वेलकम टू द चैनल JIB एंड CIB मेड सिंपल। ABFM के कंप्लीट सिलेबस को रिवाइज करना चाहते हैं, वो भी 3 से 4 घंटे में, तो दोस्तों आप बिल्कुल सही जगह पे हैं। देखिए, ABFM का कंप्लीट सिलेबस का मीनिंग ये हुआ कि जो जो इंपॉर्टेंट पॉइंट्स है, जहाँ से सवाल बराबर आ रहे हैं, उसको रिवाइज करना, तो उसको मैं कंप्लीट करूँगा। ऑब्वियसली आप जानते ही हैं कि 3 से 4 घंटे में मैं कंप्लीट सिलेबस नहीं पढ़ा सकता हूँ, क्योंकि जिसको कंप्लीट करने में लगभग 40 घंटे का लेक्चर है हमारे पास प्रति यूनिट का। तो ऑब्वियसली बात है कि हमने क्या किया है कि जो जो मेन कंटेंट है, जिससे सवाल बराबर पिछले 4 एग्जामिनेशन में आए हैं, उसको दोस्तों सिंपल भाषा में समझाया है और उसको मैंने रिपीट किया है, ताकि आपके दिमाग में वो बातें बैठ जाए और आप उस पर न्यूमेरिकल प्रैक्टिस करें तो आप बिल्कुल कॉन्फिडेंट फील करें। तो दोस्तों चलिए शुरुआत करते हैं इस मंथन को, इस पार्टिकुलर सीरीज को। सारे इंपॉर्टेंट पॉइंट्स को आपको फ्लो चार्ट और माइंड मैप के द्वारा समझाया जाएगा, और दोस्तों बहुत ही सिंपल इंग्लिश समझाया गया है। आप बिल्कुल भी डरे ना कि नहीं कि इंग्लिश में है, कोई दिक्कत नहीं है। बहुत लोगों का मैसेज आता है कि इंग्लिश में लेक्चर है, तो दोस्तों बिल्कुल भी डरे मत, बहुत सिंपल है, सिंपल भाषा में समझाया गया है। वीडियो तो अंतिम तक देखिए और देखिए आप कितना कॉन्फिडेंट फील करते हैं वीडियो को देखने के बाद। तो चलिए बिना देरी किए हुए शुरुआत करते हैं अपने इस वीडियो सेशन को। सबसे पहले हम लोग मॉड्यूल डी कवर करेंगे। मॉड्यूल डी के बाद दोस्तों हम लोग ऑर्डर में चल रहे हैं, सी कवर करेंगे, फिर ए कवर करेंगे, फिर बी कवर करेंगे, जिस ऑर्डर में दोस्तों वेटेज है, क्योंकि डी से बहुत सारे सवाल आते हैं। तो चलिए शुरुआत करते हैं मॉड्यूल डी के सारे इंपॉर्टेंट पॉइंट को।
Wished for an investment that offer the best of both the worlds, the safety of debt and the upside of equity. Will hybrid security might just be what you are looking for? Let's break it down. So if we look at the pros and cons, on the left hand side we have the pros, right, of hybrid security. First pros is higher yield. So unlike traditional debt instrument, hybrid offer better return, making your investment journey more rewarding. And it is less volatile, which means this instrument tends to have a stable price thanks to the predictable return, right? They have a stable price. Why? Because returns are predictable, which means less stress during market swing. Market swings upward and downward, so you have to take less stress during that. Then risk diversification, this is the magic. They blend equity and debt feature, right? That is why they are called hybrid, right? Why they are called hybrid? Because they blend the equity and risk, equity and debt feature, right? Helping reduce overall risk and balancing your portfolio smartly, right? So that is called risk diversification. Then on the other side we have the cons. Demerits. So first demerit is complex assessment. So evaluating hybrid security is not always easy. Their return structure can be tricky, making decision more complicated. Now regulatory uncertainty. They are also prone to regulatory changes, which might impact investment stability, a risk that every investor must consider. And finally we have limited liquidity, right? I think it is written here. Yes, limited liquidity is the next point, third point. So limited liquidity is one of the cons. So it says that so basically that if applicable, basically sometimes trading hybrid may not be as smooth as equity or bond, right? That is called limited liquidity. So these are the three demerits: complex assessment, regulatory uncertainty, and limited liquidity. And pros, I have told you: higher yield, less volatile, and risk diversification. So pros and cons are most frequently asked. So final thought is that hybrid security are like a power combo, exciting yet complex, right? Before jumping in, make sure to weigh the pros and cons carefully and match them with your investment goal, right? Because before you're starting investment, you must know the pros and cons of every investment portfolio that you have. Now friends, let's switch our focus to the understanding hybrid security and preference share. So friends, have you ever wondered what sits right between share and bond? Meet the financial chameleon that is called hybrid security, a perfect mix of debt and equity. So let's first zoom on the preference share. Let's see the preference share capital on the left hand side. Now friends, steady income if declared, we can call it. First of all, what make preference share special? Preference share capital is one of the most well known hybrid security. What make them special? Let's see. First of all, dividend right. They get dividend before common shareholder. That is why the word preference is used, right? A steady income if declared. Now the second is called cumulative versus non-cumulative share. If a company misses dividend, cumulative share carry it forward. If it is non-cumulative, you lose it, right? Then we have no legal enforcement of dividend. Even with right, companies are not bound to pay. Only if they make profit and declare it, they are bound to pay. That is called no legal enforcement of dividend, right? So rights are there, but company are not legally bound to pay. Only if they make profit and declare it, right? So there is no legal enforcement of dividend. Dividend right is there before common shareholder. If a company misses dividend, then cumulative share carried forward. That is a unique feature of this preference share. Next, have liquidation priority. Yes, if the company shut down, preference shareholder are paid before equity holder, but after debt holder. Then we have credit rating of preference share. So they can have a credit rating, helping investor assess the risk, just like a loan or a bond. Then multiple classes possible. So company can issue different types of preference share with varying terms. Voting right, yes, usually no vote, but in a special case they get a say, especially if dividend are missed repeatedly. If dividend are missed for last 2 years, try to understand. If dividend is missing for 2 years, their company is not providing the dividend for 2 years, then the preference shareholder have a say in the company. And finally, we have maturity option. Some are perpetual, which means no expiry, or the redeemable after a set period. We will understand it. So all these things are the peculiarities of the preference share capital. Now friends, let's look at some of the common type of hybrid security. So first of all, preference share, which means fixed dividend, priority treatment. Warrant, so give the right to buy share in future at a fixed price. So warrant give you the right that you can buy the share, right, in future at a fixed price. Then we have convertible debenture. So what is convertible debenture? So start as a loan but can turn into equity. FCCB, foreign currency convertible bond. So like convertible but issues in foreign currency. And mezzanine financing, a high risk, high return instrument, part debt, part equity, often used by growing company. In simple word, hybrid security are like financial discs. They borrow the best flavor of both equity and debt. They give fixed return like a loan, but also come with equity style feature like convertibility and priority. So question may be asked, which of the following is not a type of hybrid security? Some option will be given, and you must know that what are the types of hybrid security, then only you can answer it. So that is the peculiarity of this crash course, that we provide you every content in the simple word, right? So that at the time of revision you just go through these keywords and everything will be in your mind, right? So friends, let's move forward to the next topic, that is understanding preference share capital. Some more points are there. So let's take a closer look at the preference share capital, right? Which is a smart blend of safety and priority in the world of investment. So the first section is section number 43, right? So what exactly is preference share capital? You can think of this like a special type of share that gives its holder two big advantage. First advantage is first preference, right, when it comes to receiving dividend, and second is first in line to get their money back if the company shut down. So basically two advantage it provides to the holder. First preference when it comes to receiving dividend, and first in line to get their money back if the company shut down. Even if extra dividend or leftover fund are available after winding up, these shareholders still get priority over the other. That is why they are called preference share, right? First of all, they get the first preference when it comes to receiving dividend, and they are first in line to get their money back if company shut down. Then we have section number 47, that is called voting right on non-payment of dividend. I told you that normally preference shareholder don't get to vote in the company matter, but here is the twist. If company does not pay dividend for 2 consecutive years or more, this shareholder gain the right to vote on all company decision. So remember, 2 years. If dividend is unpaid for 2 consecutive years or more, the shareholder gains the right to vote on all company decision. So in simple word, no dividend for 2+ year, full voting power unlocked. Then section number 55, that is issue and redemption of preference share. So what it means, see, let's talk about these shares are issued and taken back, that is redeemed. The key rule to remember is that irredeemable share are not allowed, which means all preference share must have a way to be paid back, right? Maximum duration is 20 years, but for infrastructure project, share can go beyond 20 years, right? If a part is paid back, you can see, if a part is paid back every year, the first condition, if the part is paid back every year. Second condition, if the shareholder agree. And third condition, if their specific terms and conditions are clearly mentioned. So maximum duration is 20 years, but for infrastructure project it can go beyond 20 years if these 3 conditions are fulfilled. So these are 3 sections. I'm again zooming out. So first one is 43 regarding the definition, section 47 regarding the voting right, and section 55. So you must remember the section name also. Sometimes question may be asked, which of the following is related to the voting right? Option number A, section 43. Option number B, section 47. Option number C, section 55. So 43, 47, 55. This must be known to you, because what I'm telling you, because I have observed the question have been asked in the previous year. That is why I mention here. Take it for granted. Whatever thing is presented in the form of crash course, everything has been asked. right? That is why it is here, that is why it make a place in here, right? So friends, if you want such kind of content where you can easily revise the content in just 20 minutes, entire unit, you can go for our crash course. And you know, our main motive is that you should practice more and more questions, which I add daily in our folder, and less time should be given to theory reading and the videos, because at this moment the main thing is practice. The more you practice, the more easy it become. And how you can practice? Once your theory is clear, then only you can practice now. So theory, minimum theory, maximum practice, that should be our motto. Now friends, let's move forward and let's see the types of preference here. Preference here are further classified. So not all preference here are created equal. Let's explore the different types of preference here, each with its own unique twist, right? First of all, convertible versus non-convertible. So as the name suggests, this share come with a superpower that they can convert into equity share later as per the terms mentioned in the time of issue. You can think of it like a ticket that let you switch team from investor to the part owner. Then we have non-convertible. That means, as the name say, no switching is allowed. They stay as preference share forever. This is the default type issued by most company. Then cumulative versus non-cumulative. Cumulative, they offer fixed dividend. And here is the best part. If suppose the company is skip paying it in 1 year, it accumulate and must be paid later. It is great for long-term, long-term believer. Cumulative. What is non-cumulative? Non-cumulative, what happened? That fixed dividend here also, but no carry forward. Dividend will not be carry forward. If the company skip payment 1 year, that dividend is gone forever. Then participating versus non-participating. See, participating means what? You get your fixed dividend, and if the company has any extra profit, you also get a slice of that surplus. So it is a win-win situation. And non-participating means what? Here you get only the fixed dividend. Even if the company make bumper profit, you don't get a penny more. Simple and straightforward. Then we have redeemable versus non-redeemable. So redeemable means what? This comes with an expiry date. The company will buy them back after a fixed period. Some haven't come with a call option, letting the company redeem them early. And non-redeemable means what? That they cannot be bought back. Fun fact is that this is prohibited in India. Company here must specify a redemption plan. And finally, adjustable rate preference here. Here the dividend rate is not fixed. It moves with the market rate, offering more flexibility. You can think of it like a floating interest loan. It adjusts with the time. So from fixed to flexible, convertible to cumulative, preference here offer a whole buffet of choice to suit every investor appetite. So smart investors don't just invest. They choose the type that fit their strategy best. Right? So once you know all the peculiarities of all this, then only you can invest. So that is the main thing, right? You must know everything, that convertible, non-convertible, what is the difference. Every aspect should be clear. Now friends, let's shift our focus to the next topic, that is PNCPS feature. Friends, if this video adding value to your knowledge, please hit that like button, right? This will motivate me to make more such and such content. Now friends, have you ever heard of PNCPS? These are not your regular preference here. Let's decode the feature of perpetual non-cumulative preference here, or simply PNCPS, a smart tool used by bank to boost their capital strength. So first of all, let's talk about the purpose. So PNCPS are issued by Indian bank as a part of their AT1. AT1, additional tier 1 capital. In simple word, it is a way for bank to raise long-term fund without increasing debt. Right? It is a way for bank to raise long-term fund without increasing the debt. That is called, AT1 part. Additional tier 1 capital part. Then issuer and approval. Only bank can issue PNCPS, and that too with the approval from their board of director. So yes, it is not a casual call. It need official backing. Capital limit. So bank can issue PNCPS up to 1.5% of their risk weight asset in AT1. I think you know the limit. You already have learned in BFM that maximum AT1 can be 1.5 of the RWA. So that is the cap to make sure that bank don't rely too much on this instrument. Then if we talk about the future of this instrument, no maturity, no step up, no redemption. They are perpetual in nature. They live on forever. That is called perpetual. So unless the bank decide otherwise, it's like a fixed seat in the bank capital, not a short-term guest. Now friends, dividend. Dividend can be fixed or a floating, but there is a twist. The bank can cancel them if they want to, especially during tough time. So no guaranteed income here. So bank discretion is required. Bank can cancel them also. Call option. So bank can call back. Call back means redeem. So bank can call back this share, but only after 5 years, right? And with RBI green signal. So again, no random buyback. Now principal repayment. Same story. The repayment of your capital also need RBI approval, right? You can't just expect your money back anytime. Then loss absorption. So in the bad time, this share can be either converted into equity or they are written off completely. Yes, you can lose your money. That is why it is a part of AT1. It absorbs the risk, right? Then restriction. Bank can't use PNCPS to fund their own group company or related party. No sneaky moves is allowed. Claim hierarchy. If the bank goes bankrupt, PNCPS holder rank above equity holder but below creditor. So you will get paid but only after the big lender. So to wrap it up, PNCPS, so basically this is all point we have covered regarding PNCPS. If you go through a book, it is covered in 2 pages, and in one slide everything is clear, because these all those main points have been taken at one place, and just I provided you this slide. Now, so what is the wrapping up? So PNCPS is a bold, risky but clever capital tool. It gives bank flexibility, but investor must accept that they are taking a higher risk for a potentially better reward. Obviously, they are taking higher risk here. Now friends, let's look at the Black-Scholes model. Every year warrant valuation, one question is asked based on Black-Scholes model. Ever wondered how financial analysts value complex instrument like warrant? Let me break down the legendary Black-Scholes model in the simplest way possible. You can think of it as a recipe to find the fair price of warrant. Now, let's first of all, the first step is to identify the key variables. So start with the ingredient. We need volatility of the stock, right? How much the price move. We need the current stock price. We need the time left until the warranty expire. We need the strike price. What is the strike price? The price at which warrant can be exercised. We need the risk-free rate, which means like government bond interest rate. So these are the building block of the formula that is called key variable. Then we calculate D1 and D2. Now we plug those variable into the Black-Scholes formula to get 2 critical value, D1 and D2. They help us estimate the probability of making a profit from the warrant, right? So D1 and D2 help us estimate the probability of making a profit from the warrant. Don't worry, the formula look tough, but it's just a fancy calculator behind the scene. You don't need to remember the formula, right? That's why I have not added here, right? So D1 and D2 you have to calculate. They help us estimate the probability of making a profit from the warrant. Then we find ND1 and ND2. So what it is? Something called a standard normal distribution table. So these values represent probabilities, like what are the chances that this warrant will be in profit. That is called ND1. These are like probability, what are the chances that this warrant will be in profit. Now, then we calculate the present value. It's time to discount the strike price to today's value. Think of it like this. 100 rupees received a year later is worth less than rupees 100 today, obviously. So we calculate that reduced present value using math. I think you know it very well. Now then we apply the Black-Scholes formula, right? So now bring it all together, use the full Black-Scholes formula to calculate the actual value of warrant. It blends probability, time value and volatility all in one shot. And feeling lazy, let's Excel do the heavy lifting. Use function like non.dist, exp, ln. So basically using Excel the calculation is done. But what we should know that what are the steps involved. This you should know, right? So identifying key variable, right? So that's it. Black-Scholes model might look complex, but when broken down, it is just a series of smart steps to price a warrant logically and accurately. Now you know the secret sauce used by market pros, right, for valuation of warrant. So you must know what Black-Scholes model used for valuation of warrant. Now 2 ratios, super important. One question is fixed every year: conversion ratio and conversion price. See, so if you are confused between conversion ratio and conversion price dealing with debenture, so these are dealing with debenture, right? Let's simplify these 2 powerful concepts with a real world twist. So if you are holding a convertible debenture, these 2 numbers decide how many shares you will get and at what price. So what is conversion ratio? Imagine that you have a convertible debenture and the company promise you equity share instead of the cash at maturity. Yes, since it is convertible, so obviously that debenture can be converted into equity, and that is what company has promised you. Now conversion ratio tells you how many shares you will get for each debenture. That is called conversion ratio. Means for every one debenture, how many shares you will get, right? That is what is told by conversion ratio. For example, if CR is 5, suppose conversion ratio is 5, it means one debenture gives you 5 equity share. That's it. Simple math, right? So that help you estimate your potential ownership in the company. So CR is 5, it means for one debenture we will get 5 equity share. Simple math. And what is this conversion price? Now comes the money talk. Conversion price is the effective price you are paying per share at the time of conversion. Effective price you are paying per share. So the formula is conversion price is equal to par value of the debenture, that is called face value of the debenture, and divided by conversion ratio. For example, if your debenture face value is rupees 1000 and conversion ratio is 5, so conversion price will be 1000 divided by 5, which will be rupees 200 per share. So you are getting one shares at rupees 200 each. One share costs rupees 200, no matter what the current market price is. right? So so let's wrap up. So basically conversion ratio tells you how many share you get, and conversion price tells you at what price you are getting them. So these two terms are key to evaluating whether a convertible debenture deal is worth or not. Remember it, very very important. That is why it is called crash course, right? Because we are not covering everything, we are covering only thing that matters, because for everything we have separate lectures available, unit wise lecture which covers every aspect. But right now what is required, the main points that should be covered. Now friends, let's look at the ever heard of financial instrument that can act like a debt and equity. They are called hybrid instrument, and today we will decode two powerful one, FCCB and mezzanine financing. Question are every year asked. So first of all, FCCB, imagine this as a bond, right? So FCCB, foreign currency convertible bond. So basically you can imagine this as a bond issued in foreign currency, but with a twist. It starts as a loan, that is debt, but may end as ownership, that is equity. So the definition is FCCB are hybrid security issued by the company in foreign currency. They offer interest, as you can see, coupon payment, and return the principal unless they are converted to equity. Right, they return the principal repayment. Conversion option to equity is there, right? So that is the definition. If you look at the key features of this, FCCB, that investor get the option to convert their bond into share, but conversion happen only if the market price of the stock is higher than the conversion price. See, conversion when will happen? If the market price of the stock is higher than the conversion price, right? If the stock underperform, no conversion will happen, it remained as a bond. So underperform is what? If the market price of a stock is less than the conversion price, then no conversion will be done. I think you are familiar with the conversion price. We have already talked in the previous year. Means per share, what is the price you are paying for each conversion? That is called conversion price. Now, who invest? Hedge fund and foreign investor love this for potential upside. So investor, you can see hedge fund and foreign investor. Now, if we talk about the smart option, call option is there. The issuer can redeem the bond early, and put option is there. The bondholder can demand early redemption. So both options are there, call option and put option. Then friends, if we talk about the currencies, so they are issued in a stable currency, like usually in dollar, euro. They help reduce currency volatility, and they also offer lower interest rate due to the sweetener of the conversion. And so there are some risks are there, like currency exchange rate swing, political, legal, economic uncertainty, and of course credit risk is there. What if the company fail? And terms and repayment, typically 5-year term. If not converted, the investor get the principal back. Bottom line is that FCCB combines security of debt with potential of equity, but can carry the global risk exposure, because obviously foreign exchange dealing is there. Now, mezzanine financing. See, basically you can think of them like a bridge between traditional loan and fully fledged equity. On one side you have loan, traditional loan. On other side you have fully fledged equity. So they act like a bridge between them. So a hybrid instrument that give the lender the right to convert into equity, usually if the borrower default or the business condition are met. So that is called hybrid security. Means it gives the option the lender to get a right to convert to equity, usually if the borrower default. Suppose borrower defaulted, or when business conditions are met. In these two conditions they will. What is the purpose? It is commonly used to fund large project or acquisition when traditional funding is not enough. Suppose traditional funding is not enough, right? So you want to fund a large project. In that case, mezzanine financing is great. If you look at the return and cost, so investor earn higher return than normal debt, and for company it is cheaper than equity but more expensive than regular debt. If you look at the structure, so unsecured means no collateral, fixed or variable interest rate. It is unsecured, no collateral is taken. It is fixed or variable interest rate. Both can be possible, and usually mature after the 5 years. And one thing is that the biggest advantage is that it aligns the investor interest with the company long-term success, since they can become shareholder also. So investor interest aligned with the company long-term success, right? So friends, if we wrap it up, these two, mezzanine financing and FCCB. So FCCB is foreign currency bond with conversion to equity option, and mezzanine is hybrid loan that may turn into share with high return. Both are creative financial tool that balance risk, reward and flexibility for both company as well as the investor. Now friends, let's look at the last slide, that is called Collard FRN. What if you could invest in a bond that move with the interest rate but never goes too low or too high? And what if the same bond could also react to a company credit rating? Welcome to the smart world of hybrid security, where innovative means investor need. Today we are exploring two unique types. FRN, that is called Collard FRN, Collard floating rate loan, and rate sensitive FRN. Right. So first of all, let's talk about Collard FRN. Let's rewind to 1993, where Solomon Brothers introduced a clever new product issued by Lead Permanent Building Society. What are they? So they are basically the floating rate bond, which means the interest move with the market rate. Typically LIBOR, London Interbank offered rate. So market rate changes, interest rate moves. But there is a twist. The twist is that they come with a floor and a cap. That means the floor and the cap set the boundary for the interest payout. What is the floor? Floor is 7%. What is the cap? Cap is 11%. So floor means 7% means the minimum interest you will earn. Cap 11% means maximum interest you can receive. So no matter how wild the market swing, your return stay within a safe collar. Right, that is why it is called collar. There's a collar, right? And your return will remain between the 7% and 11%. And if you talk about the currency and maturity, they were sterling denominated with a 10-year term and a face value of 100 million euro, right? As you can see written clearly here. Now, what is the purpose of it? To protect both issuer and investor from volatile interest rate, giving stability and predictability. And behind the scene, you know how it works. The issuer actively use the derivative market. Right, they use the derivative market. How? They sell the cap. That means they limit the maximum payout. They buy the floor. They ensure minimum return. So this helps lower the cost of issuing the bond while managing the risk effectively. In short, we can say it is like having a floating rate bond with built-in safety net. Two limits are there, floor and caps are there. So it is kind of, you know, say a floating rate bond because interest rate keep fluctuating. And if you talk about the rate sensitive FRN, so this was a bond that adjusts its return based on the issuer credit worthiness. So issuer credit worthiness matter here a lot. It was introduced in 1988 by Hanover. The FRN offered a special spread over LIBOR. So LIBOR is there plus some spread is there. But the kicker is that the spread increased when the issuer credit rating dropped. Yes, suppose issuer credit rating drop, then a spread increase. So if the issuer become riskier, the investor was compensated with higher return. So why does this matter? Because it aligns risk and reward perfectly. The lower the issuer credit score, the more the investor earn to cover the added risk. And you know, if you talk about the benefits of this hybrid instrument, that they help complete the market, offering new way for investor and issuer to balance risk and return. And they offer tax advantage also to some you know jurisdiction, and they bring in customization. But you know, criticism also exists. Some argue that these securities were the part of supply driven craze, and bank and institutions start pushing them aggressively without truly matching investor need. So while the idea was strong, the execution got messy at time. Still there is a support. Hybrid security are, you know, these offered tailored solution helping issuer reduce cost and investor get better return. You can easily understand and you can easily revise. So let's get started with our first topic, that it is Startup India framework, a bold step toward a new India. So look at this particular mind map. So it was launched in January 2016, as you can see, launch date. By whom? By the Department for Promotion of Industry and Internal Trade, which is called DPIIT, right? What is DPIIT? Department for Promotion of Industry and Internal Trade. And you know, the Startup India framework marks a transformative shift in the India's economic landscape. Now if you look at the launch goal, so what was the goal of behind launching it? So to spark a revolution of entrepreneurship, to fuel innovation and drive job creation and ensure a smooth flow of investment into the economy. So these were the goal behind launching the program. Now if you look at the action plan, so here you can see the action plan. Let me zoom a little bit. So at the heart of this mission lies a comprehensive action plan built on 3 pillars. First one was, you know, unified policy. Second is clear action point, and third is seamless execution. So these are the 3 pillars: unified policy, clear action plan, clear action points, and you know, seamless execution. Now let's talk about the key features that make it stand out. So what are some key features? Here you can see the first is, you know, that incentive is disbursed online, ensuring transparency. So online incentive disbursement, thereby transparency is ensured. And you know, a startup get recognition within 72 hours. So you know, you don't have to wait for longer. This is one of the key point, that within 72 hours, I think it is 3 days, right? So within 3 days the startup get recognized. So a startup get recognition within 72 hours, and you know, no recommendation letter needed, just your ideas and ambition, that's it. Even a scalable business are welcomed with open arms. So you can see a scalable business are also included. So basically, if you talk about the vision, if you look at the vision of this Startup India framework, so basically a thriving startup ecosystem where creativity is unlocked, the economy grows sustainably, and job opportunities are available in abundance, right? And if we talk about the platform, so all of this is brought together at one digital destination that is called a Startup India Hub. So these are the points which we have to go through regarding this Startup India framework: launch body, launch date, key features, launch goal, action plan, and vision, right? So now friends, let's shift our focus to the next scheme that we have. It's called, you know, Startup India. So Startup India is not just a campaign, it is a powerhouse of support for every aspiring entrepreneur in India. So let's explore the rich benefit it brings to the table. The first is incubator services. So basically from day one, startup get access to startup capital access and funding avenue. They get access to the tech and lab infrastructure, mentorship and advisory and co-working space, plus unbeatable networking opportunities to fuel growth. Right. So incubator services. So first of all, it includes startup capital and funding avenue, tech and lab infrastructure, mentorship, advisory and co-working space, plus unbeatable networking opportunity to fuel growth. The second is we have innovation and incubation support. See, to turn bright ideas into world-changing reality, Startup India promotes Atal Innovation Mission, right? The SETU program, global grade innovation hub, that is called world class innovation hub, and dedicated incubator setup support. So these are things included under the innovation and incubation support to turn bright idea into world changing reality. Startup India promote Atal Innovation Mission, C2 program, global great innovation hub, and incubator setup support. Then if you look at the financial benefit, here you can see financial benefit of it. So money always matter, and Startup India ensure that it is easy to manage tax incentive, capital gain tax exemption, direct government funding support, and public procurement policy priority in the public procurement. So this is financial benefits. And if you look at the regulatory restriction, so just you can see it here, regulatory restriction. So regulatory relaxation, right? So focus on your startup, not on paperwork. So self-certify under 9 labor and 3 environmental law, and enjoy inspection exemption and relax compliance norm. So this is called relaxation, regulatory relaxation. That means focus on your startup, not on paperwork. So that is some relaxation has been given so far as paperwork is concerned. Now we have IPR benefit. So IPR, intellectual property right. So protecting innovation is made simple. 80% discount on patent fee, 50% rebate on trademark, and free facilitation support, and a fast track exit option when needed. So whether you are at the ideation stage or scaling up, Startup India is your ultimate growth partner, offering tools, trust, and transformation. The 3 T's principle, right? So that is about Startup India, incubator services, financial benefit, innovation, incubation, every aspect we have talked about in this particular slide. Now we have Startup India Yatra. So what is Startup India Yatra? Let's discuss. So imagine a journey that is not just about covering miles but discovering minds. Right. So that is called Startup India Yatra. Welcome to the Startup India Yatra, a mission driven movement that bring the startup ecosystem to the remotest corner of India. If you look at the purpose of this Yatra, Startup India Yatra, so this initiative is built to discover the hidden talent across town and village. Second, to expand the startup ecosystem beyond metro cities. Third, to support grassroots entrepreneur. And fourth, to offer incubation support when it is needed the most. So these are the purpose of this Startup Yatra, Startup India Yatra, to be more precise. And if you look at the mission of it, so 2 mission is given in your book, that with the goal is to visit every district in India, and it aims to bridge the resource gap. Means connecting rural innovator with urban opportunity. Then we have the key elements. So key elements that drive the Yatra. First is mobile vans equipped with tools and mentors. Second is wide district level coverage. Third is access to incubators opportunity, and hand-on boot camp to sharpen startup skill. Right. So these are key elements: mobile van coverage, incubator opportunities, and hand-on boot camps to sharpen startup skill. So from idea born in a small town to innovation that inspire the nation, Startup India Yatra is India's innovation highway, ensuring no talent goes unnoticed. Right. This is called Startup India Yatra. Now then we have WING. WING is what? Women Capacity Development Program, WING. Right. So friends, what happen when you give wing to your idea? You create a revolution led by women entrepreneur. So introducing WING, Women Capacity Development Program, a bold step toward creating equal opportunity in the startup world. So what is the vision of it? So as you can see, the vision is to support women-led entrepreneur, or to support women-led ventures, enhance their awareness and accessibility, and provide the right platform and training to grow. Now here we have virtual incubation. So basically a 3-month acceleration journey specifically for 20 women-led tech startup and in partnership with Zone Startup, all free of cost because support should not come with a price tag. So virtual incubation means 3-month acceleration journey is specifically for 20 women-led tech startup in partnership with Zone Startup, all free of cost because support should not come with price tag. Then we have the funding support. What is the meaning of funding support? See, women can apply via Startup India Hub, get screened by expert, and connect with CAIIB. I think CAIIB is no, right? CAIIB to explore financial assistance. Then we have workshop. So this is all funding support. So from where they get funding support, they get screened by the expert and connect with CAIIB to explore the financial assistance. And on the right side, you see there are workshops that make the difference. So what does it mean? 21 powerful capacity building workshop are there. It helps across 9 states and benefiting our 1150 plus women entrepreneur. So these are the characteristics of workshop. And if you look at the online presence, so here you can see the online presence. So a dedicated page on the Startup India Hub keep everything accessible, centralized and easy to explore, right? So this is about Wing program, Wing, right? And goal is very much clear. So Wing program is not just an initiative, it is a movement to redefine India's startup story through women-led innovation. That is called Wing program. Now let's look at the next slide that we have, that is called overview of the startup challenge. So basically, what is the meaning of a startup challenge? So Startup India is not just about ideas, it's about solving real world challenges, right? So let's look at how startups are tackling some of the most pressing issues across key sector. The first one is animal husbandry and dairy. It was launched by the Department of Animal Husbandry in collaboration with Startup India. And basically this challenge kicked off in 2019 and again in 2021 on National Milk Day in Anand, Gujarat. The goal was to find innovative tech-driven solution that can revolutionize the dairy and livestock sector in India, empowering farmer and boosting productivity. That was the goal of this animal husbandry and dairy program. Then we have the Ayushman PMJY challenge, a powerful partnership between NHA, right, and Startup India under the Ayushman Bharat Jan Arogya Yojana. This challenge opened the door for startup in medical device and digital health to bring innovation directly into public health care. It's all about take meeting care to support India's largest health protection scheme. Then we have textile and garment, the innovation challenge. So Indian textile is rich in heritage and ripe for transformation. So this challenge aimed to push cutting edge innovation into one of the India's most labor intensive sector with a global market of 1.3 trillion. With a global market of $1.3 trillion by 2025 and domestic target of $59.3 billion by 2022, the future of fabric is smart, sustainable and startup power. So these are not just challenges, they are opportunity to build impactful, scalable solution and be a part of India's innovation revolution. Now friends, so all the content which I am sharing with you is the part of the crash course. After going through all these content, you have to solve today's MCQs and quizzes which I have added in today's folder. Now friends, let's look at the next slide. So basically we are talking about comprehensive overview of SUP challenge. So basically it is a bold initiative to reshape the future of packaging in the food and beverage industry. So what are the objective of it? As you can see, it to eliminate the single use plastic. What is the full form of SUP? Single use plastic. To promote eco design alternative and to empower F&B, that is food and beverage innovator, to create sustainable solution. So to encourage F&B, that is food and beverage innovator, to create sustainable solution, to promote eco design alternative and to eliminate single use plastic. If you look at the challenge detail, so this initiative powered by the Government of India and Startup India was launched under the banner of the SUP Challenge Goa, right? Event name SUP Challenge Goa. Startup were invited to co-develop pilot project, right? Startup were invited to co-develop pilot project with F&B partner across Goa, turning eco-friendly dream into tangible product. Now, funding and execution. So the challenge was backed by global visionary like to Prevent Waste Alliance, Germany, ECCA Family Foundation, and execution was steered by the Incubation Network with Climate Collective Foundation as the India's partner, right? At the grassroots level, Atal Incubation Center, GIM Goa brought it all together. That is called funding and execution. So again I am repeating that challenge was backed by global visionary like Prevent Waste Alliance, ECCA Family Foundation, Execution was steered by Incubation Network with Climate Collective Foundation as the India's partner. If you look at the global participation, not just India, this movement brought in minds from India, Philippines, Thailand, Vietnam, Indonesia, with 8 entrepreneur support organizations, which called ESO, right? 8 entrepreneur support organizations working across the border. This was truly a global cooperation for local impact. Now the outcome was that it bridged the gap between industries and innovator, giving rise to a scalable, eco-friendly solution that can revolutionize the way food and beverage are packed and delivered. Then the next point we have is SPRS, that is called Single Point Registration Scheme. So basically this is an entry pass to the public sector opportunity. This scheme is driven by the Ministry of MSME, right? The force behind empowering micro and small enterprise across India. If you look at the purpose of it, so the core mission is to boost government procurement from MSE, not MSME, MSE, that is micro and small enterprise, to boost the government procurement from micro and small enterprise and make it easier for them to participate in tender confidently and competitively, right? So that is the main purpose. Again, I am repeating, the purpose is to boost government procurement from micro and small enterprise and make it easier for them to participate in tender. If you look at the background, the root of this scheme trace back to the government store purchase program of 1955 and 1956. And if you look at the eligibility, who can apply? First of all, MSE with UAM or EM Part 2 registration, they can apply. Second, those engaged in commercial production. Third, an even unit less than a year old can get a sort. So these are the 3 eligibility criteria, right? I just told you. Now registration validity. So the registration is valid for 2 years, but it does not stop there. It is renewable as long as the unit continue to prove its competence. So registration is valid for 2 years, and but it does not stop there. The registration is renewable as long as the unit continue to prove its competence. So this is called single point registration scheme. So with the single point registration scheme, MSME gain more than the access. They gain recognition, they gain opportunity, and they gain a seat at the national growth table. That is called SPRS. Now, very important scheme, Startup India Seed Fund scheme. It could be your launch pad, but first let's check it if you are eligible to fill that dream. First of all, legal entity. What does it mean? So to begin with, your startup must be legally registered under the relevant government act. No shortcuts here. Official recognition is must. Then we have operational tenure. So you need to be more than just a name. At least 2 years of active operation is minimum bar to qualify. Infrastructure. So your startup incubator must have a minimum capacity of 25 seats, because the real ideas need real space to grow. So at least 25 seats should be there. Minimum capacity of 25 seats. And startup presence. So your incubation center should already be nurturing at least 5 active startup, right? So your incubation center should be nurturing at least 5 active startup. We are talking impact at a scale. Then we have team requirement. So strong leadership is the key. A full-time CEO with business development plus entrepreneurship experience. A support crew covering mentoring, testing, validation, finance, legal, HR. This is where vision meet execution. If we talk about the funding rule, no third-party private funding is allowed for seed distribution. This ensures clarity, focus, and fairness. So no third-party private funding is allowed. This is very much important point, right? We are talking about Startup India Seed Fund scheme. Then we have government support clause. So basically, if you got state or central government support, that is great. If not, then ensure that minimum 3 years of operation, 2 years of audited financial, and minimum 10 physical startup under incubation. This thing you have to ensure, right? If you have got state or central government support, it is great. If not, then ensure these things. Then we have EAC clause, that is called expert advisory committee clause. So you need to meet the extra eligibility criteria laid down by the expert advisory committee. So seed funding scheme is not just funding, it is a launch pad for India's next wave of innovation. Then we have the seed fund grant, right? So every aspect of it has been taken care of in this particular slide. So this is the heart of the process, that is called seed fund grant guideline. So first of all, incubators duties. So incubators is not just a place to sit, it is your startup powerhouse. They are responsible for infrastructure support, mentoring, capacity building, networking opportunity. So incubators don't just host, they help the build business. Then we have utilization timeline. So time is money, and here is how it is monitored. 3 years, you must utilize all of it. 2 years, at least 50% must be used. No further drawdown after deadline, so use it wisely and timely. Then we have, fund use restriction. Here you can see fund use restriction. So this is only for startup funding. No infrastructure cost, no administration expense, a tiny 0.5% management fee is allowed. That's it. That is called, fund use restriction. Then we have, installment. So money is not handed over all at once. Here is how it is released. First installment up to 40%, and next only after milestone proof. And the best part is that fund are released within 30 days of approval. So the release time you can see within 30 days of the approval. And if you talk about the evaluation, so you can see that expert advisory committee steps in here. The expert advisory committee evaluate every proposal and approve funding on milestone based mode. This is called, milestone based model, meaning you grow, they release. This is not just money, it is a mission backed investment in ideas that matter. Right, so if you are ready to build with purpose, track with milestone, and scale with support. Right, so that is our, Startup India seed fund grant scheme. Then we have what? SIDV fund of fund scheme, very very important. Right, SIDV fund of fund scheme. Now friends, we have what? Startup India seed fund scheme overview, very very important. So basically, what does this scheme aim to achieve? As you can see, objective, it was launched on 19th April 2021 and with total fund of 945 crore. Objective was proof of concept, means supporting entrepreneur to validate their idea. Product trial, which means enabling real world testing of new product. Prototype development, which means helping a startup create their first working prototype. Commercialization, which means, taking product to the market. And market entry, which means helping business get a foot in the door. So, it is a fully fledged support system for a startup to reach their next big milestone. And this scheme aims to empower 3600 entrepreneur, right? Entrepreneur and collaborate with 300 incubator to drive innovation and to foster growth in the startup ecosystem. Now if you look at the structure and process, here you can see, then we have the first thing called PM announcement. So this scheme was announced by the Prime Minister himself. Then we have DPIIT management. So the scheme is managed under the Department for Promotion of Industries and Internal Trade, that is called DPIIT. Then we have expert advisory committee. So a panel of experts ensure the funds are distributed effectively. And we have the incubator role. Incubator plays a crucial role in nurturing and supporting the startup. If you look at the fund allocation, so here you can see, so 290 crore is allocated to incubator, ensuring they have the resources to support entrepreneur, and 265 startup has already been funded under the Startup India seed fund scheme. Right, so basically government is helping entrepreneur to turn their dream into reality by using this scheme. Then we have TDF, that is called Technology Development Fund. So what it is all about, let's understand. So the primary objective of this TDF is to enhance self-sufficiency in defense technology, aiming to foster innovation and development in area crucial to India's defense capability. This fund is overseen by DRDO, this Defense Research and Development Organization, and by the Ministry of Defense, ensuring expert management and efficient use of resources. Then we have a goal. The goal is clear: to encourage both private and public industry to develop cutting edge technology that can elevate India's defense sector. The initiative is a step toward building world-class defense infrastructure and innovation. If you look at the eligibility, who can benefit from this fund, then the first we have entities like public or private company, LLP partnership, sole proprietorship, MSME, and startups. These are the entities who can benefit from this fund. Ownership, at least 51% of the share must be owned by the Indian citizen. And location, this entity must be registered in India. Now if we talk about the funding, so the project cost, the fund cover up to 10 crore for eligible project, and grant coverage is how much? The fund provide a generous 90% grant coverage for the project cost, making it a highly supportive initiative for defense technology. Right, so with TDF, India is opening door to innovation, encouraging local industry to create state-of-the-art technology for defense. Then we have India Croatia Startup Challenge overview. Right, so this question is also asked. So this challenge, what is basically this collaboration between India and Croatia basically aims to create impactful solution for a global challenge. And the challenge is what? A strategic partnership between India and Croatia, designed to foster innovation across multiple sectors. What are the focus area? Sustainability, which means developing green eco-friendly solution for better tomorrow. Education means so eligibility means if you are entrepreneur or if you have a startup, the challenge is for you. This challenge is for you. Basically eligible participants include registered business, from both India and Croatia, and innovator who are passionate about making a difference. And you know, this India Croatia ecosystem startup challenge encourage solution in the following key category. First, we have clean water and sanitation, means tackling global water scarcity issue, reducing inequality. Left hand side, what you will see the points about shared trait, and the right hand side you will see the key difference. So let's start with the shared trait first. Though different in style, but PE and VC share some common ground. Like the first point is autonomous capital, which means both tap into private fund from wealthy individual and institution. So both tap into what? Private fund. From where? From wealthy individual and institutions. Second, high incentive. You know, fund manager are fueled by lucrative performance based reward. That is called, you know, high incentive, right? So fund manager are fueled, they are motivated by lucrative performance based reward. Then we have, you know, pre-public investment, which means, you know, they both invest in company before they hit the public market. That is called pre-public investment. Whether it is PE, whether it is VC, they both invest in company before they hit the public market. That is called pre-public investment, right? Then low regulation, which means, you know, that their strategies remain flexible thanks to minimal regulatory interference and active oversight. So both demand close monitoring to drive performance and protect investment. So these are the common trait which is shared by both PE as well as the VC. So autonomous capital, let's zoom a little bit, zoom out. Autonomous capital, high incentive, pre-public investment, low regulation and active oversight. Now if you look at the key difference between them, on the right hand side you will see the key difference. So if you look at the key difference, so on the other hand, key difference are, first of all, that is where, you know, PE and VC carve out their own path. Restructuring focus. So PE take charge of the transforming business through financial and operational restructuring. So, you know, through financial and operational restructuring, private equity takes charge of the transforming business, right? So transforming business through financial and operational restructuring. Then we have stages of investment. So VC dive into early stage startup, while PE prefer matured established company. So VC, that means venture capital, invest in early stage startup. So those startup which are at early stage, there VC dives in, and PE, that is private equity, prefer mature and established company, right? So that is on the basis of a stage of investment. This is the difference. VC invest in early stage startup, while PE prefer mature established company. What about governance versus management? So PE enforce tight governance, while VC nurture capable management. So PE enforce tight governance, while VC, that is venture capital, nurture capable management. If we look at the debt versus equity difference, so PE often use mix of debt and equity, and VC, it is all about equity, right? So PE private equity is all about, you know, mixture of debt and equity, while VC is all about equity. And that is a snapshot. Whether it is private equity or venture capital, both are power player in shaping the future of the business. So let me again go through the key points. Restructuring focus, right? Stage of investment, early stage VC investment, and PE in mature stage firm. Governance and management, just now I told you, governance versus management. PE emphasize corporate governance, while VC management capability, and PE may use debt, VC primarily use equity only. So that is the difference. Now in the next slide, so ever wondered how a startup land big ticket investment from venture capital? So let us take you behind the scene of the VC funding process, right, step by step. First of all, we have something called, you know, deal origination, as you can see. So it all begin with identifying potential investment opportunity, usually through trusted network, right, referral or industry event. Then screening and shortlisting. The VC team evaluate the deal based on market potential, tech innovation and the stage of funding. Only the most promising make it to the next round. That is called screening and shortlisting. Then we have detailed evaluation and rating. So now it gets serious. The VC, that is venture capital, digs into the founder track record, revenue forecast and risk profile to assess long-term viability. Then we have deal negotiation. If the number and vision align, it's time to talk terms, right? Negotiating a win-win investment deal that benefit both the founder and the investor is the key. Then we have, you know, post-investment activities. So investment secured, but the work does not stop yet. VC monitor progress, offer strategic support, and often take board seat to guide the startup journey. And finally, we have exit strategy, which is the ultimate goal is to maximizing the return. That could mean an IPO, acquisition, or even a buyback, whatever deliver the best outcome. That is called exit strategy. So that is the ultimate goal is to maximize the return, and that could mean an IPO, acquisition, or even a buyback, whatever deliver the best outcome. So what we have seen in this particular slide, from discovering to exit, this is how venture capital fuel innovation and build tomorrow giant. Now friends, let's look at the VC firm role and responsibility. So who is who in venture capital firm? Ever wondered how venture capital firm actually operate behind the scene? Let's break down the key player and their role in fueling the startup ecosystem. First we have the analyst. Analyst, the entry point into the VC world. These are often fresh grade or MBA intern who dive into market research and initial deal analysis. Then we have associate. After analyst, what we have? Associate. On the right hand side you can see associate, basically a setup. Associate sources deal, build founder relationship, but don't make final investment decision. They are the vital connector. They act like a connector. They build relationship, as you can see. After associate we have principal. What principal do? So principal plays a strategic role in guiding entrepreneur and contributing to the investment decision. So two keyword: investment decision, entrepreneur guidance. Think of them as decision influencer. Then we have partner. On the left hand side you can see. So partner is where the power lies. General partner make final investment call and managing partner oversees firm operation. So basically this is where the power lie. And then we have venture partner. So these pros are deal magnet, right? So they bring in top tier opportunity and earn a share of profit without getting involved in day-to-day operation. That is called venture partner. And then we have EIR, entrepreneurship in residency. So a unique role is there. So they share a unique role, temporarily onboarding for 12 to 18 months. They are tasked with launching the next VC backed success story. And finally we have something called limited partner, as you can see here. So limited partner, the silent but essential force. These are the fund provider, pension fund, endowment, high net worth individual who stays out of the operation but bankroll the entire search engine. So from analyst to partner, each role plays a crucial part in turning visionary startup into tomorrow unicorns, right? So that is all about this particular slide. As you can see, analyst, associate, venture partner, entrepreneur in residence, partner, principal, limited partner. So question may be asked that which of the following is a role of partner, which of the following is a role of venture partner. So you must note it down. Now friends, let's look at the next slide. So friends, here we are talking about VC fund metrics and returns. So what determine the success of venture capital fund? It's all about hitting the right target, and each one matter. So first of all, VC fund success. So the ultimate goal, the ultimate goal is to achieve the strong return for limited partner. Miss the mark and the fund is considered a failure. That is called VC fund success. The ultimate goal is to achieve the strong return for the limited partner. I think we have just discussed the limited partner. They fund investor, they provide capital, not involved in operation. So basically VC fund success, how it is measured? So achieve a strong return for the limited partner because they are the one who have invested in the amount, right? Like insurance company are the limited partner. Hurdle rate. This question is asked, what is hurdle rate? See, this is the minimum return promised to LP. Think of it like floor. If the fund can't clear this hurdle, it is falling short. It is failing short. Right. Then we have expected return. So venture capital is high risk. So naturally investor expect high reward to match. This metric keep the pressure on. Then we have sector focus. Not all industry deliver equal return. For example, SaaS, software as a service, might outperform D2C. So smart sector selection, it means a stronger return. Then we have stage focus. So investing early, like in seed round, means more risk but also more upside. Later stage like Series B tends to be safer but with modest return. Right. Now friends, so in venture capital, as you can see in this particular diagram, every arrow must be aimed with precision because only the right mix of metric leads to the winning return. Now friends, let's switch our focus to the next slide. This is the uniqueness of our crash course. Everything is presented in the form of mind map and flow chart, so that you should focus on only thing that matters from examination point of view, and your rest time should be focused on solving MCQs and case studies, which I am adding on daily basis in our crash course. If you are interested in the crash course, please see the link below in the description section. You will get the link of the course. Now friends, also we are offering 40% discount on the same. Now friends, let's talk about the private equity. That means behind the buyout. So private equity is not just about big money. It's about a strategic transformation, long-term play and powerful exit. What are the pros? As you can see, pros are PE bring in alternative capital, right, with no quarterly performance pressure. First point, it gives firm breathing room to grow strategically. That is the pros. It brings in alternative capital with no quarterly performance pressure. And if we talk about the cons, so but there are trade-off. Valuation are not market driven and holding period can stretch for year, demanding patience. So pros are also there as far as private equity is concerned, that it brings in alternative capital with no quarterly performance pressure. It gives firm breathing room to grow strategically. But cons is that there are trade-off where valuations are not market driven and holding period can stretch for year, demanding patience. Now income source. Here you can see income source. So what are the income source? So PE firm earn through management fee and performance based incentive, aligning their success with the fund performance. So two types of sources are there. First is the management fee and performance based incentive, aligning their success with the fund performance. And if we talk about the funding use, so here you can see funding use, where funding will be used. So where does the money go? Into new technology, acquisition, working capital, and balance sheet improvement. So fueling serious growth. And what about the exit event? So the end game, an IPO, a strategic sale, or turnaround exit. These are the end game. Each move is planned to maximize investor return. And if you look at the structure of this PE, so PE firm operate with LP owning 99% with limited liability, while GP means general partner own 1% but hold full responsibility for investment. This is the structure of private equity. LP owning 99% with limited liability, and GP on 1% but hold full responsibility for investment. And finally, investment sources. So I told you who fund it all. Institutional investor fund it and accredited individual fund it, which are the backbone of private equity. So friends, if you summarize this entire is this entire private equity, so we can say that private equity is about high stake strategy with equally high potential reward. It is not fast, but it is very powerful. Now friends, let's look at the types of private equity we have. Very important slide. So private equity is not one size fit all. It branches into a specialized strategy designed to target different market, different risk level, and different investor goal. The first kind we have is called venture capital. So venture capital is a dynamic subtype of private equity, and this VC is driven by angel investor. It is funded by angel investor, right? And and venture capitalist. So two person fund it. Venture, it is funded by angel investor and venture capitalist. So if we talk about the stages, it fails the early stage journey from seed, which is called prototype phase, to the series A, which we call where a startup is scale up and prepare to conquer the market. So if we talk about the stages of venture capital, it fails the early stage journey from seed to series A. Right, seed means prototype phase and series A means startup scale up and prepare to conquer the market. So this is the stages of the stages of the journey. So early stage, seed, and series A stage. Now VC is where innovation meets capital. Venture capital is where innovation meets capital. Now the second point we have is called real estate private equity. So the second type of this private equity is called real estate private equity. So what happened, that gained massive momentum post 2008 after the real estate crash. So real estate crash post 2008, and this real estate private equity gained the massive momentum. This form target commercial real estate, CRE, REIT, and require high capital entry. That is real estate private equity. And then we have something called fund of fund, FOF. So what it happens? It is designed for those seeking exposure to private equity without direct investment. So it invests in mutual fund, hedge fund, and more. It is great for a small investor but with higher fee due to its layered structure. And while diversification is a plus point, but it does not always mean guaranteed return. So these are the three forms of private equity. Venture capital, right? So each type of PE serve a various different purpose, offering flexibility, which is offered by venture capital, risk variation offered by real estate private equity, and access tailored to different investor profile, fund of fund, right? So just now I told you that venture capital fuel the early stage journey, right? Sub type of private equity, real estate private equity, commercial real estate, REIT, high capital, lock-in period spans year, and fund of fund without direct investment, right? Mutual fund, hedge fund, a small investor but with higher fee. These are the key points which you must keep in mind. Now then we have legal, right? Legal and administrative structure of the private equity in India. So let's decode the regulatory backbone that shape the private equity in India. First of all, let's talk about the PE fund structure. Here we can see PE fund structure. So private equity fund in India can be structured at trust, LLP, or company, but all must be SEBI AIF registered under the 2012 regulation. SEBI Alternative Investment Fund registered under the 2012 regulation. These guidelines replace the older VCF norm. It replaced the older VCF norm of 1996. PE fund are privately pooled investment vehicle with a well-defined investment policy for both Indian and foreign investor. So again I am repeating that private equity fund in India can be structured as a trust, LLP, or company, but all must be SEBI AIF registered under the 2012 regulation. These guidelines replace the older VCF norm of 1996, right? And PE fund are privately pooled investment vehicle with a well-defined investment policy for both Indian and foreign investor. And one point you must note that mutual fund and collective investment scheme are excluded from this definition of PE fund structure. Then AIF category, very important. So that private equity in India operates operates under 3 AIF, Alternative Investment Fund category. Category 1 AIF, it is supported by the government or the regulators. Key point, remember, supported by government or regulators. It includes angel fund, SME fund, social venture capital and infrastructure fund. These are the key points. Then we have category 2. It is PE home turf. This fund uses no leverage except for operational need and cover PE fund, real estate fund and even distressed asset fund. Right. And then we have the last category 3 AIF, which is the most complex of the three, right? They use, leverage and complex strategy, investing in listed, unlisted securities and derivative. And this includes, hedge fund and PIPE fund, right? What is PIPE? Private investment in public equity. So basically these are the three categories. So these structure ensure that India's PE ecosystem remain flexible, regulated and open to innovation. Now, then we have, angel fund investment structure. Let's look at it. So friends, let's step into the world of early stage investing where innovation meets capital. What is angel fund? So here you can see the detail of the angel fund. Let me take you. So angel fund are subcategory of venture capital fund operating under category 1 AIF. I told you there are three category of AIF, category 1, category 2, category 3. So angel fund operate under category 1 AIF. They pool money from angel investor to back a startup at very early stage. So remember the key point, early stage. It is governed under chapter 3A of the CAIIB AIF regulation 2012, and these fund raise capital by issuing unit to the angel investor. Now the question is, who are these angel investors? You must know. See, they are not just wealthy individual, they are experienced professional. Individual with at least 2 crore in net tangible asset and relevant entrepreneur or managerial experience. Corporate with net worth of 10 crore and a track record of investing. Other VC or AIF entity already registered with the SEBI under VCF regulation 1996. Now, if we talk about the investment limit, minimum investment required is 25 lakh and maximum lock-in period is 3 years. Now, then we have SEBI AIF regulation. So, angel fund, operate under a standardized governance framework, just like any other private equity firm. They focus mainly on equity or equity-linked instrument or structured partnership. So, angel fund, they are the rocket fuel for tomorrow unicorn, bridging big dream with bold investment. Right. So that is the point about angel fund. So that is all you need to understand all about this particular chapter. Nothing more, because only these topics have been appeared in the examination, in the last 4 examination. So I request you to please go through them. And now you go to solving MC.
In learning. In the world of search engine, Google Rank Brain start as a game changer. Introduced on October 26, 2015. Right. 26th October 2015 it was introduced. This powerful machine learning system transformed how search results are delivered. Initially handling less than 15% of the query, it quickly proved its strength by adapting to new queries, right? Ensuring semantic similarity and providing the most relevant result, right? So you can see launch date I have told you, and accuracy almost 90% accurate. Rank Brain process integrate and smart. It uses something called word vector. Here you can see it uses word vector, linguistic similarity, entity mapping, word cluster, user intent, ranking adjustment, user satisfaction, right? At its core, Rank Brain purpose is simple. What is the purpose? The purpose is to make search result more relevant and more accurate, achieving an impressive 90% accuracy, right, rate. So accuracy rate is almost 90%. So relevancy and to make the search result more relevant and more accurate. And something called some more important point I want to tell you, that handles. So it handles unknown keywords, novel phrases, right? So handling unknown keywords and novel phrases, Rank Brain prioritize the essence of a search, focusing on strong links and content for ranking. With machine learning at its heart and relevance at its mission, right? Rank Brain continue to shape the future of smarter, faster and better search experiences. Right. So I hope every aspect I have taken care of in this particular slide. So type I told you, machine learning, when it started I told you, accuracy I told you, and process, what are the methods which are used under the Rank Brain, how much for accuracy that it has achieved. Okay, now let's look at the next point, that is AI Hub, that is called Artificial Intelligence Hub. So friends, welcome to AI Hub, a game-changing platform designed to empower developer and data scientists by providing access to top-tier machine learning expertise in a plug-and-play environment. So friends, that AI Hub primary goal is to access, reuse and exchange AI asset effortlessly By doing so, it fosters faster innovation and reduce the redundant effort of building from scratch. At its core, AI Hub value reuses and collaboration and scalability. Right here you can see core value. It reuses, right? It values reuse, collaboration, and scalability. It offers a unified environment where developer and data scientists can collaborate and scale their project efficiently. Here you can see it offered a unified platform where developer and data scientists can collaborate and scale their project efficiently. And the content available inside AI Hub is very rich and practical. Here you can see the content available is very rich and very practical, right? From ready to use pipeline, here you can see content include from ready to use pipeline and interactive Jupyter notebooks to robust TensorFlow modules. Everything needed to accelerate AI workflow is right at your fingertips. And some key benefits here, as you can see, some key benefits include seamless integration with Google Cloud AI, right? Leveraging cutting edge research from Google Research and tool trusted by internal Google team themselves. When it comes to deployment, AI Hub is highly flexible, supporting both Google Cloud Platform, that is called GCP, and hybrid infrastructure. Support both of them, making it adaptable to various enterprise movement. And AI Hub also tackles critical challenges, right? AI Hub also tackles some critical challenges. What are the challenges? As you can see here, right? It likes simplifying machine learning workflow, making machine learning expertise more accessible, and behind the scene it uses powerful tool like Qflow. You might have heard about this Qflow. It uses a very powerful tool behind the scene that is called Qflow pipeline to automate, streamline, and manage the entire machine learning lifecycle. So basically, whether you are building new AI solution or scaling existing one, AI Hub start as the trusted companion, right? This AI Hub start at the trusted companion. It stands as the trusted companion for every developer, every data scientist. It is not just a resource, it is a revolution in AI collaboration and innovation. So what I have just told you, let me just give a quick overview. So plug and play environment, I told you, learning expertise in a plug and play environment. Then I told you the primary goal is to access, reuse, and exchange. This is the goal part of what? Access, reuse, and exchange AI asset effortlessly. And I told you core value. The core value is to reuse, collaboration, and scalability. A unified environment where developer and data scientists can collaborate and scale their project efficiently. Content available is rich in practical from ready to use pipelines, interactive Jupyter notebooks, and benefits I told you Google Cloud AI, right? Google Research, internal Google team, GCP, right? Deployment I told you that Google Cloud Platform and hybrid infrastructure. Now friends, let's talk about Qflow pipeline. What is Qflow pipeline all about in this particular session? So in the world of machine learning, having a structured repeatable workflow is very crucial. That is where Qflow pipeline comes into picture, offering a powerful centralized platform to design and manage machine learning workflow with ease. At its core, Qflow pipeline is built around critical components. What are the components? Pre-processing, data transformation, and training, ensuring that every phase of the machine learning life cycle is seamlessly handled. So these are the three phases: pre-processing, data transformation, and training, right? Qflow pipeline. Now friends, its key function. What are the key functions? So its key functions are nothing short of game changing. It enable repeatable workflow, promote experimentation, and ensure a smooth production deployment, saving both time and resources, right? Repeatable workflow, experimentation, production deployment, and orchestration. So this capability allow developer to visually design and manage complex machine learning workflow through workflow graph, sequence execution, making even the most intricate task intuitive and efficient. This is called orchestration. It allows developer to visually design and manage complex and machine learning workflow, right? Workflow graph and sequence execution. Now Qflow pipeline true strength lies in reusability, modularity, and hybrid compatibility, allowing flexible integration across various cloud and on-premises infrastructure. Strategically linked with AI Hub and Cloud Auto ML, Kubeflow pipeline connects seamlessly with a broader ecosystem, enabling end-to-end AI solution at scale. In short, Kubeflow pipeline empower teams to innovate faster, automate smarter, and deploy machine learning solution more reliably than ever before. So we have just talked about the three components of Kubeflow pipeline, the key function. So such kind of PDF, such kind of things will help you revise just before the examination. You will only need to go through only thing that matters. You can't Now friends, let's switch our focus to the hybrid information system in finance. So in today's fast evolving financial landscape, innovation demand smarter, faster and more adaptive system. Enter the hybrid information system, HIS, a cutting-edge AI-driven platform designed to combine the best of multiple artificial intelligence techniques. HIS in short is called Hybrid Information System. It leverages powerful AI technique like the fuzzy expert system, Neuro fuzzy system and genetic fuzzy system. These are the AI technique. So these are the AI technique used by HIS to create solutions that are not only intelligent but also remarkably adaptive. Right. So three technique I told you: fuzzy expert system, neuro fuzzy system, genetic fuzzy system. These are the AI technique that HIS leverage to create solution, intelligent solution and remarkably adaptive solution. What is the purpose of HIS? See, purpose of HIS is simple yet profound. It blends strength of different AI model. It overcome the limitation, individual limitation. It creates systems that are more robust, reliable and versatile. This is the purpose. In the world of finance, hybrid information systems are a game changer. It is used extensively in portfolio selection and powering smart decision for financial institutions. What truly set HIS apart is its competitive edge, right? Delivering a smarter product and offering more efficient service, giving organization a real advantage in a fiercely competitive market. In short, we can say that this hybrid information system, it represents a perfect synergy, merging intelligence, flexibility, strategy into the heart of modern finance. So what are the techniques which are used? Fuzzy expert system, neuro fuzzy system, genetic fuzzy system. Purpose is to blend the strength of different AI model, overcome individual limitation, and in the world of finance, HIS are a game changer. It use extensively portfolio selection and is powering a smart decision for financial institution and competitive edge. This is all about HIS, hybrid information system. Then comes neural network, very important thing. So neural network stands at the core of today's AI revolution, offering powerful adaptive algorithm that learn and evolve without predefined model or rigid assumption. They can learn, they can evolve without predefined model or rigid assumption. So this flexibility is the key part of this neural network. This flexibility make them suitable for a wide range of use cases, from supervised learning, unsupervised learning to handling categorical variable and solving regression problem with ease. This flexibility allow them. When it comes to practicality, neural networks shine. They excel in managing large data set, enabling simple deployment and tackle highly complex model, making them a favorite for real world application. Their strengths are also unmatched. Ability to capture complex relationship, highly adaptable structure that mold itself to the data and task at hand. Then we have their strength are unmatched. I told you, with neural network we are not just solving problem, we are redefining how machine learn, adapt and perform. In the world driven by data, heard how business make a smarter decision, predict your next move or recommend just the right product. All it boils down to analytics, the silent engine behind modern success. Let's break down the 4 powerful types of analytics that are transforming industries across the globe. The first is called descriptive analytics. So let me zoom a little bit. So this is descriptive analytics. You can think of this as a rear view mirror. It helps organizations understand what happened in the past using historical data, key performance indicator and patterns. Whether it is customer behavior, marketing insight, this is where the real story begins. Then comes diagnostic analysis. On the right side you can see diagnostic analysis. Now that we know what happened, we dive deeper. Why did it happen? Diagnostic analysis get into the root cause using technique like drill down analysis, correlation, data discovery. So this is called diagnostic analysis. Then we have predictive analytics. What is predictive analytics? See, here comes the crystal ball. Predictive analytics tells us what could happen next using forecasting, a statistical model, machine learning, whether it is predicting client behavior or future sale. This is all about staying ahead, right? So this is called, predictive analytics. It tells us what could happen next using forecasting, a statistical model, and machine learning. And the fourth type we have is called prescriptive analysis. Finally, the strategist of the group. Prescriptive analysis recommend what action to take. With the help of neural networks and deep learning, it suggests the best solution and strategy to optimize outcome. From understanding the past to predicting and shaping the future, analytics is not just data, it is a direction. Which type is your organization using today? Please let us know. Now friends, these are the 4 types of analytics, very important. Questions are being asked. Now behind every powerful business decision lies a set of tools that decode the data maze and turn number into knowledge. Welcome to the core component of business analytics, your roadmap to a smarter, faster decision. So first of all, we have the first core component is called the data mining. What is data mining? It all starts with discovering. So data mining means it starts with discovering hidden pattern in massive data set. So data mining, how it helps? It helps determining the hidden pattern in the massive data set. Data mining help uncover what is really going on beneath the surface, behind the surface, revealing the insight that others miss. You and me may prefer to miss, but a perfect data miner, this data mining technique will reveal the insight. Right. Then we have text mining. Not all data comes in number. Text mining extract meaning from emails, reviews, or any other written feedback, turning human language into actionable insight. Then we have data aggregation. Then comes the magic of putting it all together. Data aggregation combines data from multiple sources. Name itself suggests it combines data from multiple sources, right? And to provide a single comprehensive view, which is the foundation for accurate analysis. Then we have forecasting. Now that we have the data, let's look ahead. Forecasting uses past trend to predict what is coming next, helping business stay one step ahead. Then we have data visualization. Finally, we tell the story through visuals, chart, graph, dashboard, transform complex data into clear, compelling narrative that drive decision. So these are the part: mining, data mining, text mining, data aggregation, forecasting, data visualization. Now friends, let's see the next part, comprehensive data mining overview. So it is all about data mining. So these 5 components are the pillar of business analytics. So 5 components, just now I told you, right? These 5 components are the pillar of the business analytics, each one playing a unique role in turning raw data into revenue driven insight, right? So basically, then we have comprehensive data mining overview. Let's have a look at this particular mind map. Now friends, data is everywhere. Data is everywhere, but the real power lies in knowing how to dig deep and find what matter. Welcome to the world of data mining, the engine behind a smarter decision and sharper strategy. At the core, data mining is all about discovery, right? It's all about discovery, uncovering pattern, trend, and hidden relationship within massive amount of data. If you look at that is the purpose of data mining. If you look at the technique from KDD to advanced analytics, these techniques are the tool that help business make sense of the chaos and find gold in the data mine. So techniques like KDD are used, advanced analytics are used, right? Now if we talk about the uses, whether it is real-time analytics or business intelligence, data mining add brain to the business, making insight smarter and action faster. That is the uses. Application from marketing to finance to cyber security, industries everywhere are tapping into data mining to power innovation and precision. Then we have data collection. It all begins with gathering the right data from the right sources, because what you dig up depends on where you dig. Then we have data preparation. Next comes the cleanup. formatting, filtering, polishing your data to ensure that it is ready for action. Then we have data mining execution, right? Then the real magic begin. Algorithm and model spring into action, extracting insight that fuel business breakthrough. Interpretation and analysis. Finally, we visualize. We translate number into stories, patterns, strategies. So we translate number into a story, pattern into a strategy, all with the goal of making informed, impactful decision. So data mining is not just a step in the process, it is the heartbeat of analytics. This data mining which we are talking about, it is the heartbeat of the analytics. Master it and don't just follow the trend, you predict them. Right, you will able to predict the trend if you understand data mining. We have seen the purpose, technique, usage, application, data collection, preparation. Friends, likewise manner, we have prepared such kind of mind map and flowchart for each and every units of entire CAIIB syllabus. If you are interested in it, you can enroll in our crash course program, which offer you such kinds of information, such kinds of data, which cover only those topic from where questions are repeatedly asked. We are not covering 100% in this crash course, rather we are focusing on only those topics from where questions are repeatedly asked, and everything is presented in this kind of flowchart mind map manner. So friends, in the description section you will get the link of the course. Now friends, let's look at the types of data mining technique. Why we are so much focused on data mining? Because questions are most frequently asked. Right now friends, what are the types of data mining technique? Data speak volumes, right, but only if you know how to listen, and that is where data mining technique comes into play. Let's explore the toolkit that transform raw data into powerful insight. The first is called association rule. So ever noticed how buying bread often lead to buying butter? That is association rule at work. These if then statement help us find pattern, relationship, and even hidden link in the data, which is crucial for everything from market-based analysis to fraud detection. Then we have classification. When we already know the category, classification comes in to sort new data using tools like decision. So there are some tools like decision tree, CAIIB base. You can see the name here. Question may be asked that what are the tools which we use for classification. So some tools are used like CAIIB base, logistic regression, right? So these are the tools which are used for classification. Then we have clustering. What is clustering? See, clustering is all about finding natural grouping in the data. Think customer segmentation. It means grouping people by behavior or preference without any predefined level. That is called clustering. Is all about finding the natural grouping in the data, right? You can think of customer segmentation, right, grouping people by behavior or preference without any predefined level. Then we have regression. If you want to predict something like future sale or price trend, regression model help forecast outcome by analyzing the relationship between variable, whether linear or complex. So by analyzing the relationship between the variable, you can forecast the outcome, and the regression model helps in that. Then we have sequence and path analysis. What is the meaning of sequence and path analysis? See, understanding the order of event is the key. This technique uncover how event unfold over time, helping business map customer journey or identify system failure before they happen. Then we have neural network or deep learning. So taking inspiration from the human brain, these advanced models recognize complex pattern in massive dataset. From image recognition to voice assistant, this is where artificial intelligence meet analytics. Then we have data mining software and tool. Now let's talk tools. Whether it is platform like Alteryx, Databricks, S2O.ai, right? You might have heard about it, right? Alteryx, Databricks, S2O.ai, or open source favorite like Weka and Orange. These tools simplify data preparation, modeling, and deployment, empowering business to mine site at scale. So top vendors may be asked core features, right? And open source tools are also there, and premium models are also there, right? Like NIME, DataKU, S2O.ai. So some free model are also there, premium models are also there. Now friends, text mining, the second part of it, very important. Text mining technique, how does it work? Ever wondered how machine can understand, summarize, or even feel the meaning behind the text? Welcome to the world of text mining, where language meets logic. So friends, first of all, on the left hand side you will see text pre-processing. Before we teach machine to read, we must first clean the clutter. So pre-processing involve a step like cleaning the messy character, identifying the language, tokenization. Tokenization means what? Breaking text into words. POS tagging, which means part of speech tagging, labeling word as noun, verb, etc. Chunking and syntax parsing, so that machine understand the grammar behind the message. Then we have the information retrieval. So basically, now that text is clean, let's dig out what matter. Then there comes tokenization. Tokenization is split text into token, right? It is split text into token for what? For models, while stemming strip down word to their root, improving searching and indexing. So this is called information retrieving. Then we have something called NLP, natural language processing. So here is where the real magic happen. Summarization condenses long paragraph into key takeaway, and POS tagging add context to each word. So summarization condenses, as a name itself suggests summarization. It condenses long paragraph into key takeaway. POS tagging add context to each word. Categorization classify document by topic. And what about the sentiment analysis? Sentiment analysis, it tells us if the text is praising a product or roasting it. That is called sentiment analysis. Summarization, POS tagging, categorization, classify the document by the topic, and sentiment analysis tells us if the text is praising a product or roasting a product. Then we have information extraction. So once we know the tone, it's time to extract the value. Feature selection picks only the most important part for the analysis. That is called feature extraction. Then we have feature selection. Feature selection pick key feature for predictive model. It picks the most important part for analysis. Then feature extraction simplify the data for a smarter model. NER, what is NER? Named entity recognition. It helps detect name, places and more, bringing a structure to unstructured text. From tweets and review to research paper and chat logs, text mining transformed world into wisdom. It is not just reading, it's understanding at a scale. Now friends, let's switch our focus to the big data analytics. Very, very important topics. So every second our world generates mind-blogging amount of data. But how do we make sense of it all? That is where big data analytics steps in, turning chaos into clarity. At its core, big data analytics is all about. So I think at its core, big data is all about advanced analysis on massive, complex and diverse data set. Now, data type, it deals with every kind of data, structured like databases, semi-structured like XML file, and unstructured like email, videos, social media post, etc. Sources, so where all this data come from? Just about from everywhere. IoT device, then mobile apps, social media platform, sensor, system log, even audio or video feed. Key characteristics, big data is often defined by 3 V's: volume, which means from terabyte to zettabyte; velocity, which means data generated in real time; and variety, which means mix of format and sources. So volume, velocity and variety. Technique which is used to harness the data, right? We use powerful tools. What are the powerful tool used? So some tools name is given here, like text and predictive analysis, data mining, statistics, natural language processing, so that even human language become data. Then we have practical uses. So you can see big data is not just about number, it drives real impact, smarter customer integration, detecting and minimizing fraud, and optimizing entire supply chain. Then we have industry benefiting, from healthcare to finance, retail to telecom. Every industry is riding the big data wave to stay ahead. In the data driven world, big data analytics is not just an advantage, it is a necessity. It is a lens that helps business see the future before it happens. That is the importance of big data. Some more slide to tell you about the importance of big data. Questions are asked based on this. So in the world flooded with data, the real game changer is how do we use it. Big data analytics is not about handling massive data set, it's about driving real business value. First of all, it helps in cost reduction. So let's start with the bottom line, cost saving. Thanks to the cloud analytics and data lake, business are dramatically cutting down on storage and operational expense. Second, we have innovation. So big data help business listen better. By understanding what customer truly need, company can innovate faster, offering product and services that feel tailor made. Then we have faster decision. Speed is power. In memory analytics paired with IoT allow organization to make real time decision, turning data into action in the blink of an eye. And if you look at the impact, so big data does not just support decision, it amplify impact. From streamlining operation to boosting profit, it is a foundation of a smarter business strategy. So big data analytics is more than just a tool, right? It is the strategic edge, reducing cost, sparkling innovation, enabling decision that truly makes a difference. Now friends, let's look at the mobile web analytics components and futures. Very important topic. So in mobile first world, understanding how user interact on their smartphone is no longer optional, it is essential. Welcome to the power of mobile web analytics. Mobile web analytics tracks, first of all what it does, it tracks everything that matters: page view, visit duration, user location, device specific detail, whether it is phone screen resolution or its model or manufacturer, everything, right? What is the purpose of it, right? So you can see now, track everything: page view, visit, device information, model, manufacturer, screen resolution. What is the purpose? The goal, if we talk about the goal of it, so the goal is to optimize user experience on mobile and supercharge your marketing effectiveness. Think of it as your digital radar, scanning user behavior to fine tune every touch point. Now what are the features that matter? Mobile analytics goes deeper than traditional web analytics. They capture nuanced device information using the user agent header and database like WRFL. So WRFL is a kind of database. So that is why we say now mobile analytics go deeper than traditional web analytics, because they capture nuanced device information using user agent header and database like WRFL, helping you understand not just who you are visiting but how. Why it is different? Unlike standard web analytics, mobile tools are tailored for the ever evolving world of smartphone and tablets, where user experience must adapt to the different device in the real time. What are the supported platform? So HTML, WordPress, PHP, Java, Python, Ruby on Rails, Node.js and Typod. So mobile web analytics integrates seamlessly with all the platform you build on. So these are the platforms: mobile analytics, futures, mobile web analytics. Friend, if you really think that this video is adding value to your information, please hit that like button. This will motivate me to make more such and such content. So with mobile web analytics, you are not just counting clicks, you are crafting experiences. Dive into the data, understand your user, and let insight lead your mobile strategy. Then we have challenges. Yes, we have seen with different business analytics technique, but obviously there are some challenges also. So friends, implementing business analytics sound promising, but the road to insight is often paved with challenges. Let's explore what truly stand in the way of success. First and foremost, analytics need a strong foundation, top leadership buy-in. Without alignment with the business strategy, even the smartest tool can fall flat. Then we have approval issues. Project can stall at the gate without clear goal and senior management approval. Analytics thrive where direction is strong and measurable. IT engagement. Yes, a successful journey demands teamwork. Collaboration between business and IT team, backed by the right infrastructure, is non-negotiable. Commitment. The initial phase often demands patience, investment, and perseverance. ROI, that is called return on investment, may not come overnight, but dedication ensures long-term gain. Then we have end user involvement. Analytics should empower, not alienate. End user need to feel involved, especially when predictive model influence financial decision or require behavior change. Data integration. Today's data come in all shape and format. Bringing it together without losing meaning or value is both an art and a science. Skill shortage. Behind every powerful dashboard is a skilled professional. Unfortunately, finding the right talent, especially for a small and medium enterprise, remains a major hurdle. Storage limitation. Yes, big data need big space. A small organization often struggle to store and maintain manage massive volume efficiently. So if you go through the book, it is covered in 2 pages. I have just refined all the key information in just 1 page so that you can easily go through it. So basically the bottom line is that overcoming this challenge requires more than just tool. It takes a strategy, collaboration, and a commitment to make data driven decision part of your culture. Now friends, let's look at this slide. Business analytics skill prioritization. So business analytics is not just about crunching number. It's about applying the right skill to extract insight that drives success. But how do we prioritize this skill? Let's break it down. The first is the attention to the detail. As you can see it here, attention to the detail. It is undoubtedly complex, obviously, requiring meticulousness in every step. Whether it is an essential skill for accuracy, it has limited impact on broader strategic decision, but it is a foundation on which all other skills are built. Then we have the critical thinking, second part. So critical thinking take the center stage. This skill is crucial for high impact decision. It's about analyzing data, questioning assumption, and making decisions that shape the future. If you are tackling complex challenges, this is the skill you want to prioritize. Then we have step number 3. It's called communication. So communication is straightforward. You need to articulate finding and insight clearly. While it is essential, its impact may be minimal on decision making compared to the other skill. Yet without communication, even the best insight remain hidden. Then we have the final, that is called problem solving. So this is a skill that blend impact and simplicity. It's about applying data insight to resolve issue, and although it may seem straightforward, its impact on improving operation is undeniably high. So in business analytics, mastering the right combination of skill is key. Critical thinking, problem solving leads the charge, while attention to detail and communication round out the equation. And flow chart. So when it comes to valuing an asset, selecting the right approach is very crucial. But which one should you use? Let's break it down. On one side we have the market approach, as you can see it here. So look at the market approach, look at the recent transaction and recent asset prices. This method compares similar asset considering their size, quality and quantity and some key characteristics, right? So it compare recent transaction, asset price, considering size, quantity, quality and some key characteristics. That is called market approach. Second approach we have is called the cost approach. So cost approach focus on the fair market value of the asset minus liability, right? So fair market value of asset minus liability is what cost approach looks at. It is ideal for asset intensive business. So those business which are huge asset intensive, right, holding corporation or when dealing with troubled entity, then cost approach is most useful because it focus on the fair market value, does not focus on the recent asset price or recent transaction, right? And in the market approach, I told you the comparison method work best, where we compare similar asset considering their size. And the third approach we have is called the income approach. So income approach is thinks about the future. This approach values asset based on the future earning or future cash flow. It's all about calculating NOI, net operating income, and dividing it by the capitalization rate. So you must remember the formula which formula we use while using the income approach. So net operating income, NOI, divided by capitalization rate. So it values asset based on future earning or future cash flow. So the three method which we have just learned now, each method has its unique role depending on the type of asset. Like suppose the type of asset is asset intensive business, so we will go for cost approach, and suppose we are futuristic looking, then we will go for income approach, right? So each method has a unique role depending on the type of asset and business situation. So that is the point. So one should choose wisely to unlock the true value. Which one to choose? I hope I have given you sufficient insight. Now friends, let's have a look. So when it comes to valuation, choosing the correct method is not just important, it is crucial. So what are some valuation method selection criteria? So before we choose, we consider the basis of value. right? The pros and cons of each and every methods, that is called advantage and disadvantage, their appropriateness for the situation, how much they are appropriate for the situation, and the reliability of the information available, means whether the information available is trustworthy enough, is it reliable enough. So that is the valuation method selection criteria. Then we have the cost approach, right? What is the cost approach? Let's see the point. So I told you early, in the cost approach, it is based on the cost to rebuild or replace the asset. It is already I told you it is for asset intensive businesses, right? So suppose I want to rebuild the asset or replace the asset, how much it would cost me, right? Suppose I have a huge building, right? I want to rebuild it, I want to replace it, right? So how much would it cost me? That is called the cost approach. This is how the valuation is done. It is perfect for valuing the tangible asset, right, where rebuilding is a realistic option. So cost approach is there, it is helpful. Then we have primary methods. There are some primary methods of valuation also. Let me give you a name. I will discuss in detail about this. So the first is called adjusted book value approach, stock and debt approach. We will cover all these things. Direct comparison approach and discounted cash flow approach. These are the 4 primary method used. And methodology, sometimes a single method is enough, other time multiple methods are needed to ensure accuracy, especially when data is limited or insufficient. Remember, value reconciliation is all about thoughtful comparison, not simple averaging, right? So that is called value reconciliation. It's all about thoughtful comparison, not simple averaging. So basically this is the a complete overview of the valuation method. So choosing the right valuation approach is not just a step, it is a strategy toward better business decision. Now friends, have a look at this particular flow chart. Very important. It talks about the asset valuation methodology. So friends, asset valuation is a crucial step in understanding the true worth of a business. Let's walk through how different types of assets are evaluated. If you go through the book, you will see multiple lines, paragraph, right? You have to identify yourself what is important, what is not important, and what we do in our crash course, that we filter out the important content for you in the most efficient format, easy to understand, easy to remember. At the last moment before the examination, if you go through such PDF, you will be able to easily recall in the examination all the fact, because mind map work in the same way. Once you hit your mind, you will never forget it. So we have prepared such kind of material for each and every subject. If you are really interested in it, you can enroll in our crash course program. In crash course program, we ensure we provide you such kind of content, right? We are not covering 100% syllabus, rather we are just covering only those part from where questions are being repeatedly asked. Now first of all, let's look at the cash. So cash, the valuation is since there is no change in value, right? Reason is that cash is already at face value, there is nothing to adjust or estimate. Then receivables. So receivable valuation start with the face value, which means the amounts owed, and then adjust for the default risk, meaning you lower the value if there is a chance that some customer may not pay, right? So receivable means what? That suppose you are providing goods or services, some customer takes goods from you and they said that they will pay you later, right? That is called receivable. So first of all, valuation, you start with the face value, means the amount that is owed or the amount the customer has owed to you, right? And if suppose some default happens, somebody don't pay, then you have to reduce that amount. You have to adjust for the default risk. That means you lower the value, right? You should lower the value. Then we have the stocks, which is very important. Stock means inventory. Stock here means inventory. So a stock is valued differently based on their production stage. There are different production stages of stock or inventory. The first is called raw material. So it is done at the last acquisition cost, means what it costs to purchase them. That is how the valuation, asset valuation of the stock in the raw material is done. Then we have WIP, or work in progress. So it is evaluated either cost or selling price depending on the reliability of information. And then we have finished good. It is evaluated at selling price minus cost to complete and sell them, right? So three kinds of things we have just discussed: raw material valuation done at the last acquisition cost, work in progress cost or selling price, finished goods selling price minus cost price. Other current asset, so it is recorded at the book value, means the value listed in the accounting book. Tangible fixed asset, if it is land, so it is valued at the market value, the price it would fetch if sold today. If it is building, it is valued on the replacement cost minus depreciation, means the cost to replace the building today less any loss in value over the time. If it is machinery, then we have to add the market price plus cost associated with making it usable or sellable, right? So these are the tangible fixed asset. What about intangible fixed asset, like patent, trademark, goodwill? So they require unique valuation method, like book value, market value, utility to the business, or remaining useful life. There is a separate chapter for valuation of the intangible fixed asset. And finally we have non-operating asset, means those assets which are not used in daily operation, like suppose surplus land is there or unused building is there, so they are valued at the market value, means what they could sell for currently, right? Like securities, surplus land, disused structure, etc. So basically each type of asset has a tailored method for valuation depending on its nature, whether it is liquid cash, evolving inventory, valuable property, or even intangible intellectual property. Correctly valuing asset ensure accurate financial reporting, better investment decision, and fair business evaluation. Now friends, have a look at the first approach. I told you na, stock and debt approach, very important. Every aspect which we are going to clear here. So when valuing a company, one trusted method is the stock and debt approach. If you look at the definition, so it is simple, just add the market value of equity and the market value of the debt, that is your total company value. That's so simple. Market value of equity plus market value of debt, that's it. Now assumptions, what are the assumptions that it made? Very important assumptions. See, this method work on EMH. What is EMH? Efficient market hypothesis, which says that market price already reflect a company true worth. That is called efficient market hypothesis, that it says that market price already reflect a company true worth. For example, let's take a Seashore Limited. As on 31st March 2022, the data is given that equity is 15 lakh share and price per equity is 50 rupees. So it amounts to 7.5 crore. Similarly, debt market value is 14.8 crore. So the total firm value will be 22.3 crore. That is what it says, which says that market price already reflect a company true worth. So this is the market price. It reflects the company true worth. Right, that is the example. Now there is some controversy regarding it. What is the controversy? But there is a catch. Should we use current market price or an average price? Right. So EMH suggests current market price is the best. What is EMH? EMH, I told you the formula of EMH, efficient market hypothesis. So EMH says that use current price, right? But because averaging can reduce valuation accuracy, because if you multiple average, then it will reduce the accuracy, right? Valuation accuracy. So what is the key implication, key takeaway? That that if the market is efficient, the stock and debt approach is reliable. Always use lean data prices, not average price, for the most accurate result. So the stock and debt approach shows us the power of market signal, but it needs a keen understanding of the market efficiency to get it right, because everything depends on the market. What is the market value of equity? What is the market value of debt? Then only you will add them now, right? So this was all about the what we have just discussed is the market, is the stock and debt approach. The second approach we have is called DCM, direct comparison approach. So when it comes to determining the true value, direct comparison is one of the most straightforward method, right? What is the principle? It works on the principle of substitution. Simple idea, substitution, that no buyer will pay more than what it costs to buy a similar competitive property, right? So no buyer pay more than cost of a similar competitive property. Very important. This is the principle. Now if you look at the steps involved, first determine the highest and best use of the asset, that is called HBU. HBU means highest and best use of the asset. Next, identify the comparable sale, means similar transaction. You find the similar transaction and then you adjust the sale value based on the difference. So 3-step process I told you. HBU means highest and best use of the asset. Then identify the comparable sale, means find similar transaction, and finally adjust the sale value based on the difference, right? So these are the 3 steps: HBU, comparable sale, adjust the sale value. Now if you look at the methods, So here we have the methods. The focus is to find similar business or asset and use current market price for accurate reflection. So that is the focus. The focus is to find similar business or asset and use current market price for an accurate reflection. If you look at the comparables, so the trick is that minimal adjustment, right? The closer the comparable, the better the valuation and higher the accuracy, right? The closer the comparable, the better the valuation, the higher the accuracy. And if you talk about the adjustment, so what is the adjustment? First, perform a time adjustment, means aligning old sale to the current value. Then apply any other necessary adjustment, but always adjust on a per unit basis, right? So in this valuation, the direct comparison approach reminds us that real world comparison, when done carefully, it creates the clearest path to the true value. That is why I told you HBU is done. HBU means highest and best use. We identify comparable sale, find similar transaction, and finally adjust sales value. Adjustment is done, sometimes time adjustment is done, right? So means aligning old sale to the current value and apply any other necessary adjustment. So these are the steps, complete steps regarding the direct comparison approach. And in our theory video, I have provided a numerical problem also based on a step-by-step explanation of how to go about solving a problem based on direct comparison approach. It is not feasible to describe the entire process here, because the entire calculation will itself take 20 to 30 minutes. So I request you to please go through the theory videos. Now friends, let's look at the financial performance overview, some very important metrics which are very important role. So let's break down the terms one by one. First of all, the invested capital. Imagine a business need money to buy machine, building or other resources. Invested capital is the total money that come from shareholder, that means owner, and the lender, which means bank or investor, to buy all kinds of asset, whether they are using daily or just sitting there, right? So that is the point. The invested capital means whatever fund that has been accumulated from the shareholder or the lender like bank to buy all kind of asset. This is called the invested capital. Then we have operating invested capital. This focus only on the part of the business that are used day to day, daily run operation. Means it focus on the part of the business that are used daily. It includes machine, factory, working cash, basically everything that help the company make and sell product. That is called operating invested capital. So the formula is quite simple, that operating asset plus operating working capital. Now what is this operating working capital? This is short-term money movement. That is why working capital. It is the money tied up in everyday operation, like buying inventory, stock, or waiting for customer to pay, receivable, or paying supplier, that is called liability, right? So the formula is operating asset, which means cash in. You can see the formula, operating working capital asset, which means cash in products, means bill minus bill we owe, that is cash out. So cash in minus cash out, that is very, very simple formula. So non-interest bearing current liability means these are the bill which we owe, that is called cash out, which we have to pay. And operating asset means cash in, means some product. I told you means some money is tied up in everyday operation, that is cash in, right? And cash out, this tells us how much money the business need daily to run smoothly, right? To run smoothly, how much money the business need, that is called operating working capital. Formula is quite simple, operating working asset, right? And minus the bill, non-current interest bearing current liability. Then we have NOPLAT, net operating profit less adjusted tax. Fancy name but simple idea. It is the actual profit the company made from running in business after paying the normal tax. So after doing business and paying tax, how much real money is left? That is called NOPLAT, right? So after doing business, after paying tax, how much real money is left? So that is called NOPLAT. The formula is quite simple, EBIT, earning before interest and tax, minus tax on EBIT, that is called NOPLAT, net operating profit less adjusted tax. What is EBIT? EBIT, earning before interest and tax. So this is the interest, this is the income the business made before paying off loan, that is the interest, before paying out government tax. So it has not paid interest, it has not paid government tax. The total income it has made, the company has made, is called EBIT. It shows how much the core business earned before any extra cost comes into pay. For example, if a bakery make $10,000 before paying tax and bank loan, that is their EBIT. And what is the tax on EBIT? These are theoretical tax a business would pay if they had no loan, no extra cash lying around, no weird gain or loss. It gives a pure view of tax impact on operating profit. So in short, if we summarize these 5 kinds of parameter which we have just gone through, let me summarize it. Invested capital, get the machine running. Operating invested capital, right, it powers daily work. Of working capital keeps cash flowing. EBIT, so earning before outside cost. NOPLT, so real business profit after tax. And tax on EBIT is what the taxman theoretically takes. Now one more important parameter is ROIC, right? So what is ROIC? So at the heart, ROIC stands for return on invested capital. The formula is NOPLT upon operating invested capital. NOPLT I told you, that is EBIT minus tax on EBIT, and operating invested capital already I told you here, right? This is the formula regarding it, that is operating invested capital here, operating asset plus operating working capital, right? So just write in the denominator, you will get ROIC. So it measures how much profit a company generate for every dollar invested in its operation, right? So that is why in the denominator we have operating investment, means every dollar we have invested in the operation, how much profit the company generate, that is called ROIC. Now while calculating ROIC, consistency is the key. Use either the beginning or the ending or the average value for your investment, but whatever you choose, stay consistent between the numerator and the denominator. Then only your result will be consistent, accurate and reliable. Now then we have the net investment. It is the amount a company actually spend on new asset after accounting for wear and tear. So how much amount the company invest on new asset is called the net investment. It is equal to gross investment minus depreciation. Just like net salary is equal to gross salary minus deduction. Similarly, what is gross investment? It is the total money spent on both current and long term asset, everything from buying machine to upgrading technology. And what is depreciation? Over the time asset lose value. Depreciation is the non-cash accounting method that reduce the book value of asset every year, reflecting this gradual loss. So there is alternate formula, that net fixed asset plus net current asset at the end of year minus net fixed asset plus net current asset at the start of the year. This gives a full year picture of how much net investment was made. We are discussing other non-discounted cash flow valuation model. The first of its kind we have is called relative valuation model. So let's dive into relative valuation model. See, when direct valuation is difficult, relative valuation become our go-to tool. It works by comparing the company with similar company in the market. If you look at the application of the relative valuation method, as you can see, so we use market comparable to determine pricing, especially when direct valuation method are not practical. So then we use market comparable to determine the pricing. If we talk about how it is related to DCF, see, DCF is discounted cash flow. Relative valuation complements DCF. This is very important thing. This relative valuation model complement DCF, right? While DCF focus on absolute cash flow, relative valuation focus on market driven metrics, right? So in the case of DCF, it focus on absolute cash flow. Cash flow plays a super important role, while in this case relative valuation, it depends on market driven metrics, right? So this is called relation to DCF. Then we have DCF valuation. See, here we focus on fundamentals like cash flow, growth, risk to find an absolute value, and relative valuation brings in market realism. So what we focus in DCF valuation? Cash flow, growth, risk, right, to find absolute value. Now there is something called human behavior factor. So as Dan Ariely say, human judge value relatively, not absolutely. Right, this is very important thing. Dan Ariely says that human judge value relatively, not absolutely. What does it mean? That we tend to compare prices rather than evaluate them independently. Interesting, right? What we do, we tend to compare price rather than evaluating them independently. So what is the core idea? The core idea is that if two assets are similar, they should have similar price. simple common sense mixed with economic logic. One example is given for easy understanding. Imagine 2 acre of land sold at rupees 10 lakh total, right? So obviously what is the price per acre? It is nothing but 5 lakh rupees per acre, isn't it? Because 2 acre is sold at 10 lakh, so per acre cost is 5 lakh. So what will be the cost of 5 acre? It will be simple, 5 into 5 lakh is equal to 25 lakh. So this is how this relative valuation model works. So just let me go through remind you the important points. Application, use market comparable for pricing, relation to DCF, because I told you it complement DCF, and it cash flow DCF valuation. I told you that here we focus on fundamentals. In the case of DCF valuation, we focus on fundamentals like cash flow, growth, risk to find absolute value. But relative valuation bring in market realism, right? And human behavior factor is also always there. Dan Early say human judge value relatively, not absolutely, right? Like we tend to compare price rather than evaluate them independently. So core idea I told you, if two assets are similar, right? If two assets are similar, they should have similar price. Simple common sense, right? Now, so that is all about relative valuation model. Now there are very important multiple which we will explore one by one now. The first multiple is PYE multiple. So in this particular slide, every aspect related to PYE has been taken care of. So let's get started. So first of all, let's explore the PYE multiple. So the PYE concept was introduced by Graham and Dodd in 1934, right? Laying the foundation for value investing. So definition is quite simple. You look at the definition. Definition is simple. It says that PYE is equal to, in the numerator we write the price, in the denominator we write the earning. So price of what? Market price per share. And earning of what? Earning per share. So per share on both numerator as well as denominator. So market price per share divided by earning per share. This is called PYE, right? Again I am repeating. PYE means P means market price per share. In E means to earning per share. So EPS is based on past earning, last 12 month earning, right? And EPS or expected future EPS, which means current or next year, right? So it is based on either the past earning, last 12 month EPS, or expected future EPS. So this is the basis of calculating the EPS. Either you take the past earning, or you take the last 12 month EPS, or you take the expected future EPS. And the most common terminology is P node by E1. This is called P node, P0 or P node, whatever you call it, upon E1, which means current price divided by expected earning next year. So what is the meaning of P node by E1? P node is the current price and E1 is the expected EPS or expected earning next year. This is the most commonly used, right? Now fundamental determinant, very important. So this is the bit of math. Just remember this formula, because question are asked to calculate P node by E1. Formula is 1 minus B divided by R minus ROE times B. So what is 1 minus B? See, 1 minus B is called dividend payout ratio. 1 minus B is called dividend payout ratio. And what is B? B is called retention ratio, right? So B is called retention ratio or plowback ratio, and R is called cost of equity, and ROE is called return on equity. It's like climbing the ladder to success, and the formula clearly show how to value a company stock, right? Obviously, basically by applying the formula, we are valuing the company stock, right? So remember the formula, 1 minus B upon small r minus ROE multiplied by B. So B on both numerator and denominator, right? In the numerator just 1 minus B, in the denominator R minus ROE times B, and every aspect should be taken care of. Now let's make it easier with an example. One example is given, like let's say VNS company has PYE of 30 or P node by E1 of 30, right? ROE is 20%, cost of equity or small r is 15%. So dividend payout they have given 0.7. So obviously retention ratio will be 0.3 dividend payout they have given. So retention ratio, retention B, small b will be 0.7, right? So if you find P naught upon E1, so just apply the formula. So in the numerator just write the dividend payout ratio, right, which is 0.3. In the denominator just write small r, which is, you know, what is small r? 0.15, and multiply by minus ROE times B. ROE is how much? ROE is return on equity. Return on equity is 0.20 multiplied by 0.7. So after the calculation, right, so you will get 30. P naught upon E1 30. So just you have to remember the formula, 1 minus B upon a small r minus ROE times B, you will get the answer. So I hope this particular table explain every aspect of P by E ratio. What is origin, what is definition, what is fundamental determinant, and how. Now let's switch our attention to the next model that we have, is called P by B model. So the formula is P means price and B means book value. So market price per share upon book value per share. Formula is quite simple, right? And let's first look at the definition. So this is one of the classic valuation tool. So P by B is simply market price per share divided by the book value per share. Here book value means the shareholder fund, meaning the company actual net worth shown on the balance sheet. That is called the book value, means shareholder fund, right? Means what is actually shown on the balance sheet. So here you can see the formula, right, in this particular slide. So book value shareholder fund minus preference capital divided by equity share, right? So P by E income statement, P by B balance sheet. Now fundamental determinant. So you know P by B is influenced by some key financial metric. What are the key financial metric which influence? Like ROE, return on equity, retention ratio, cost of equity, growth rate, and the formula is ROE multiplied by 1 minus B divided by R minus G, right? So this is how you calculate the P naught by B naught, which is the fundamental determinant. So ROE multiplied by 1 minus B upon R minus G. B is the retention ratio, or 1 minus B is the dividend payout ratio, and ROE is the return on equity, R is the cost of equity, G is the growth rate. So one example is given. Suppose ROE is 25%, cost of equity is 18%, dividend payout is 0.5, right? So what will be P by B? Just apply the formula. ROE is 25% multiplied by 1 minus B, or just write multiply by 0.5 divided by R minus G, 0.18 minus 0.15. So this will give you approximately 4.17, showing that premium investor are willing to pay over the book value, right? So this is called, you know, P naught by B naught value. Now what is the reason of using this P by B? So because, you know, it is a stable even when earning are negative. You can see even when earning are negative, book value will be stable. It remain consistent when earning are volatile, right? So when EPS is volatile, the book value remain consistent. Also P by B has a strong correlation with long-term return. So this is another reason for using this P by B multiple. So 3 reasons I told you. First reason is, you know, it is stable even when earning are negative. It remains consistent when earning are volatile. Plus P by B has a strong correlation with long-term return. What are some limitations to watch out for in this particular case? Yes, so of course there are some limitations also. First of all, it ignores the intangible asset. Yes, there are some intangible assets also, like brand, human capital, so it does not take into account. Also inflation, technology change, widen book versus market value gap. So that is all about P by B multiple. Now we have P by S multiple. So that is called price to sale. So here you can see the P by S multiple, right? What is the definition of P by S multiple? P means market price per share and divided by the sales per share, right? Or simply market cap divided by the annual sale, right? It tells us how much the market is willing to pay for every rupees of the sale the company generate. How much market is willing to pay for every rupees of sale that the company generate. That is called, you know, P by S. Now why use P by S over P by E? Why do we use it? Sometimes earning can be volatile, sometimes negative or manipulated, right? Sales on the other hand are usually more stable and transparent, making the P by S ratio more reliable indicator. Because earning can be volatile, it can be negative, it can be manipulated, but sales cannot be, right? So sales are usually more stable and transparent. So that is why this is the most reliable indicator. And one more thing is that low PYS, it means better. Low PYS, it means better. Why? Because a better opportunity. A PYS of ratio of less than 1 often signal potential undervaluation, right? It signals the undervaluation, right? For example, a company with PYS of 0.5, right, could be a hidden gem, but always compare it with industry average and the company on history, right? So compare PYS with industry average and plus company on history, because PYS less than 1, it means undervaluation. A company with PYS of 0.5 could be a hidden gem, but always compare it with the industry average and the company on history. If you look at the basic PYS determinant, the formula is simple: NPM, net profit margin, multiplied by 1 plus G. G is the growth rate, multiplied by 1 minus B, right? B, 1 minus B is the dividend payout ratio, or B is the retention ratio, and divided by R minus G. So so basically this is the simple thing, right? 1 minus B divided by R minus G, the same thing we have done in the previous case also, P by B also, but here NPM and 1 plus G, two things extra, right? So NPM means net profit margin, G is the growth rate, B is the retention ratio, right, and small r is the required return on equity. So this is called basic PYS determinant. Now what are the advantages of using PYS? Very, very important. It is less prone to manipulation compared to EPS or book value. First point, less prone to manipulation than EPS or book value. Then sales number remain positive and stable. Sales usually positive. Sales remain stable even when earning fluctuate. And last point, sales are less impacted by the debt level compared to the earning. I told you this is the most reliable ratio, PYS. It is less prone to manipulation. Sales usually positive even if EPS book value negative, and sales is more stable versus EPS. So the leverage is having the less impact. So debt level is having less impact on sale as compared to the earning. So the PYS multiple is a simple yet powerful tool for identifying a stable, valuable company, especially when earning are not telling the full story. Sometimes earning does not tell you the full story. And after PYS multiple ratio, the next multiple is we have PEG and modified multiple, right? So using PEG and modified multiple, it let you see beyond just surface number, helping you spot the true value and avoid hidden risk. So first of all, let's understand PEG. So start with the equity multiple. Here you will see three kinds of multiples are there. I think this thing we have already seen. Equity multiple we have already seen. 3 equity multiple. Just revise it. Price by earning. Formula is 1 minus B upon R minus G. Right. Price by book value. Price to book value. So 1 minus B R minus G already there. Just multiplied by ROE, and which is return on equity. And the third is price by price to sales. So here we have NPM. Right. So NPM multiplied by 1 plus G multiplied by 1 minus. So one thing is common, 1 minus B upon R minus G is common in all these three equity multiples. But you know what happened? The real world investing demand more precision, and that is where modification comes into picture. So that is called modified multiples. So we adjust traditional multiple to factor in growth, margin and return. So I think you know what is the meaning of B. B means retention ratio, R is the small r is the required return, G is the growth rate, NPM is the net profit margin. Right. Now friends, PEG. PEG means what? PEG ratio. So PEG means P by E divided by expected EPS growth. So this is the formula written in front of you. P by E in the numerator and expected EPS growth in the denominator. So two things can be possible, either PEG less than 1 or PEG greater than 1. If PEG less than 1, it means stock is undervalued, so it means a potential bargain case. And if PEG is greater than 1, it means stock may be overvalued, it means here caution is required. So that is called PEG ratio. So P upon earning, expected growth, that is called a PEG ratio. And other smart ratios are also there, like value ratio, which is PYV divided by ROE, or PSM ratio, which is PYS divided by NPM. So very easy to understand, modified multiple how it come, right? So PYV upon ROE, PYS upon NPM, PYE upon expected EPS growth rate. I hope it makes sense to you. So that is all about PYG PEG multiple. So less than 1 undervaluation, more than 1 overvaluation, right? So here caution is required. Now friends, let's look at some other multiple, like EV to EVI TDA multiple, right? EV to EVI TDA multiple. Let's talk about it. What is this EV to EVI TDA multiple? So first of all, the question is what is enterprise value, right? So what is the meaning of enterprise value? Enterprise value is the sum of equity value plus interest bearing debt, right, minus cash. Cash is subtracted. So this is called enterprise value. Equity value plus interest bearing debt minus cash. Why we subtract the cash? We subtract the cash to prevent overstating a company true value from the non-core interest income, right? So that's why we subtract cash to prevent overstating a company true value from the non-core interest income, because cash is a kind of non-core interest income. If we understand the basic determinant, so EV upon EVI TDA depends on some fundamental principle, like ROIC, small g, DA, T, and WACC, which is called weighted average cost of capital. These are the basic determinant. ROIC, return on invested capital, small g, growth rate, DA means what is the meaning of DA? DA means depreciation and amortization. Small t is the tax rate, and WACC is the weighted average cost of capital. So this is how we understand the basic determinant using the enterprise value calculation. Now one more thing. So I hope this formula you must remember. What is ROIC, what is small g, what is DA, right? Now a lower multiple might hint the company is undervalued, but always check this factor first. Now if we compare EVI TDA versus FCFF, so FCFF is free cash flow to the firm. So EVI TDA is close to FCFF, but EVI TDA is more stable and easier to compare across company, especially mature one. So suppose some mature companies are there, right? So in that case EVI TDA is more stable and fixed income, so it is more stable, it is easier to compare across. So that is the relationship between EVI TDA and FCFF, right? Close to FCFF, EVI TDA is more stable and easier to compare across different company. So one simple formula you must remember: EVI TDA is equal to EBIT, earning before interest and tax, plus depreciation plus amortization. So this formula will also help you, right? And what about the EVI TDA popularity? Very much popularity. It is more stable than FCFF. It is ideal for matching firm with existing asset. And EVI TDA is just like pre-tax cash flow, more volatile, affected by the capex and NWC change. Now let's look at the next point. That is what we have: EV upon EBIT. So the formula for EV upon EBIT, in the numerator we write the enterprise value, and in the denominator we divide by the EBIT. Enterprise value, how to calculate, I already told you in the previous slide. Let me again take back to you there, right? So here we find the equity value plus interest bearing debt minus cash, that is called enterprise value, right? And same enterprise value is to be put in the numerator, and EBIT is to be put in the denominator, right? And if we do the same calculation after adjusting for tax, which is equal to EV upon EBIT divided by 1 minus tax. So after adjusting for tax, just multiplied by 1 minus tax in the left hand side, which will be equal to EV enterprise value divided by NOPAT, that is called net operating profit after tax, right? So this is the change in the formula. Now what are the key driver behind the scene? So EV upon EBIT multiple is influenced by what are the factors? The first factor is the tax rate. So just 1 minus tax rate. So these are the basic determinant, as you can see. So first is the tax rate is denoted by small t, WACC weighted average cost of capital, G means growth rate, and R reinvestment rate means how much of the earning are put back into the business. And the formula is 1 minus t multiplied by 1 minus reinvestment rate divided by WACC minus G. So this is the funda for computing EV upon EBIT, right? So again I am repeating, 1 minus reinvestment rate Now, what about EV upon FCFF multiple? What is FCFF? Free cash flow to the firm. So the formula is quite simple. So what you do, which is 1 divided by WACC minus G. So in the denominator, just write WACC minus G and take it reciprocal. This will give you EV upon FCFF, enterprise value upon free cash flow to the firm, right? So WACC, weighted average cost of capital, and G, that is called growth rate, right? Now okay, now we have something called reinvestment rate. It was portion of the earning reinvested back into the company, that's called reinvestment rate. Now the next kind of enterprise value we have is called EV upon BV multiple. So enterprise value multiple, like EV upon BV, EV upon sales, give investor a powerful lens to evaluate company beyond just profit, focusing instead of how real value creation. Now first of all, let's talk about EV upon BV. So enterprise value divided by book value of the asset. This help you see how much investor are willing to pay compared to the book value of the company asset, right? That is called EV upon BV multiple. Again I am repeating it. This help you understand how much the investor are willing to pay compared to books of debt. Now the question is, what are the basic determinant of this EV upon BV? What drive this EV upon EV? So ROIC minus share. So enterprise value, EV upon BV, enterprise value divided by the book value of the asset, that is called EV upon BV. And this help you see how much investor are willing to pay compared to the book value of the company asset. What are the factors which affect this book value EV upon BV? So it is nothing but ROIC, that is called return on invested capital, small g, which is growth rate, and WACC, which is weighted average cost of capital. And what is the formula? So 1 upon WACC minus G is as common, but in the numerator we have ROIC minus G also. ROIC minus G divided by WACC minus G, because it captures both profitability in the form of ROIC and growth potential in one simple ratio. That is the importance of it. Then we have EV upon sales multiple. EV means enterprise value, sales, you know it very well, right? This tells you how much value the market places on every rupee or every dollar of the company's sale. So for every rupees or every dollar of the company sale, how much value the market place on every rupee, right? That is called enterprise value upon sales multiple. So what is the formula? After tax operating margin multiplied by 1 plus G multiplied by 1 minus reinvestment rate divided by WACC minus G, which is common in everything. After tax operating margin multiplied by 1 plus G multiplied by 1 minus reinvestment rate divided by WACC minus G. Now what about the reinvestment rate? So again, small g is the growth rate, WACC is the weighted average cost of capital, and reinvestment rate is the portion of the earning invested. So this formula you must remember for this EV upon sales multiple. So in this particular slide we have covered EV upon BV, EV upon sale, right? Two kinds of method we have covered right now. So that is all you need to learn from this particular chapter. We have learned various kinds of multiple. If you cover this much, more than enough, because most of the time question has been repeated from this only, right? So you must know the definition, you must know the formula, and you do one to three calculation based on them. And hi friends, welcome to the crash course unit number 17. Chapter name is merger, acquisition and restructuring. So friends, let's start with this chapter with our first topic, which is a special reorganization procedure with perspective to India. So let's explore the landscape of special reorganization procedures in India designed to breathe new life into unviable firms. So in this particular umbrella shaped diagram, every aspect will be made clear regarding this special reorganization procedure. So at the center lie a strong regulatory framework upheld by vital legislation like as you can see FEMA 1999, right? FEMA 1999, as you can see, regulatory framework FEMA 1999, the Income Tax of India 1961, right? Industrial Development and Regulation Act of 1951, Competition Act 2002, and SEBI Regulation Act 1992. So these acts together ensure financial discipline, industrial regulation, market fairness and investor protection. So these acts, so all some acts name I have provided you, right? These are super act. Now friends, moving on to the reconstruction of the SIC unit. The first topic, as you can see, reconstruction of the SIC unit. Right, so it is governed by the SIC Industrial Companies Act of 1985. Right, it is governed. Last time this question was asked, that act name was asked basically. So this reconstruction of the SIC unit is governed by the SIC Industrial Companies Act of 1985. This step help company that are financially ailing but operationally recoverable. So it helps those company which are financially ailing but are operationally recoverable. That is called reconstruction of SIC unit, right? Then comes amalgamation, right? Then comes what called amalgamation, as you can see on the right hand side. So amalgamation means what? This is when two or more firms merge to form a new entity. Shareholder of the original company gains significant stake in the resulting business, paving the way for a strategic consolidation, right? And one more thing is reconstruction reorganization scheme of arrangement, which means what? Right, single firm alteration of owner or creditor or right. And then we have revival of unviable firm, right? So basically this particular diagram shows the detail about the reorganization procedure. Either you go for amalgamation, either you reconstruct the SIC unit as per this act provision, or you go for reconstruction reorganization scheme of arrangement, revival of unviable firm, and regulatory frameworks are there in action. Some act name I have already provided. So together these measures form a robust umbrella of revival strategy guiding distressed business toward recovery and sustainable growth. So this is a brief overview. Now have a look at the types of merger. Very important. We are only covering those topics from where question have appeared in the previous examination. Now when we talk about the business growth through integration, merger comes in various strategic form, each with its unique purpose and impact. First we have something called horizontal merger. So horizontal merger is when company in the same industry join force.
So here you can see the keyword same industry. Company in the same industry join forces. The goal is to boost market share, reduce competition, and sometimes even create near monopolies. Think of it as two rival becoming one strong leader, right? Two rival are becoming one strong leader. You can think of them like that. This is called horizontal merger. Next we have something called vertical merger. Vertical merger, what happen when a company merge with, so some key points you can see what happen in the horizontal merger. Same types of industries are there, right? They boost market share, reduce competition, and sometimes they even create near monopoly. So these are horizontal merger. What is vertical merger? So when one company merge with one in its supply chain, when one company merge with another company in its supply chain, right, either a supplier or a distributor, this strengthen the buyer seller relationship and improve supply chain efficiency. This is called vertical merger. So one company merge with one in its supply chain. In the same supply chain, if there is another company and two company merge together, they are called vertical merger, right? So key points you can see: buyer seller relationship improvement and supply chain integration. Then we have something called conglomerate merger, and for 5 key points have been given to quickly understand conglomerate merger. This is the beauty of this particular slide, right? Everything is written in just keywords. So at the time of examination, if you go through this slide, the keyword will be immediately, you can easily get the entire picture clear using these keywords. Conglomerate merger, a bold move where completely unrelated business unite. So here you can see unrelated business, no overlap, right? They unite. So the motive here is diversification, resources utilization, and even a strategic debt expansion. That is called conglomerate merger. Means two industry having nothing in common, right? They unite. They are totally unrelated, they unite. That is called conglomerate merger, right? Then we have congeneric merger. See, congeneric merger is what? This involves company with related technology or complementary products. It allows for broader product range, increase market reach, and enhance technical capability. You can see related technology means those company are merging together which are with related technology or complementary product. So broader product range, increase market reach, and take technical capability enhancement. And finally we have something called reverse merger. So last slide you can see reverse merger. So it is a lesser known but powerful tool. Here a private firm merges into publicly listed one, allowing it to bypass the lengthy IPO process and gain fast public listing. So what happened in the reverse merger? One private firm merges into a publicly listed one, allowing it to bypass the lengthy IPO process. It does not have to go through the lengthy IPO process, initial public offering process, and it helps them gain fast public listing. So each merger type, so see, we have talked about at least I think 4 types of merger, 5 types to be more precise: horizontal, vertical, conglomerate, congeneric, and reverse. Remember, these merger are most frequently asked. Sometimes case studies is being asked regarding the types of merger. So reverse merger, what happened in the case of reverse merger? I told you, a private firm merged into publicly listed one, allowing it to bypass the lengthy IPO process. So each merger type serve a specific business need, whether it is to dominate, diversify, streamline, scale. Together they shape the dynamic world of corporate restructuring. Right, now have a look at this slide. Merger region, very important. This question was asked, what is the reason for merger? Every aspect has been taken care of in just one single slide. In your book it is given in 3 pages, right? And we are just covering only those things that are important from examination point of view. So when two companies come together through a merger, it is not just a business handshake. It is a strategic leap toward amplified growth and efficiency. First of all, we have something called economies of vertical integration. What does it mean? So merger help align the value chain, bringing production and distribution under one roof, leading to significant cost saving, right? It leads to significant cost saving. So key points, remember, value chain, right? Aligning the value chain means bringing, so economy of vertical integration means merger help align the value chain, bringing production and distribution under one roof, leading to significant cost saving. Then we have power of complementary resource. So here you can see complementary resource. So basically what it means, that when one company has strength fill another's gap,
it foster innovation and ensure a perfect market fit. See, two things are there. Complementary resource means what? Suppose one company has strength, fill another gaps, right? So it foster innovation and ensure a perfect market fit. That is called, complementary resource. Then we have something called, synergistic operating economy. What is the meaning of this synergistic operating economy? Let's understand. So synergistic operating economy, try to understand what it means. The concept of synergistic operating economy is key, where the combined entity is more valuable than the sum of its part. That is what is represented by VAB greater than VA plus VB, which means combined value is larger than the individual value. Combined entity is more valuable than the sum of its part. So this synergy comes from shared services and scaled operation, right? Shared services and scaled operation, two way through which this synergistic operating economy comes into picture. Then we have something called, taxation benefit. What is the meaning of taxation benefit? You can't ignore the taxation benefit. Merger allow company to offset accumulated loss, reducing the overall tax burden, right? So offset accumulated loss, whatever loss has been accumulated, to offset that, merger allow company to offset the accumulated loss and to reduce the overall tax burden, right? So this is the taxation benefit of merger. Then we have faster growth, right? So merger also bring faster growth, enabling quicker market entry and saving valuable time that would otherwise goes into building from scratch, right? So faster growth, first of all, a quicker market entry and saving valuable time. Obviously it helps to save the valuable time that would otherwise go into building from scratch. Then we have market power and production. On the left hand side you can see. So with market power and production consolidation, company gain a larger market share and higher production capacity. You can see with with market power and production consolidation, company gain a larger market share and high production capacity, positioning themselves as industry's leader. Then we have economy of scale. So what happened through economy of scale? You can see through economy of scale, larger operation means lower per unit cost and improve efficiency, right? So cost reduction and efficiency improvement. Through economy of scale, larger operation means lower per unit cost and improve efficiency, right? Then we have economy of scope. Economies of scope help expand business offering and utilize asset more effectively across a broader base. That is called economies of scope, right? It help expand business offering and utilize asset more effectively across a broader base. Then finally, merger ensure utilization of surplus fund. Idle capital can be reinvested smartly into a strategic area for growth. That is called utilization of surplus fund. That means idle capital can be reinvested smartly into a strategic area for growth. So together, let me just summarize the main point. First of all, economies of vertical integration, complementary resource, synergistic operating economy, taxation benefit, market power and production consolidation, faster growth, economies of scale, economies of scope, utilization of surplus fund. So together these reasons paint a powerful picture of why merger are not just about expansion, they are about smarter, faster and more strategic evolution. Now friends, so main driver you can just remember like this: synergy, tax benefit, fast growth, market power, scale, scope, vertical integration, complementary, then surplus use, managerial strength. So these are the main driver. Now have a look at the legal procedure of amalgamation. This is very important aspect. Friends, when company decide to merge, the process is not just strategic. Have a look at the legal procedure for amalgamation. First of all, when company decide to merge, the process is not just strategic, it is deeply legal. Let's walk through the step-by-step procedure of amalgamation in India. So basically, step number 1 is review object clause. Start by checking the MOA, that is called Memorandum of Association, to ensure that merger is within the company scope. If it is not, obtain approval from shareholder, the board and the company law board, right? Then we have step number 2, that is a stock exchange intimation. So inform the stock exchange about the proposed amalgamation and issue formal notice. Transparency is key from the beginning. Third we have is board approval. What is board approval? The draft scheme of amalgamation is placed before the board. Once reviewed, the resolution is passed to move forward. Then we have application to NCLT. Next, a formal application is filed with the National Company Law Tribunal for a foreign company merger. Prior approval from RBI is also required. See, application to NCLT for basic thing is that a formal application is filed with the NCLT. What is NCLT? National Company Law Tribunal. For foreign company merger, prior approval from RBI is also required. Then we have notice to shareholder and creditor. See, once NCLT gives the go ahead, a 30-day notice is issued. This includes publishing the notice in both English and regional newspaper, right, on the company website and via SEBI, that is Security and Exchange Board of India, and the stock exchange. Financial and auditor certificate are shared for inspection. So see, after NCLT approval, send 30-day notice, publish in English plus vernacular newspaper plus company website plus SEBI plus stock exchange. So what that SEBI does? Financial and auditor certificate are shared for inspection, right? So, and file compliance affidavit with NCLT. Then we have the last step, that is the conduct meeting. See what happened. Finally, meeting are held with shareholder and creditor, right? So meeting are held with shareholder and creditor. And one more thing is that approval must be secured from at least 75% in value, right? However, if 90% consent is obtained via affidavit, the creditor meeting can be skipped. So remember, one more thing is that 75% approval should be there in the meeting, right? And 10% plus shareholder 5% plus creditor can oppose, notify central government, ROC, IT department, RBI, CB, CCI. 30-day objection windows is there. Skip creditor meeting if 90% plus consent is obtained via affidavit. So this legal framework. So sometimes question being asked that suppose a foreign company want to merge, so whether RBI approval is required or not. So it is required, right? In which case board approval is required, right? So what should be checked? MOA should be checked, AOA should be checked, what should be checked? So review object clause, stock exchange intimation, board approval, application to NCLT, 30 days notice, right? Very very important. And notice to shareholder and creditor, and then meeting is conducted, and 75% approval is required, right, in the meeting. Now then we have the accounting method for business combination, right? Business combination, just we are talking about this merger, amalgamation, takeover, etc. Let's decode how business account for combination, whether through merger, acquisition, or any other strategic control transfer. So at the core of the business combination, an acquirer gain control. Here you can see acquirer gain control, right, through cash, equity, or other mixed consideration. But how do we account for this? That depends on legal and tax consideration, and most importantly, the accounting method selected. So there are two main approach. The first is called, so as you can see, acquisition method, and the second is called the pooling of the interest method. So what happened under the acquisition method, and on the left hand side, as you can see, first of all we identify the acquirer. Who is acquirer? Acquirer is the entity gaining control. Means who is acquiring, that is called acquirer, gaining control. Next we determine the acquisition date. Means when the control is officially transferred, that is called acquisition date. Then the company must recognize either goodwill or bargain purchase gain, right, depending on the deal's nature. So company must recognize either goodwill or a bargain purchase gain depending on the deal's nature. Finally, asset, liabilities, or any other non-controlling interest called NCI, they are recorded at the fair value. So these are the steps. Just now I told you, in the case of acquisition method, identify acquirer, means the entity gaining control, determine the acquisition date. A company must recognize either goodwill or bargain purchase gain depending on the deal's nature. Finally, asset, liability, and any non-controlling interest are recorded at fair value. And on the other hand, we have the second method, that is called pooling of interest method. It is used less frequently now. So the focus shift to recording assets and liability as they stand, right? Then firm aligning accounting policy across both entity. Then what they do, reserves are adjusted but no goodwill is recorded, emphasizing continuity rather than acquisition. So basically these are two methods of accounting, acquisition method. Now friends, have a look at the role of investment banker in merger and acquisition. When it comes to merger and acquisition, investment banker are not just facilitator, they are a strategic enabler. You can think of them as an umbrella shielding both the parties during high stake financial storm. So let's look at what are their functions. First of all, coordination. It is their first task, identifying the right target, connecting potential acquirer and seller, and ensuring a smooth matchmaking process. Second is defensive strategy, right? So advising firm on how to resist hostile takeover and stay in control when under threat. Then we have something called fair value determination. So they also handle fair value determination, ensuring that valuation is transparent and legally sound, reducing the risk of post-deal lawsuit. Then we have financing merger. On the financial front, they manage financial merger, arranging capital for the acquirer and sometimes even defense funding for the target company. And then arbitrage opportunity. So they operate in the complex world of arbitrage operation, leveraging market movement in traditional and merger and acquisition related arbitrage to maximize the deal efficiency. So coordination, defensive strategy, fair value determination, financial merger and arbitrage opportunity. So together all these roles make investment banker the central force behind successful merger, balancing risk, opportunity and values for all the stakeholders. Now have a look at the exchange ratio factor in merger and acquisition. So in a merger or acquisition, one of the most critical element is determining the exchange ratio. What is this exchange ratio? The number of share the acquiring company will offer for each share of the target company. See, two company are there. One is the target company, other is the acquiring company. How many number of share the acquiring company will offer for each share of the target company? For one share of the target company, the number of share acquiring company is offering is called the exchange ratio, right? So but what drive this number? So there are some factors which drive this number. Let's look at those factors. The first factor we have is called book value per share. So it is a balanced valuation where exchange ratio is aligned with the combined book value of both entities, right? So if we talk about the book value per share, so the formula is quite simple, that a balance sheet based valuation it is there where exchange ratio is aligned with combined book value of both entity. So as per the book value per share, formula is acquired book value divided by target book value. Then exchange per share, earning per share. So this focus on profitability. Higher earning per share typically demand a better exchange offer. Then we have market price per share, right? So it is a real time market driven metric reflecting investor sentiment and share performance. And then we have discounted cash flow, that is called DCF method. It estimates future cash flow, giving us a forward looking value. So together these are the factor: book value per share, earning per share, market per share, discounted cash flow. So these factors ensure that exchange ratio is not just fair but strategically sound, maximizing value for both acquirer and target shareholder. That is called exchange ratio factor in merger and acquisition. Now friends, have a look at the next slide. Takeover, control, types and methods. What is the meaning of it? Let's try to understand. When it comes to corporate strategy, takeover are a powerful tool to gain control of a company, right? It is a very powerful tool to gain control of the company, right? Either with the open arm or in some case again the will of the management. Sometimes open arm, right? Or sometimes again the will of the management. Let's break it down. So control can be of two types: either full control where the acquirer take over completely, or second is effective control where the influence is gained without total ownership. So two types of control are there. Full control means the acquirer take over completely, or effective control where the influence is gained without total ownership. Total ownership is not gained but influence is gained only. And there are two types of takeover. The one is called friendly takeover, second is called hostile takeover. In friendly takeover, management is on board. In hostile takeover, management resists the acquisition, right? So we have seen notable Indian example like Indal was acquired by Hindalco, IPCL was acquired by Reliance, right? Then Ranbaxy Daiki Sankyo deal, right? So these are some examples of it. So friendly takeover means, you know, management agree, and hostile takeover is management opposes, right? Now friends, how do takeover happen? Methods of it. Have a look at it on the left hand side. First of all, we have open market purchase. So buying share directly from the stock market, often using hostile bids. Then we have negotiated acquisition. So it happened, what happened in that case, that, you know, buying share privately from promoter or large shareholder. So privately from promoter and large shareholder, you are buying shares. And third is called, you know, preferential allotment. What happened in preferential allotment? When the company itself issue new share to the acquirer. This is typically a friendly move to boost a strategy or to raise fund. So whether friendly or whether fights, takeover shape the future of industry one share at a time. Right now friends, have a look at this anti-takeover defense flowchart. So what are the some defense technique of anti-takeover? So when a company senses that it might be taken over, especially in a hostile way, it can use several defense tactics to protect itself, and these are called anti-takeover defense. Again I'm repeating, whenever a company senses that it might be taken over, especially in a hostile way, it can use several defense tactics to protect itself. These are called anti-takeover defense, and they fall into two main stages: before and after the takeover takeover offer is made. That is called pre-offer. See, pre-offer defense means before the takeover offer is made. That is called before a takeover bid happen. And second is called, you know, post-offer defense. Post-offer defense means after a takeover bid is made. So have a look at the pre-offer defense. Pre-offer defense on the first side we have. What is the meaning of pre-offer defense? The first type we have is called a staggered board. What happened in the staggered board? That the company has split the board of director into 3 groups elected in a different year. This slows down the process of gaining control. This is called a staggered board. Again I am repeating, company is split the board of director into 3 group. Board of director is split into 3 group, and this slow down the process of gaining control. Then we have super majority clause. Instead of simple majority, a very high number like 80% of the vote is needed to approve a merger, making it much harder. Now then we have something called, you know, poison spill. This is most frequently asked question. See, the company give existing shareholder the right to buy share or bond at a cheaper price, making it costlier for the outsider to get control. So what happened in poison spill? That the company give existing shareholder the right to buy share or the bond at a cheaper price. So obviously it will become costlier for the outsider to gain control. Then poison puts. Poison puts means company issue bond that can be repaid early if there is a takeover attempt, putting financial pressure on the buyer, right? So if suppose takeover happen, what will happen? So such kind of bond can be repaid earlier, right? So if there is a takeover attempt, so it will put financial pressure on the buyer. Then we have dual class share. See, the company create a special class of share with more voting power, helping the original owner stay in control. Then we have golden parachute. So if the top executive was removed after a takeover, they get huge payout. This make the takeover more expensive, right? So if the top executive, right, are removed after a takeover, they get huge payout. This make the takeover more expensive. So these 1, 2, 3, 4, 5 and 6. So these 6 are the pre-offer defense. Why they are called pre-offer defense? Because before a takeover bid happen, these strategies are taken into action. A staggered board, right? Board is split into 3 groups. Super majority clause, poison spill, poison put, dual class share, golden parachute. Now we have post-offer defense. What happened in the post-offer defense? After a takeover bid is made, the first technique that is used called green mail. What is green mail? See, in green mail, the target company buy back its own share from the bidder at a higher price to stop the takeover attempt. Then we have Pac-Man defense. So Pac-Man defense means what? The target company turns the table and try to buy the company that is trying to buying it, right? So the target company turn the table and try to buy the company that is trying to buying it. Litigation means the target company sue the bidder, usually claiming rule violation to slow down or stop the process. Asset restructuring means the company sell its best part, called the crown jewel,
or buy poor performing asset to make itself less attractive to the bidder, or liability restructuring, the company take on new debt or buy back it on share to make the deal harder or costlier for the bidder. So in short, these are the tactics, right? These are act like a shield that a company put up to avoid being forcefully taken over. Some strategy buy time, other may take over more expensive or complicated, and some just fight back, right? So that is all about the anti-defense takeover. First ratio is called interest coverage ratio, right? So what is interest coverage ratio? It tells us that how much interest, in the numerator you can see EBIT, in the denominator you can see interest expense, right? It tells us how much easily company can pay it interest, right? So that is what interest coverage ratio tells us. Obviously company has borrowed money, so obviously it will have to pay interest, right? So how much easily company is able to do the interest payment, that is what interest coverage ratio tells us, right? And the formula is EBIT upon interest expense. So what does EBIT indicate? EBIT indicate the net profit before interest, paying interest and tax, and from that profit only from that earning only company will be paying interest. So more EBIT, so more ability to pay interest. So EBIT upon interest expense is called interest coverage ratio. Then we have equity multiplier. So what does equity multiplier tells us? It also tells us how easily company can make it interest payment. Higher the equity multiplier, if we talk about the equity multiplier, it shows us as a total asset upon total equity, right? That means how much asset, right, is getting funded by equity, right? So if it is more, it means leverage is also higher, right? If more asset is funding by equity, it means our leverage is also higher. Then we have debt EBITDA ratio. So what does debt EBITDA ratio means? Means how much early company can repay its loan using its earning. That is debt to EBITDA ratio, right? So if this ratio is lower, it means better financial health. So basically what this ratio tells us, how easily company can pay back its loan using its earning. So EBITDA is the earning and debt is the total debt it has taken. So if this ratio is lower, it means that it is better financial, it shows better financial health. Then we have debt equity ratio. So as the name itself suggests, it compares debt and honors equity. So if debt portion is higher, it means risk is more. Then we have debt to asset ratio. So this ratio tells us how much portion of the company's asset is funded by the debt, right? Again, the lower the ratio, the better it is, right? So you see, we have discussed 5 different ratios. On those ratios where debt is in numerator, that ratio should be lower, right? And for those ratio where interest expense EBIT is in numerator, those ratios should be higher. That is the basic funda. So these 5 ratio when combined, right, they decide the financial structure of a company, right? So interest coverage ratio means how easily company can pay back its interest using its earning. Equity multiplier means how much of the asset is funded by the equity, because to fund asset either we use equity or we use the debt, right? So equity multiplier, I told you the equity multiplier, if it is higher, it means leverage is also higher. Then we have debt the debt EBITDA ratio means how much it shows that how early company can pay back its debt using its earning. If this ratio is lower, better financial health. Debt equity ratio, debt and honor contribution comparison is being done using this ratio. And debt asset ratio, that means how much of the asset is funded by the debt. Like debt equity ratio, similarly we have debt asset ratio. Lower it is better. Now friends, let's shift our focus to the financial leverage, right? So we have discussed 5 ratios earlier, financial leverage ratio. Now financial leverage, you can think of it like double-edged sword. It amplifies your return on equity when used wisely, but if you overuse it, especially by large firm, it can be dangerous. So you know what happened. So that is why I have written double S word, right? Why it is double S word? I told you now, right? It can amplify your return on equity. This ROE means return on equity. It can increase your return on equity if you use it wisely. But if you overuse it, by large firm, what they do, you know, they overuse it. It can be dangerous. A small business might tolerate higher leverage, but larger corporation need to treat cautiously, right? So that is why optimal mix is required. Mixing between equity and debt is optimal. It should be required, right? So the goal is to strike the optimal mix between equity and debt, and that is where, you know, CBA. What is CBA? Cost benefit analysis and proper funding strategy comes into play. Then we have something called risk management. So risk management is all about balancing gain with stability. You can see balancing risk and return in leverage. So risk management is all about you are balancing gain with potential gain with financial stability. So more debt, it means more profit, but only if managed smartly. Suppose you have taken more debt. Oh, you are happy that yes, I have more profit. But remember, at the back of mind, you must keep in mind, if you manage that debt smartly, then only it is profitable. Otherwise, it will not be profitable. You have to manage that debt smartly. Right, now comes the degree of financial leverage. It is a tool that shows how sensitive earning per share is to the change in the operating income. So the formula is percentage change in EPS upon percentage change in EBIT, and here is the simplified version, right? What is the simplified version? That if interest is fixed, then we can write DFL is equal to EBIT upon EBT. You can see it here. Since interest is fixed, right? So delta EBIT is equal to EBI per delta EBT. So the final formula is, you must remember this formula, EBIT upon EBT, right? So that is earning before interest and tax divided by earning before tax. And finally, some more important formula that will help you to solve the problem is that suppose sales is given, variable cost is given, fixed cost is given, you have been asked to calculate EBIT. How to go about doing that? So what you do, first of all, you take the sale, you subtract variable cost, and you also subtract the fixed cost excluding interest. Right, you also subtract the fixed cost from that, and then you will get EBIT. And suppose we know the EBIT. How to get EBT? Quite simple. EBIT means what? Earning before interest and tax. EBT means what? Earning before tax. So just subtract the interest from EBIT, we will get EBT. So these two formula will be very useful to you, right, while doing the calculation, so while calculating the DFL. Right, so remember these two formula, very important from examination point of view. So to summarize the fact that we have covered in this particular slide, let me tell you that this financial leverage, you know, it can be your best friend or it can be your biggest risk. Handle it with insight and it can drive powerful growth. Now friends, so I hope this financial leverage concept is clear. Then comes degree of financial leverage. So after financial leverage, the next important topic is degree of financial leverage. What is the meaning of degree of financial leverage? Let's understand. So friends, basically, you know, there are three scenario here. First scenario on the left hand side is there when there is no interest. So when no interest, what will happen? You know, EBIT is equal to EBT, because no interest is there, no debt part is there. No interest means what? You have not taken any debt, hence no interest to pay. In that case, DFL will be equal to 1. This means there is no leverage effect. So this interpretation should be there. You should know what is the meaning of DFL is equal to 1. So whenever DFL is equal to 1, it means EBIT and EBT both are equal. It means that no debt has been taken, no leverage effect is there, profit change in line with the operating income, safe but limited upside. It is quite safe, but you know, there is no chance of gaining too much. So that is why upside is limited. Right, okay. Now this is situation number 2, that is called break even. So break even means what? You know, break even means neither profit nor loss. Right, you are neither making profit, you are not making loss. Right, so what will happen? What will happen in this case? Your EBIT, which is your earning, which be exactly equal to the interest. Interest means the cost you are paying. Because you have taken debt, obviously you are paying interest on that. That is the cost you are paying, and EBIT is your earning. So what I told you, break even, no profit, no loss. Right, so no profit, no loss means what? Whatever cost you are incurring and whatever sales you are getting, both are same. Cost price is equal to selling price. That is what it is happening here. Right, and tell me what will happen to the DFL. So DFL is what? EBIT upon EBT, and EBT is 0. Obviously EBT is 0, earning before tax is 0.
right? So EBT is 0. Since EBT is 0, it means denominator is 0, and denominator means 0 is undefined. It means it is undefined. So this is the maximum risk zone. This is called maximum risk zone. Even a tiny dip in EBIT can lead to huge loss. Suppose EBIT decreases a little, it will lead to huge loss, a dangerous place for any business. So break even point is the dangerous place for any business. This is the situation number 2. And the third situation you have, suppose it is operating below the break even. So break even below means what? It is undergoing a loss. So loss means what? Interest cost is higher than the EBIT, isn't it? So before break even means EBIT is positive, but EBT turned negative due to high interest cost. See, interest cost is higher, EBIT is lower, ultimately EBT is become negative, right? That's why it is written EBT is less than 0, EBIT is greater than 0, interest cost is quite higher. So what will happen in this case? DFL will become negative, right? It will become negative because it is a ratio of EBIT upon EBT. So out of, you can see EBT is negative, so DFL will be negative. So this signal what? Loss amplification, means leverage is hurting you, right? It is not helping, it is hurting you. That is why I told you na, leverage is a double-edged sword. If you use it smartly, then it can be very helpful, but if you use if you don't use it smartly, it will be very much hurtful, like you can see in this case. So it since it is operating below the break even point, right? In this case you can see DFL is negative, your loss will become amplified. So more debt if you take, it increase loss instead of gain. So what we learned from this discussion is that it has been simply represented in the form of this chart, is that leverage can be a powerful financial tool, but only when used within the safe limit. Knowing where you are in this scenario help you manage risk smartly. So this break even point decide if you are above the break even, or if you are at least at the break even, you are safe. But if you go below the break even, you are unsafe. That means your DFL will become negative, your loss will get amplified. So this break even acts like a the brake, right? It acts like speed brake. It acts like your speed brake. If you go beyond the break even point, if you go in the negative side, you will be ultimately at loss. I hope that makes sense to you. Now friends, understanding the DOL, DFL we have covered completely, every aspect we have touched now. So now let's understand the DOL, degree of operating leverage. So degree of operating leverage can be understood very well using this particular diagram. So first of all, we will look at the formula. So DOL measure how sensitive a company operating income. So what is the meaning of DOL? It shows how sensitive a company operating income. So what is the meaning of company operating income? It means EBIT, earning before interest and tax. How sensitive a company operating income, that is EBIT, is to the change in sales. That is what is shown by DOL, degree of operating leverage. In simple term, if your sale move 1%, how much will your profit move? That is what DOL tells us, right? So again I am repeating, the formula is percentage change in EBIT upon percentage change in sales quantity. Means if your sales move 1%, how much will your profit move? That is what is indicated by the degree of operating leverage. Now friends, higher DOL, it means higher risk, higher reward. It signal higher fixed cost. It signal greater earning volatility. There are some key formula which we must keep in our mind. The first thing is contribution. I already told you that it is nothing but sales minus variable cost. Then the next formula we have DOL always reflect the operating risk. And then we have the fixed cost. What is fixed cost? What is the meaning of fixed cost? So fixed cost is the main driver. They stay the same even if your sales does not, right? Obviously fixed cost does not get impacted by the sale. Whatever your sales is, fixed cost will remain the same. So you should know how to calculate the contribution, because to calculate basically DOL, you will need to have contribution concept should be clear, right? So percentage change in EBIT upon percentage change in sale, and EBIT you can write like sales quantity multiplied by price minus variable cost and subtract the fixed cost from it, right? So there is something called refined DOL formula, right? So you can say delta EBIT, or means change in EBIT, is equal to change in sale quantity multiplied by price into price minus variable cost,
And finally, this is a super important formula that will help you to calculate, which is nothing but contribution upon EBIT, right? DUL. Like in the case of DFL, I told you the EBIT upon EBT. Similarly here, contribution upon EBIT. This is the final refined formula, and this formula we will be using most of the time. So understanding DUL help business plan better, price smarter, and prepare for the market shift. So if your DUL is higher, what does it mean? It means that your profit can skyrocket with a small sales jump, but it can also fall sharply if sale drop, right? So your suppose DUL is higher, it simply means that your profit can skyrocket with a small sale jump, but it can also fall sharply if sale dip, right? So that is the implication of DUL. Now the most important thing, how to interpret degree of operating leverage in a special situation. This is very important thing. So let's decode DUL when things get extreme. Let's explore how the degree of operating leverage behave in two very special and very opposite situation. The scenario number one is having no fixed cost, right? Having no fixed cost. So what does it mean? When a business has no fixed cost, it run purely on variable expense, right? Since there is no fixed cost, so it will run purely on variable cost or variable expense. In this case, DUL is 1, meaning there is no operating leverage, right? So when no fixed cost is there, which means business is purely running on variable cost, in that case DUL is 1, means that no operating leverage is there. The question is why no operating leverage? Because your profit move exactly in synchronization with your sale, so no acceleration effect is there. So it is a safe zone. That is why I have highlighted by green color. It is safe zone, low risk, but also low potential for profit boost from increased sale. Obviously it is why it is called safe zone, because risk is very low, and but since risk is low, but potential for profit is also very low from boost from increased sale. Then scenario number 2 is EBIT is 0. This is very important thing. Now flip to the other extreme, when your business earn no operating income at all. No operating income earned by your business. Now the formula it very well. The formula is contribution upon EBIT. Just now I told you. So when EBIT is 0, means denominator is 0, so the DUL will become undefined, isn't it? DUL will become undefined, right? Since you divide by 0 in the formula, the result is impossible to quantify. That means maximum operating risk. A tiny drop in sale could send you into loss instantly. You are walking a financial tightrope, right? So this is called maximum operating risk. A teeny drop in sale could send you loss instantly, right? And you are walking a financial tightrope. So basically what we learned from this discussion is that, let's summarize the fact that DUL tells you how much your profit react to the change in sale. But in these these are two extreme cases. On one side we have no fixed cost when DUL is equal to 1. So on the other side we have EBT is equal to 0 where DUL is undefined. So in this extreme case, right, so DUL basically tells you how your profit react to the change in sale. But in these extreme cases, the message is clear. No fixed cost, you are stable. No EBIT, you are in danger. That's it. So this is the best way to learn, right? To comprehend the thing, to remember it for the long time. And if before the examination, if you go through these kinds of slides, you will be able to recall the main points, right? Now friends, have a look at this particular slide. How to manage leverage and fixed cost. Very, very important aspect. Here we will look at something called break-even point. I think you are familiar with it. So when it comes to running a business, the balance between risk and return often hinges on two key factors. The first is called leverage and the fixed cost. Yes, these are the two key factors, leverage and the fixed cost. Let's understand what are these two key factors here. So basically, first of all, let's talk about the high leverage case. See what happened. What is the meaning of high leverage? It means you are using more borrowed fund or fixed financial obligation. So whenever you are using more borrowed fund or whenever you are using fixed financial obligation, it pushes your break-even point higher, right? It pushes the break-even point higher. This increases the risk, okay, but it also opens the door to higher profit when things goes right. You can think of it as high risk, high reward. This is called high leverage. So I hope the meaning of high leverage is clear. That means you are using more borrowed fund or fixed financial obligation, right? So this more borrowed fund or fixed financial obligation pushes your break even point higher, increases the risk, but also open the door to higher profit when things goes right. Then we have low leverage. Low leverage means you are playing it safer with few financial obligation. It lower your break even point and reduces the risk, but your return may also stay modest, ideal for a steady and a stable growth. Then we have high fixed cost. So more fixed costs like rent, salary, equipment means your business becoming more sensitive to the change in sales, right? Your business is becoming more sensitive to the change in sales. So this amplify both gain and as well as loss, a classic feature of high operating leverage. And low fixed cost, right? I told you, when zero fixed cost was there, DUL was exactly equal to 1. So low fixed cost means what? Reducing fixed expense add flexibility. It stabilizes your earning, cushioning both profit and loss. This is a strategic move during uncertain time. So the bottom line is that from this discussion what we get to know is that mastering leverage and fixed cost is not just about math. It's about making a smart decision that match your risk appetite and business goal, right? I hope that makes sense to you. Now friends, have a look at the combined leverage. In this particular slide we will understand it. So what combined leverage is all about, it has been depicted clearly in this particular slide. So this metric that is the combined leverage tells us total risk exposure of a business, right? It combines both operating and financial leverage. It tells you the total risk exposure of a business, total risk impact. As you can see, total risk impact or total risk exposure of a business, right? So it combines both, right? It combines your operating and financial leverage. So if we talk about the impact, on the left hand side you can see DTL stands for degree of total leverage. It captured the full risk impact by considering the operating fixed cost like rent and salary and financial fixed cost like loan interest. Now a high DTL, it means that even a small change in sale can cause big swing in the earning per share. It is both a great opportunity but a big risk also. Now have a look at the formula, right? There are three ways to calculate DTL. First of all, percentage change in EBIT upon percentage change in sales. This is the first formula. Second formula is either you calculate DFL individually, DUL individually and multiply both of them. And the third thing you can do, DFL, DFL is EBIT upon EBT, DUL is contribution upon EBIT. So EBIT will get cancelled, it will be contribution upon EBT. So there are three formula which you can use to compute DTL. I use, depending on the situation what is given to you in the question, you can choose the either of this formula. No matter which one you use, it's all about understanding how sensitive your profit are to the change in sale. That's it, right? Now what is components, what are the things inside it? First of all, we have operating fixed cost, means cost that don't change with production. Then we have financial fixed cost, means payment like loan interest that are due no matter what. So together they define your company total leverage position. So combined leverage is like driving with both the gas pedal and turbo engaged. The reward can be huge but so can be the risk, so handle it with insights. Now friends, that is all we need to learn from this particular chapter. I have provided you information regarding DFL, its implication, when it becomes DFAT calculation. So first of all, cash forecasting. Cash forecasting help predict your company's future cash position. It is not just about guessing, it's a strategic planning rooted in data. Let's explore the core driver. The first one we have is called sales inflow, right? As you can see, sales inflow means revenue from sale and customer order. It is the lifeblood of your forecast. A strong inflow, it means healthy business, right? Then we have next we have is called service inflow. So then after sales inflow comes service inflow. So here you can see service inflow on the right hand side. So don't overlook service fee and contract. They provide a steady stream of income and help project recurring cash. Then we have market penetration. As you can see, market penetration on the top right side. So market penetration means knowing your target market and distribution channel help estimate how much cash your business will generate in the new market. Then we have demand estimate. So demand estimate means through research and survey you can forecast customer demand and plan cash need accurately. Then we have, competition. Yes, competition always plays a super important role. So what is the meaning of competition? As you can see on the top right side, top left side. So competition means what? Analyzing market share and rival, ensure you stay ahead and plan for price war or volume change. Then we have something called production plan. Production plan means your capacity, your inventory. They dictate how much you can sell and how much cash you will need or generate. Then we have raw material availability. Inventory level as well as supplier relation affect your production and ultimately your cash outflow. Then we have pricing strategy, which means cost plus or competitive pricing affect your margin and therefore your cash position. And finally, working capital. So the balance between current asset and liability determine how flexible and resilient your business is. So that is all about cash forecasting, right? So by combining all this factor, business can accurately estimate CFAT. What is CFAT? CFAT is cash flow after tax, which is very crucial for investment planning and financial health. So these are the factors which affect our cash forecasting. Now have a look at how do we calculate the CFAT. So there is a step-by-step process I will tell you to calculate the cash flow after the tax. So ever wondered how business actually calculate the cash they truly earn after paying tax? Because the name itself suggests cash flow after the tax. So they have paid the tax. So how do they calculate the cash, right, they truly earn? So let's break it down in the simplest way. First of all, we start with something called sales, right? As you can see, we start with the sale, then we subtract the variable cost. What is variable cost? Like raw material cost or direct labor cost. These are the variable cost. So start with sales value, subtract the variable cost, right, and that you are left with something called contribution, right? So what is your contribution? Contribution means your profit before covering the fixed cost. So sales value minus variable cost, this will give you contribution. From contribution you subtract what? From contribution you subtract your fixed cost, right? So why you subtract the fixed cost? Because these are the costs that don't change with the production. And what are example of fixed cost? Like rent, like salaries. These are the example of fixed cost, right? So you determine the contribution by subtracting sales value minus variable cost, and from contribution you subtract the fixed cost, right? So after subtracting the fixed cost you will get EBIT. What you will get? You will get EBT, earning before tax, right? Earning before tax. And and one more thing that you have to subtract is the depreciation, right? So it is simply your contribution minus fixed cost and depreciation. So contribution minus fixed cost plus depreciation will give you EBT, earning before tax, right? Now time to pay the tax, right? So subtract tax from EBT to get EAT. So if you subtract tax from EBT you will get earning after tax. But here is the twist. The twist is that depreciation is a non-cash expense. So to get the true cash flow we add the depreciation back. So first of all we subtracted the depreciation and again we add the depreciation because it is a kind of non-cash expense, right? So the result you get is called CFAT, that is called cash flow after the tax. This is the amount of real cash that the business generate. So basically this funnel system, I have prepared this funnel system. So this funnel system show how money flow down through the financial system of a business from total sale to the actual usable cash. So again just let me summarize. You start with the sale, subtract the variable cost, get the contribution. From contribution you subtract the fixed cost as well as any depreciation, then you will get EBT. From EBT you subtract the tax, you get EAT, earning after the tax, and from earning after the tax you add again the depreciation, then you will get CFAT. This is the cash flow generated after the cash flow after tax. And this calculation will be super helpful while dealing with cash inflow, cash outflow, right, type of transaction. That is called cash flow after the tax. Now have a look at this particular diagram, that is called payback period method. So let's understand each and every aspect related to the payback period, right? What are limitation, what are advantage, what are disadvantage, every aspect. See, when you invest money into a project, one of the first question that come to the mind is when will I get my money back? Obviously. So suppose you have invested 2 lakh rupees into your project. So the first question that comes into your mind while investment is that when I will get that 2 lakh rupees back. So that is where payback period comes into picture. In short we call it PP. So PP, that means payback period, is the time it takes to recover your initial investment using net cash inflow. right? So using net cash inflow, how much time does it take to recover your initial investment? That is called PP. The formula is quite simple. In the numerator you write your initial investment, in the denominator you write the annual net cash inflow. So this will give you the time period after which you will be able to receive your cash inflow, right? Your investment amount. But if you want to be more precise, we use discounted payback period, because obviously the time value of money comes into play, right? Because the 1 rupee value today is worth more than 1 rupee value after a year. You know it very well. That is why we apply the concept of discounting. Because discounting payback period, in short we call it DPP, it factor in the time value of money, giving you a more realistic view of the return. Because payback period simply ignore the time value of money, but the discounted payback period, it takes into consideration, right? So suppose if your project generate equal inflow, the calculation is very easy and consistent. Suppose every year you are getting how much? You are getting 50,000 as cash inflow, and you have invested 2 lakh. So obviously after 4 years you will be able to get back your investment, isn't it? But we are not taking time value of money into consideration here. So that is why I am telling you that the formula is very simple if our cash inflow is constant, right? But suppose our cash inflow is not constant, uneven inflow. Some year you are getting 50,000, some year you are getting 40,000 cash inflow, some year you are getting 30,000. This is called uneven inflow. In that case you need to accumulate cash year by year until the investment is recovered. In that particular case, cumulative cash inflow is very important thing, right? So what we do, we add cumulative net cash inflow year by year until it is equal to the initial investment, right? Like 50,000 plus 40,000 plus 30,000, we add it till it equal to 2 lakh, which is our initial investment, right? So this is the point which you have to remember. So some key points remember regarding the payback period method. It is simple and very fast method, perfect for a small business. However, it does not consider profitability beyond the payback point, and it ignores the time value of money unless you are using DPP, right? That is called discounted payback period. For larger or long-term project, firm often prefer NPV, IRR or ROI for better insight. For a smaller project, this method looks good, but for larger project, this method will not work. That is one of the limitation. So you should know what is payback period. You should know where it is used, where it is not used, right? So the bottom line is that shorter payback period, it means lower risk and faster return. But always pair it with deeper analysis when stakes are high, because we can't apply this payback period method even in a very large business. Otherwise, because this will not give the accurate result. Now let's understand the second kind of investment tool we have, that is called accounting rate of return. So basically this is another tool that we can use to check our return on investment. That is called accounting rate of return. In short we call it ARR. So let's explore one of the most classic and straightforward investment evaluation tool. Yes, we are discussing investment evaluation tool. We have done the investment and we are evaluating, right? So the tool we have is called accounting rate of return, ARR. How to find the ARR? Very simple. So to find the ARR is very simple, as you can see the formula here. So in the numerator you write the average annual accounting profit, right? In the denominator you write the initial investment. So average annual accounting profit divided by the initial investment, this will give you the accounting rate of return. Simple, right? But let's look deeper. If you look at the focus, so ARR put the spotlight on profit, not cash flow. In the case of PP, that is payback period, we look at the cash flow, but in this case it focus on profit. It does not focus on the cash flow. That is great for traditional business used to looking at accounting profit. That's why we are dividing the annual profit by the initial investment. In the previous case what we did, we divided by the initial investment by the net cash flow, but in this case we are comparing investment with respect to the profit. Now if you look at the data source, so from where we get the data, so it rely on data from your accounting book, not discounted cash flow. It rely on the data from your accounting book. And what about the time value of money? Yes, that is where ARR falls short. This is a disadvantage of ARR, because it ignores the time value of money. Obviously a rupee today is treated same as a rupee 5 years from now, and this is one of the limitation of this ARR, right? If we talk about the estimation period, so ARR work within a limited time frame which may not capture the full project picture. Now what if you look at the practicality of ARR, when it is practical, try to understand. When project life is long, it is practical. When future cash flow are uncertain, it is practical. When you want a quick familiar snapshot, not a deep financial analysis, this ARR is practical, right? If you look at the limitation and flaw, right, if you look at the limitation and flaw, so you can see it is not suitable for cash based evaluation, right? And one more thing, it overemphasizes the latter stage profit, and also internal mismatch is there, comparing shareholder profit with total investment. Obviously that is what we are doing now. On one side we have profit, on the other side we have investment. It can distort the decision, right? So one example is given in your book. Suppose two projects with the same ARR of 40%, but one returned faster than the other, and yet ARR treat them the same, right? ARR treat both of them as the same. It does not reward early gain, which are more valuable, right? Because two projects are there, same ARR 40%, but one returned faster than the other, but ARR treat both as the same. So it does not reward early gain. Obviously, you know, early gain is more favorable to you, right? Which is more valuable. So while ARR is easy, familiar and profit focused, we should use it with caution, right? It is best paired with deeper method like DCF when accuracy really matter. DCF, you know, discounted cash flow method, which we are going to discuss now. So ARR concept I think is clear now. Then we have the next investment evaluation tool, that is called the net present value, or we call it NPV. In short, we call it NPV, net present value. So let's understand what net present value is all about using this particular diagram. So why, first of all, the question is why NPV matter? Because it answers one simple but crucial question: is this investment really worth it in today money? That is one question that it answers. Is this investment really worth in today's money? Right. Now have a look at the time value of the money. Right. Yes, it takes into consideration the time value of money. Have a look at it. So it says that NPV fully respects the principle that 1 rupee today is worth more than 1 rupee tomorrow. It gives complete weight to the present cash, and that is key in smart decision making. So the question is, how does it work? Let's look at it. Let's look at the working of this NPV, right? So let's look at how does it work, means working of the NPV, right? So first thing first, we adjust for working capital. You can see the working capital adjustment. We always adjust for working capital. Suppose working capital increases, so that is a cash outflow. If it is decreases, that is called cash inflow, right? Obviously, right? Increase in working capital means cash outflow is there. Decrease in working capital means cash is coming in. So then we apply a discount rate, right? We apply a discount rate which reflect the risk and investor expectation. And there is a simple decision rule, as you can see is here, right? The decision rule is that if NPV is greater than or equal to 0, you should go ahead, right? The project creates value. And if NPV is less than 0, right? If NPV is less than 0, you should walk away. It is not worth the risk, right? So simple rule, NPV greater than or equal to 0, we should accept it. The project creates value, and if NPV is less than 0, we should walk away. It is not worth the risk. So among multiple projects, pick the one with the highest NPV, right? So highest NPV win. This is the simple rule that we have to follow while going through the NPV, net present value. Now one more question is that what about when asset having different lifespan? Yes, suppose asset are having the different lifespan. How do we solve this? So that is where, you know, equivalent annual cost comes into picture. It let you fairly compare option by analyzing the cost, right? So analyze cost to own, operate, maintain asset. It is useful for comparing asset with different lifespan. That is called equivalent annual cost. And you know, one more thing is very, very important. It's called capital rationing. Yes, what is the meaning of this capital rationing? Let's understand. When funding is limited, we use inflation adjusted or risk-free discount rate and raise our threshold. So when capital rationing is helpful, when our funding is limited. So we use what? We use inflation adjusted or risk-free discount rate, like, you know, higher IRR cutoff, right? So capital rationing, I told you that when funding is limited, we use inflation adjusted or risk-free discount rate. Inflation adjusted or risk-free discount rate, right? And raise our threshold like a higher IRR cutoff. Now friend, if we talk about the pros and cons of this NPV, have a look. So on the left hand, on the right hand side, we have the pros, means advantage. Because the first advantage is that it captures the time value of money. It reflects the true value, profit or deficit. So, right, and it is closest to the real return, right? And if you look at the cons, which means disadvantage, that it is subjectivity is in choosing the discount rate. Yes, obviously, because we use the discount rate, so obviously subjectivity is there, it is not objective. Also, long term projection can be unreliable, and it also don't directly show the accounting profit and loss, because it has nothing to do with profit. It just show you whether your project is viable or not by looking at whether it is greater than 0 or less than 0. That's it. So to summarize the fact regarding NPV, we can say that NPV is a robust, realistic and reliable metric perfect for evaluating whether a project adds true value. Use it wisely and let your investment speak in today's value. So that is the power of now friends, let's look at another financial metric or another investment evaluation tool we have, that is called IRR, internal rate of return. Let's decode one of the most powerful tool of investment decision making, internal rate of return. What is internal rate of return? So basically this summation formula, you see, this is the formula that we use to calculate the NPV, right? Summation of CT upon 1 plus IRR to the power T minus C naught. See, what is IRR? IRR is the discount rate that bring your NPV to 0. So this summation of something is your NPV, and you equate it to 0. You equate your net present value to 0, and the corresponding discount rate is called IRR. Means the discount rate that bring your NPV to 0. In other words, it is a rate at which your project just break even in today's money. And the formula is very simple. Summation of CT upon 1 plus IRR whole to the power T minus C naught. So what is CT here? CT is the cash inflow at time T, because for first year it will be C1, for second year it will be C2, third year it will be C3, similarly for each and every year. What is C naught? C naught is the initial investment, which means the outflow. Obviously you must have invested initially, that is the outflow. And T is the total project time. Capital T is the total project life, right? Or small t, whatever you call it, right? And one more thing, IRR is the internal rate of return. So this is the formula that we use to compute the IRR. Now interpretation, how to interpret it, very important. See, suppose you got the IRR, how to interpret it, whether your project is viable, whether your project is worthy or not. See, simple rule is that if IRR is greater than RRR, what is RRR? Required rate of return or cost of capital. Whether you call it required rate of return or cost of capital, both means the same. So if IRR is greater than required rate of return or cost of capital, we should accept the project. And if IRR is less than the required rate of return, we should reject the proposal. Very simple. This is the simple way of interpretation. Now you usually calculate it through trial and error or use Excel tool to calculate the IRR. Right, in examination you will not be asked to calculate IRR because it is very lengthy procedure, right? So just remember, you should compare IRR with respect to the RRR. If it is greater, then accept it. If it is less, then reject it. Simple rule. Now you usually calculate it using trial and error or Excel tool, and sometimes we can use option also. So out of the 4 options where IRR is given, simply put one option into the place of R and check whether the result is LHS is equal to RHS, and if it is, then that is your answer. So using option also you can calculate the IRR, but be aware of its limit. What are the limitations? Let's understand. Pros we know, when we use IRR, because it account for the time value of money. Yes, it offer a clear benchmark. It compare IRR with your expected return or WACC. These are the pros, these are the advantage. But if we talk about the disadvantage, so the calculation is very complex because it often use software. It often needs software. In some case, you may get multiple IRR. Yes, you may get multiple IRR, especially with non-traditional cash flow. Obviously, suppose your cash flow is non-traditional, you will get multiple IRR in that case. And IRR involve very heavy assumption. It is real result may differ, and if used alone, it can mislead. So always validate with NPV, WACC or scenario analysis. So when to use IRR? It is based for scenario analysis. When cash flow are stable and predictable. I told you now, when cash flow is unpredictable, multiple cash flow is there, so it will give you multiple IRR. Just now I told you, right? In some case you will get multiple IRR with a non-traditional cash flow. So when cash flow is stable, predictable, then IRR is work based. And always remember, as a part of broader toolkit including NPV, RRR and WACC, right? So this is all about IRR. What is limitation, what is when it is used, how to calculate, every aspect we have covered now. Now have a look at this MIRR, that is called modified internal rate of return. Obviously this is a good version, a nice version of this IRR, right? So have a look at MIRR. So because why we talk about this MIRR, because the standard IRR has a big flaw, has a big limitation, that it assumes that all interim cash flow are reinvested at the IRR itself, which is often unrealistic. Yes, IRR assumes that all the cash inflow are reinvested at the IRR itself, which is itself very unrealistic. So MIRR fix it. How does it fix it? It uses the two practical rate. The first rate it use is finance rate, right? And the second, here you can see the first rate is used is the finance rate, which means the cost of capital, and the second rate is used is the reinvestment rate, which means the return on the reinvested cash. So these two flaw of IRR, which was unrealistic in reinvestment at IRR, right? So it has been corrected by the MIRR because it used two practical rate, finance rate and reinvestment rate. If you look at the formula of MIRR, here you can see the formula. The formula is very simple. It is future value of inflow divided by present value of outflow to the power 1 upon n minus 1, right? So future value of inflow, which means what? It means at the reinvestment rate, and present value of outflow at that. So I told you there are two rate, right? Reinvestment rate and the finance rate. So reinvestment rate assumptions and finance rate. So reinvestment rate means return on invested capital, right? Return on reinvested cash inflow, and finance rate is the cost of capital. So this formula we have to use: future value of inflow divided by present value of outflow to the power 1 upon n minus 1. So future value of inflow at the reinvestment rate, present value of outflow at the finance rate, and n is the project life. So this will give us the MIRR. Now comes the decision rule. See, again the simple thing: if MIRR is greater than the RRR, accept the project like we did in the IRR, and if MIRR is less than RRR, which is the required rate of return, then reject it. Now question is why it is better. If you talk about the pros here, advantage here, because it will eliminate the concept of multiple IRR. In the case of IRR, if it is non-traditional cash flow, we used to get multiple IRR. It often confuses us, but this confusion is totally eliminated by using MIRR, which does not have multiple IRR, and it offers realistic return assumption. It is perfect for project with non-conventional cash flow, but be aware there are some limitations also. It is more complex than IRR. It depends heavily on assumed reinvestment rate. So basically, in short, we can say this MIRR gives you a clearer, more reliable picture of a project profitability, especially when cash flow are uneven or tricky. So that is MIRR. And then we have profitability index. So let's understand the concept of profitability index. So what it is all about, let's understand using this particular diagram. So basically it is a smart tool that help decide, is the project really worth the money we put in? It is called profitability index, right? What is PI? So PI show you the cost benefit relationship of a project. How to calculate it? You can see the formula here. Present value of future cash inflow means whatever future cash inflow you will receive, find the present value and divide by the initial investment. That's it. We can also know, it is also known as a value investment ratio upon profit investment ratio or profit investment. So both are the name of this profitability ratio. Either you call it value investments. What you do, you see you have a future cash, you have the future cash inflow, you find their present value, right? You write in the numerator divided by the initial investment, and that is what you will get PI, right? Profitability index. Now profitability index concept is clear, I think, right? So how to interpret it? Suppose I get the PI, how to interpret it? See, if PI is greater than 1, it means we should accept the project because it is profitable, and if PI is less than 1, we should reject the project because it is not adding value. And if PI is equal to 1, it means it is break even, neither gain nor loss, right? So this is the importance of profitability index. And if we look at the application, so it is used in capital rationing. What is capital rationing? When funds are limited and only the best project must be chosen, that is called capital rationing. And for project selection also, PI is helpful, especially when comparing multiple opportunity. So to summarize about this profitability index, let me tell you that this profitability index help business prioritize project wisely, ensuring every rupee invested bring more value in return. because in the denominator you're writing how much investment you have done, and in the numerator you are seeing the present value of all the future cash flow. So basically what you are doing, you are seeing that whatever rupee you, right, it is a smart way to evaluate the investment risk. So if we have to evaluate the investment risk, we have a very good model that is called Hilliard's model. So let's try to understand. When making investment decision, one key question that arises: how risky are the expected cash flow? Yes, obviously, how risky are the expected cash flow? This is one of the key questions that arise. That is where Hilliard's model, which was developed by Professor F.S. Hilliard, right? So this Hilliard's model developed by Professor F.S. Hilliard at Stanford, right, comes into picture. So have a look at the core concept of it. On the left hand side you will see the core concept. So this model uses a standard deviation of what? Cash flow, cash inflow, not cash flow, cash inflow. I told you now, it is a model to evaluate the investment risk, right? It asks how risky are the cash flow, are the expected cash flow. So we have cash inflow because we have make an investment, so obviously we will have cash inflow, right? Why we make investment? To have a cash inflow. So what it does, it for those cash inflow, it uses the standard deviation. I think you know what is how to calculate the standard deviation of cash inflow. We have discussed in detail in AVM and BFM, right? So it uses the concept of standard deviation of the cash inflow to estimate the risk. Simple meaning: higher sigma means greater uncertainty and higher risk. Lower sigma means more predictable cash flow and lower risk. Simple it is. If a standard deviation is higher, it simply means uncertainty is higher, it simply means risk is higher. And if sigma is lower, means that if standard deviation is lower, it means we have more predictable cash flow and we have lower risk. So I hope this makes sense to you. You are already familiar with this concept of a standard deviation. Now then comes, we have perfectly correlated cash flow. Very, very important. See what is the meaning of perfectly correlated cash flow? If all the future cash flow move in the same direction over the time. I think you know what is the meaning of correlation. Two things are correlated. If suppose one thing move in one direction, other thing also move in the other factor also move in the other direction, in the same direction, then they are called perfectly correlated. So perfectly correlated cash flow means if all the future cash flow move in the same direction over the time, so they are called perfectly correlated. And this model assume the same risk pattern continues year after year. That means all cash flow behaves similarly over the year. That is what this model assume, right? It assumes that the same risk pattern continue year after year, right? So this is called perfectly correlated cash flow. And what about uncorrelated cash flow? Yes. For uncorrelated cash flow, on the other hand, if each year cash flow behave independently, so they are called uncorrelated. There is no correlation between the previous year cash flow and this year cash flow. They are called uncorrelated. And had there been any correlation, then it is called perfectly correlated. So in the case of uncorrelated cash flow, the Hilliard's model treat risk dispersion separately for every year of the project. So risk dispersion treated separately. So different approach for perfectly correlated approach and uncorrelated approach. And here is the formula. As you can see, for perfectly correlated NPV, that is called net present value. I think you are familiar with this formula. Summation of CT upon 1 plus I whole to the power T minus I, initial investment. And sigma NPV is given by summation of sigma T upon 1 plus I whole to the power T. Simple formula. What about uncorrelated? For uncorrelated, we have sigma NPV is equal to sigma T2 upon 1 plus I whole to the power 2T. Right, so this is the formula. So formula will not be asked, but you should know what is the meaning of CT. CT means expected cash flow over the year T. Sigma T is the standard deviation of year T. Risk free rate is small I. Initial investment is capital I, and project life is small n. Small n is the project life. Right, so this is the formula. It formula incorporate standard financial variables. So whether your cash flow are tightly linked or it fluctuate randomly, the Hilliard's model help quantify the risk so that investor can make better data driven decision. Obviously what it does, it is quantifying the risk. When I calculate sigma means a standard deviation, which means how much our data is varying from the mean. That is what a standard deviation tells you, right? How much it is varying from the mean, how much diversion is there from the mean. So diversion means what? It shows you the risk, right? If it follow the pattern, then it's no issue, but if there is deviation, it means there is a issue, and that is highlighted by this sigma. right? So this Hilliard's model help you quantify the risk so that investor can make better decision. I told you now, Hilliard's model is all about, how risky are the expected cash flow, and that is what it shows in the investment decision. So I hope every concept regarding the Hilliard's model is clear now. No any confusion. Very good. Now friends, have a look at this risk adjusted discount rate. Very important concept from examination point of view. So when evaluating investment under uncertainty, not all projects carry the same level of risk, right? So suppose you are evaluating investment under uncertainty, so all project does not carry the same level of risk. That is where risk adjusted discount rate or RADR comes into picture. It is a very powerful tool that adjusts your discount rate to match the perceived project specific risk. So first of all, have the concept. So the concept, as you can see in the bottom, I have written, this is the concept. So it is noted by RADR. RADR is essentially a tailored discount rate. It is a tailored discount rate used in the net present value calculation. I think you know what is net present value calculation. We have already covered in the previous lecture. So in NPV calculation, there is something called discount rate which is used, and this discount rate is used for discounting the future cash flow to the present value, right? So this RADR is used as a discount rate in the net present value calculation. It factors in not just the time value of money, but also the additional risk of a specific project. The beauty of the NPV that it takes time value of money into consideration, and also so far as RADR is concerned, it takes time value of money into consideration, but in addition to that, it also takes the additional risk of a specific project. How? So let's have a look at the formula, and it will be very much clear. So this is the formula: RK is equal to I plus N plus DK. So what is I? I is the risk free rate. That means the rate of government bond. Suppose you invest in the government bond, whatever rate you get, that is I. That is I. That is called risk free rate. Then what is N? N is the normal business risk premium. What does it mean? Obviously it means that since you are investing in a riskier project, so obviously you will demand some premium, right? So that is called risk premium. And what is called DK? DK is the differential risk specific to the project. Yes, I told you now, different project, different risk. So that differential risk is projected by this DK. So the sum of a risk free rate plus normal business risk premium plus DK, it gives you the risk adjusted discount rate. So I told you now, it takes time value of money into consideration, and also the specific project specific risk. Now have a look at the benefits. So what are the benefits of having these methods? So on the left hand side you can see the benefit. The first benefit is that it aligns project valuation with the risk perception. Very important. It enables comparison across diverse. Suppose we have many different projects and we want to compare them. So every project will have different DK, so we can easily compare at types and risk level, and also it helps the decision maker apply a structured approach to the risk evaluation. But there are some limitations also. What are the limitations? First limitation is that the DK value is very hard to estimate and can be subjective. It is not objective, it can be subjective. For many different cases, different DK value can be there. And also it assumes that risk remain constant over the time, which is rarely the case. Do you think that risk remain constant over the time? No. It does not remain constant over the time. So this is one assumption that this particular model make, and this is the limitation of it. And also this model does not work well for rapidly evolving or highly volatile project. So you know very well that some projects are highly volatile. For those highly volatile projects, this model will not work, right? So these are the limitation. So every aspect should be clear. What are the benefit? What are the limitation? This is the peculiarity of this crash course, where we try to provide every information in a single page in the format of flowchart. In every unit you will see such kind of PDF, which will help you in final revision. You did not go through the lines of books, underlining every points, remembering every times again. No, just skim through this particular PDF and everything will be clear. Now have a look at the risk factor. RADR is very useful for greenfield project, right? Project in a volatile market, take innovation or innovative understanding. And if you look at the application, very important thing, see, firm use RADR to decide whether to accept a project or to reject it. How? See, if NPV is greater than 0, because this RADR, that is the risk adjusted discount rate, is used to calculate NPV, and suppose I calculate NPV and it is greater than 0, so I will accept the project. And obviously if risk is higher, RK will be higher, because RK is directly proportional to the risk. So NPV will be lower, because net present value is inversely proportional to the risk adjusted discount rate. And second thing is that if you talk about the real world example, so a company like Reliance apply it to replacement. So it means lower RK. Expansion means modeling
In business, every decision matter, and making the right decision start with focusing only on what is relevant. Welcome to Relevant Costing, a framework that helps manager eliminate noise and concentrate on costs that truly affect the decision. Right. So step number 1 is to identify the decision. Means before analyzing any number, define the decision at hand. Be it price. So step number 1, we identify the decision. Step number 2, we identify the relevant cost concept, which means relevant costs are future oriented and avoidable. So this includes what includes under relevant cost? It includes future cost, it includes differential cost, it includes avoidable cost. So these are the costs that will change depending on the decision you make. Right, that's why they are called relevant cost, because if you change your decision, obviously the cost will also change. Future cost, differential cost, avoidable cost, these are the part of relevant cost. On the flip side, we have irrelevant cost, which are like sunk cost, which are like past or we can say sunk cost or past expenses which have already committed, so they won't be recovered, they won't change, and should never influence your decision making. Suppose for example you buy a TV at 25,000 rupees, right? So tell me, 5 years ago you bought it, so will that change for if you for your to the context of your current decision? No, it will not change. The price will remain the same. So that cost of 25,000 is irrelevant. It is called sunk cost. It is called unavoidable cost. It cannot be avoided, right? So if you change your decision, it will not affect. It will have no effect on that cost. So that won't be recovered. That is the main point. That won't be recovered or changed and should never influence your decision making. So that's why to this relevant cost concept, we divide into two parts: relevant cost, irrelevant cost. An example is given like sunk cost, past cost, unavoidable cost. And don't forget the opportunity cost. So if you are working with a scarce resource, consider what you are giving up. That is your opportunity cost, the potential gain from the next best alternative, right? That is called alternative cost, opportunity cost. See, a scarce resource you are working, opportunity cost will be there. If you are not working with scarce resource, no opportunity cost. So basically what are the benefits is that it filters out the irrelevant data, it highlights the true cost implication. It is very vital for pricing, investment and strategic choice. So basically the moral of the story is that by focusing on what really matter, that is called relevant cost, you empower yourself to make smarter, sharper and more strategic decision. And this relevant cost concept is super helpful in we are just going to discuss that activity based costing. Yes, in activity based costing this relevant cost plays a super important role, ABC based costing. So let's understand this ABC based costing also, what it is all about. In today's competitive world, accurate cost information is foundation of smart business decision. Obviously, if you don't have accurate cost information, you can't take a smart business decision, and that is where ABC, activity based costing, steps in. So what is ABC? Let's understand. So ABC is a method of assigning cost to a product, to a services or to customer. So what we do in ABC, we have service, we have methods, we have product, we have customer, right? We assign cost to them based on the actual activity they consume, right? Based on what? Actual activity they consume. So there is the second method is called traditional costing. Unlike traditional costing, it is not about spreading cost evenly, it's about precision. ABC definition is all about precision. Precision, hitting the bullseye, that is called precision, right? So basically what we do, we assign cost to product, we assign cost to services, we assign cost to customer based on the actual activity they consume, right? So ABC costing helps to us to answer some question like what are we really spending, where are we really spending money, which customer or product are driving the cost. If you look at the core concept behind this ABC costing, first thing is that cost object. Cost object means what you are calculating the cost for, like a product or a service, for which thing you are calculating the cost. Second thing is cost pool. Means pool, grouping. Whenever you see this word pool, it means grouping. So grouping of similar cost tied to a specific activity is called cost pool. Then we have cost driver. Driver means activity that cause the cost, like machine hour. Machine hour may cause the cost, inspection may cause the cost, order process may cause the cost. So cost object means what you are calculating the cost for, like you are calculating for a product or service, these are called object. Cost pool means group of activity, group of similar cost tied to the specific activity. And cost driver means what drive the activity that cause the cost, like machine hour, inspection, order process,
right? Then we have, if you look at the cost of type of cost driver, means the activity that cause the cost. It may be resource cost driver, like it measures how much resource is used, like time, labor, that is a kind of resource. Or it can be activity cost driver, it measures the frequency or intensity of the activity. So what are the steps under ABC method? First of all, we write the object, we define the cost object. I told you cost of the object means item that require cost measurement, right? What we are calculating cost for. First of all, we identify the object or cost, then we list all the activities, right? We map resource cost to each activity, that this activity will cost this much, this activity will cost this much, and then we allocate support cost via cost driver and calculate the total cost per object. The formula is very simple, that activity cost driver rate is equal to total cost of activity divided by activity driver quantity. So this is the formula that we use. What are the benefits of ABC costing? First benefit is that accurate cost tracking. So accurate cost tracking, improve project process efficiency, better pricing, better outsourcing decision, enhance customer and product profitability analysis. So example is given. For example, in a quality control department, costs should not be spread equally across product. So ABC assigning a cost based on actual uses like time, inspection, rework, giving a true picture. It's not like that you have spread the cost equally across all product. No, every product they consume different time, they have different inspection, they have different rework. So that's why you should assign cost based on actual usage. Now if you compare ABC costing versus traditional costing, so in traditional costing is volume based, means using units, but ABC costing is activity based, using effort and time. So result is that ABC costing is more meaningful, more actionable cost insight. Friends, if you want to practice numerical based on ABC costing, we have available in our question bank and also in our crash course. Separate videos are there to make you understand how to utilize this ABC costing methods using problem. We है कि मॉडर्न डे बैंकिंग की इंपॉर्टेंट कंपोनेंट है इंडियन फाइनेंशियल सिस्टम का इकोनॉमिक डेवलपमेंट के लिए, और फाइनेंशियल सेक्टर क्रिटिकल रोल प्ले करती है ऑप्टिमल एलोकेशन और यूटिलाइजेशन ऑफ फाइनेंशियल रिसोर्सेज। मैनेजमेंट के अंदर स्किल ऑर्गेनाइज करना है, एंटरप्रेन्योरशिप और दोस्तों टीम मेंबर से बेस्ट लाना, ये होता है। मैनेजमेंट के थ्योरिस्ट की बात करें तो हेनरी फेयोल को माना जाता है मॉडर्न मैनेजमेंट थ्योरी के फाउंडर। फ्रेडरिक विल्सन टेयर ने मेथड इंट्रोड्यूस किया ताकि इंडस्ट्रियल एफिशिएंसी को इंप्रूव कर सकें। जो बुक का नाम है प्रिंसिपल ऑफ साइंटिफिक मैनेजमेंट, ये टेलर के द्वारा लिखा गया। इसे मोस्ट इन्फ्लुएंशियल मैनेजमेंट बुक माना जाता है 20th सेंचुरी का। पीटर ड्रकर फेमस मैनेजमेंट गुरु हैं और उनका बुक मैनेजमेंट टास्क रिस्पॉन्सिबिलिटी प्रैक्टिस वाइडली रेट किया जाता है। मैनेजमेंट प्रोसेस की बात करें तो मैनेजमेंट एक सोशल प्रोसेस है जिसके अंदर रिलेशनशिप और कोऑपरेशन होता है लोगों के बीच में और उसके टीम एफर्ट के बीच में। ये एक कंटिन्यूस प्रोसेस है जो कि अडेप्ट करता है बहुत सारे डेवलपमेंट को अलग अलग फ्रंट्स पे। मैनेजमेंट टास्क को डिवाइड किया जाता है बहुत सारे पार्ट्स या सब एक्टिविटीज़ में ताकि उनके सिग्निफिकेंस को अच्छे से समझ सकें। मैनेजमेंट की फंक्शन की बात करें तो प्लानिंग होता है पहला। प्लानिंग के अंदर आप फ्यूचर एक्शन पे डिसाइड करते हैं। सो फ्रेंड्स, प्लानिंग में क्या होता है, लेट्स सी द प्लानिंग, व्हाट हैपन प्लानिंग। तो प्लानिंग में क्या होता है, फ्यूचर एक्शन पे डिसाइड करते हैं जो कि ऑर्गेनाइजेशन ऑब्जेक्टिव के इन लाइन होता है। ऑर्गेनाइजिंग में आप स्ट्रक्चरिंग करते हैं और अरेंज करते हैं रिसोर्सेज को ताकि ऑर्गेनाइजेशन के ऑब्जेक्टिव को अचीव कर सकें। स्टाफिंग में रिक्रूटिंग, सेलेक्टिंग, ट्रेनिंग, डेवलपिंग, मोटिवेटिंग एंड कॉम्पेंसेटिंग एम्प्लॉयज़। डायरेक्टिंग में दोस्तों सबऑर्डिनेट्स के एक्टिविटीज़ को गाइड करना, सुपरवाइज करना, इसके अंदर लीडरशिप, मोटिवेशन, कम्युनिकेशन, सुपरविजन, ये सभी आते हैं। कंट्रोलिंग में दोस्तों मॉनिटर करना और परफॉर्मेंस को मेजर करना, कंपेयर करना इसे स्टैंडर्ड के साथ, ये सभी आते हैं। दोस्तों नेक्स्ट पॉइंट में आप बात करते हैं मैनेजमेंट की इंपॉर्टेंस को। तो सबसे पहला है कि ये हेल्प करता है किसी ऑर्गेनाइजेशन को ट्रांजिट करने में गुड टू ग्रेट। दोस्तों नेक्स्ट है हमारा ग्रुप टास्क अचीव करना, यानी ये इंप्रूव करता है डिसीजन की क्वालिटी को और डिपार्टमेंट के कवर कंट्रोल को ताकि ग्रुप के गोल को अचीव कर सकें। तीसरा है कि आप रिसोर्सेज को एफिशिएंटली एलोकेट करते हैं ताकि एफिशिएंट यूटिलाइजेशन अचीव कर सकें। दोस्तों नेक्स्ट है कि ह्यूमन अंडरस्टैंडिंग को समझना, कोऑर्डिनेशन को समझना, म्यूचुअल रिस्पेक्ट और ट्रस्ट को समझना। दोस्तों नेक्स्ट पॉइंट है कि मैनेजमेंट कैसे हेल्प करता है, ऑलराउंड डेवलपमेंट ऑफ ह्यूमंस। ये बेटर स्ट्रक्चर करता है ऑर्गेनाइजेशन को अथॉरिटी, रिस्पॉन्सिबिलिटी, जॉब फिट डिफाइन करके। दोस्तों ये डायरेक्शन प्रोवाइड करता है ताकि गोल अचीव कर सके, रोड मैप फॉलो कर सकें। फिर दोस्तों अब हम लोग मैनेजमेंट थॉट्स एंड अप्रोच की बात करते हैं। तो पहला है क्लासिकल। देखिए एक तरफ क्लासिकल और ट्रेडिशनल स्कूल है, तो इसका साइलेंट फीचर क्या है दोस्तों, ये एम्फेसाइज करता है टेक्नोलॉजी पे ताकि एम्प्लॉय की एफिशिएंसी को बढ़ा सकें। ये फोकस करता है ऑर्गेनाइजेशन और सेंट्रलाइजेशन पे। इसका एम्फेसिस होता है प्रोडक्शन पे। जो कंसंट्रेशन होता है दोस्तों एरर पे होता है, उसके रेक्टिफिकेशन पे होता है। ये एज्यूम करता है एम्प्लॉय की कंटिन्यूटी को, चाहे ऑर्गेनाइजेशन चेंज हो भी जाए। दोस्तों ये अकाउंटिंग मॉडल पे बेस्ड है। ये दोस्तों डिफरेंट टाइप्स ऑफ जॉब और एम्प्लॉय को इक्वल वेटेज देता है। तो इसे कहते हैं हम लोग क्लासिकल और ट्रेडिशनल स्कूल्स थ्योरी।
सो फ्रेंड्स, लेसन को आगे बढ़ाने से पहले यदि आप CIB 2023 की तैयारी कर रहे हैं तो आप हमारे स्टडी मटेरियल का हेल्प ले सकते हैं अपनी तैयारी को और अच्छा बनाने के लिए। सो फ्रेंड्स, वी आर ऑफरिंग MCQs PDF। ओके, आपको यदि MCQs की रिक्वायरमेंट है, स्टडी मटेरियल की रिक्वायरमेंट है दोस्तों, इन फॉर्म ऑफ PDF दैट वी आर प्रोवाइडिंग, यू कैन टेक हेल्प ऑफ द MCQ PDF। वी हैव ओवरऑल 2000 to 3000 MCQs पर सब्जेक्ट। पर यूनिट वी हैव 150 to 200 MCQs विच कवर ईच एंड एवरी आस्पेक्ट रिलेटेड टू अ पार्टिकुलर यूनिट। एंड इसके अलावा दोस्तों, यदि आपको वीडियोस चाहिए, वीडियो एक्सप्लेनेशन की रिक्वायरमेंट है, देन यू कैन ऑप्ट फॉर आवर स्टडी प्लान, डिटेल्स रिगार्डिंग विच यू कैन सी ऑन दिस स्लाइड। फ्रेंड्स, आगे बढ़ते हैं हम लोग, नेक्स्ट पॉइंट को स्टडी करते हैं। नेक्स्ट पॉइंट दोस्तों बताया जा रहा है कि न्यू क्लासिकल या बिहेवियरल स्कूल ये मोटिवेशन में फोकस्ड होता है। बहुत सारे लोग अलग अलग तरीके से मोटिवेट होते हैं अपने स्पेसिफिक नीड को सेटिस्फाई करने के लिए। कम्युनिकेशन क्रिटिकल इनपुट होता है एफिशिएंसी के मेजरमेंट का। टीम वर्क जरूरी होता है ऑर्गेनाइजेशन के परफॉर्मेंस के लिए। दो डिफरेंट पर्सपेक्टिव है, ह्यूमन रिलेशन पर्सपेक्टिव और दोस्तों फिजियोलॉजिकल पर्सपेक्टिव। दोस्तों बताया जा रहा है कि जो डॉगलास मैक्ग्रेगर एक्शन वाई थ्योरी है, इसमें थ्योरी एक्स का मतलब क्या होता है कि ह्यूमन जो है बिना क्लोज सुपरविजन का काम नहीं करते, अब प्रीफर करते हैं कि वो लेड हो जाए या डायरेक्टेड हो किसी दूसरे से। थ्योरी वाई क्या एज्यूम करता है कि ह्यूमन जो है काम करना अच्छा पसंद करते हैं और वो कोशिश नहीं करना चाहते दूसरे के द्वारा फॉर अचीविंग द ऑर्गेनाइजेशन गोल। सो फ्रेंड्स, ये हमारा डॉगलास मैक्ग्रेगर थ्योरी है, होपफुली आपको क्लियर हुआ होगा। नेक्स्ट पॉइंट बताया जा रहा है दोस्तों मोटिवेशन हाइजीन थ्योरी। मोटिवेशन फैक्टर जैसे चैलेंजिंग वर्क, रिकॉग्निशन, रिस्पॉन्सिबिलिटी, ये सभी पॉजिटिव से सेटिस्फैक्शन देता है। जबकि हाइजीन फैक्टर जैसे स्टेटस, जॉब सिक्योरिटी, सैलरी, फ्रिंज बेनिफिट, ये दोस्तों मोटिवेट नहीं होता है यदि प्रेजेंट होगा, और यदि एब्सेंट होगा तो डिमोटिवेशन आता है। दोस्तों नेक्स्ट थ्योरी हमारा क्वांटिटेटिव स्कूल और मैनेजमेंट साइंस थ्योरी। यहाँ पे दोस्तों मॉडल क्रिएशन, थ्योरी क्रिएशन, हाइपोथेसिस क्रिएशन होता है। यहाँ पे एम्पिरिकल डेटा का कलेक्शन होता है। उसके बाद दोस्तों यहाँ पे मैथमेटिकल और स्टैटिस्टिकल मॉडल का डेवलपमेंट होता है, डेटा एनालिसिस, एक्सपेरिमेंटेड इन कंट्रोल इन्वायरमेंट, टेस्टिंग विद चेंजेस इन वेरिएबल, डेवलपमेंट ऑफ वेरियस इंस्ट्रूमेंट, ये सभी इसके पार्ट्स हैं। जरा बात करें दोस्तों सिस्टम स्कूल ऑफ मैनेजमेंट की, तो मैनेजमेंट एक ओपन सिस्टम है, इसको इंटरेक्ट करना होता है एनवायरनमेंट के साथ कॉन्स्टेंटली, ताकि आपको रिसोर्सेज मिल सके जो कि वेरिएबल भी है, वैल्यूएबल भी है और लिमिटेड भी है। दोस्तों कॉन्टिजेंसी स्कूल ऑफ मैनेजमेंट थ्योरी बताता है कि कोई यूनिक वे नहीं है किसी ऑर्गेनाइजेशन को मैनेज करने का। बहुत सारे लीडर्स जो है सेम सिचुएशन को अलग अलग तरीके से डील करते हैं उनके लीडरशिप स्टाइल के बेसिस पे। दोस्तों TQM और लर्निंग ऑर्गेनाइजेशन की जो डिफरेंस बताया जा रहा है कि TQM का फोकस होता है कि हाई क्वालिटी गुड्स और सर्विसेज डिलीवर करे अपने कस्टमर को। सो फ्रेंड्स, TQM के अंदर क्या होता है आपको समझ में आया? TQM के अंदर क्या होता है दोस्तों कि हम हाई क्वालिटी गुड्स और सर्विसेज अपने कस्टमर को ऑफर करते हैं। इसके अंदर 4 मेन एलिमेंट्स होते हैं, एम्प्लॉय इन्वॉल्वमेंट, कस्टमर फोकस, स्टैंडर्डाइजेशन, कंटिन्यूस मॉनिटरिंग। दोस्तों जो कंट्रीब्यूटर हैं इनके कौन कौन से हैं TQM के? डेमिंग, जोरान, क्रॉसबाय। 14 प्रिंसिपल्स हैं, कंसिस्टेंसी ऑफ पर्पस, एडॉप्शन ऑफ न्यू फिलॉसफी, सीजिंग डिपेंडेंस ऑन इंस्पेक्शन, स्टॉपिंग लोएस्ट बिड सिस्टम, इंट्रोडक्शन ऑफ ऑलराउंड डेवलपमेंट, इंस्टीट्यूट ऑन द जॉब ट्रेनिंग, इंस्टीट्यूट लीडरशिप, ड्राइविंग आउट फियर। इसके अलावा और भी 5-6 पॉइंट्स हैं। दोस्तों लर्निंग ऑर्गेनाइजेशन का फोकस होता है कि कंटिन्यूसली इन्हांस करें ग्रो करने की कैपेसिटी को। दोस्तों 5 डिसिप्लिन है इसके अंदर, पर्सनल मैस्टरी, शेयर्ड विजन, मेंटल मॉडल और दोस्तों टीम लर्निंग। कंट्रीब्यूटर है पीटर सेंगे। फिर दोस्तों क्या बताया जा रहा है नेक्स्ट पॉइंट में कि आप देखिए बिजनेस मॉडल क्या है, एग्जांपल दिया हुआ है कंपनी का डिस्क्रिप्शन, जैसे सॉल्यूशन प्रोवाइडिंग IBM, यानी कंसल्टिंग सर्विस ऑफर करती है ताकि क्लाइंट ऑपरेशन को इम्प्रूव कर सके। प्रॉफिट पिरामिड में दोस्तों एग्जांपल है जनरल मोटर्स। जनरल मोटर स्टार्ट होता है लो प्राइस प्रोडक्ट से और ग्रेजुअली मूव करता है हाई प्राइस प्रोडक्ट में हायर प्रॉफिट के लिए। नेक्स्ट है बिजनेस मॉडल हमारा मल्टी कंपोनेंट। इसका बेस्ट एग्जांपल है जिलेट या HP। इसमें क्या होता है दोस्तों कि लो कॉस्ट या नो प्रॉफिट प्रोडक्ट को ऑफर करते हैं ताकि आप हायर मार्जिन प्रोडक्ट को सेल कर सकें। एडवर्टीजमेंट बिजनेस मॉडल की बात करें तो इसका कंपनी का एग्जांपल है यूट्यूब या गूगल। तो ये क्या करती है दोस्तों, बेसिक प्रोडक्ट ऑफर करती है फ्री पे और रेवेन्यू अर्न करती है एडवर्टीजमेंट से। स्विच बोर्ड मॉडल की बात करें तो इसका एग्जांपल है eBay या अमेजॉन या फ्लिपकार्ट। ये इंटरमीडिएटरी के रूप में काम करती है ताकि मल्टीपल सेलर को मल्टीपल बायर के साथ कनेक्ट कर सकें। दोस्तों टाइम मॉडल की बात करें तो यहाँ सक्सेस डिपेंड करता है कि मार्केट में पहले कैसे रहें। एफिशिएंसीज की बात करें तो साउथ वेस्ट एयरलाइन, वालमार्ट, डेल, तो ये दोस्तों ये वेट करती है मार्केट को मैच्योर होने के लिए और तब लो कॉस्ट लो मार्जिन प्रोडक्ट के साथ इंटर करती है। ब्लॉकबस्टर मॉडल की बात करें तो फार्मा, फिल्म इंडस्ट्री, ये डिपेंड करती है प्रोटेक्शन अंडर पेटेंट लॉ। प्रॉफिट डिपेंड करता है कुछ आइटम्स पे और स्टार अपील पे। प्रॉफिट मल्टीप्लायर में वाल्ट डिज्नी है, ये डेवलप करता है कंसेप्ट को फॉर ड्राइविंग अदर प्रोडक्ट और सिनर्जी लुकिंग एट द होल प्रोडक्ट। दोस्तों नेक्स्ट पॉइंट की बात करते हैं स्ट्रेटजिक मैनेजमेंट के एलिमेंट्स की। सबसे पहला है कॉन्टेक्स्ट। एक प्रोसेस होता है स्ट्रेटजिक मैनेजमेंट की, आप एनालाइज करते हैं एक्सटर्नल और इंटरनल एनवायरनमेंट किसी ऑर्गेनाइजेशन का। मिशन होता है दोस्तों क्या है, विजन क्या है, क्लाइंटली क्या है, यानी टारगेट मार्केट क्या है, रिसोर्सेज क्या है दोस्तों, प्रेजेंट एंड फ्यूचर क्या है, कैसे प्लान करेंगे। फिर स्ट्रेटजीज क्या होगी, एक फ्लेक्सिबल ब्लूप्रिंट होगा, एक आइडिया होगा। फिर दोस्तों कॉर्पोरेट स्ट्रेटजीज, एक कॉर्पोरेट एक कैटेगरी ऑफ स्ट्रेटजी होता है जो कि कवर करता है जो ओवरऑल डायरेक्शन कंपनी फॉलो करेगी। बिजनेस स्ट्रेटजी एक स्ट्रेटजी होता है जो प्रिपेयर किया जाता है दोस्तों बिजनेस के यूनिट के लेवल पे। फंक्शनिंग स्ट्रेटजी एक अप्रोच होता है जो कि फंक्शनिंग एरिया के अंदर अडॉप्ट किया जाता है। दोस्तों बात करें फेजेस ऑफ स्ट्रेटेजिक मैनेजमेंट की, सबसे पहला होता है बेसिक बजटरी प्लानिंग। इसमें क्या होता है कि एनुअल बजटिंग या फाइनेंशियल प्लानिंग एक्सरसाइज होता है। जो सेल्स मैनेजर या दूसरे मैनेजर हैं वो व्यूज प्रोवाइड करते हैं कि कैसे बिजनेस एनवायरनमेंट में चेंजेस आ रहे हैं। फोरकास्ट बेस्ड प्लानिंग में एक्स्ट्रापोलेशन टेक्निक को यूज़ किया जाता है प्रेडिक्शन के लिए। दोस्तों एक्सटर्नली ओरिएंटेड की बात करें, जो टॉप मैनेजमेंट है वो स्ट्रेटेजिक प्लानिंग प्रोसेस को कंट्रोल करते हैं। फॉर्मल स्ट्रेटजी को फॉर्मुलेट किया जाता है एक्सटर्नल हेल्प के माध्यम से। स्ट्रेटेजिक मैनेजमेंट का बेस्ट एग्जाम्पल है जनरल इलेक्ट्रिक। यहाँ पे स्ट्रेटेजिक प्लानिंग का ये जो जनरल इलेक्ट्रिक है ये स्ट्रेटेजिक प्लानिंग के पायनियर है। दोस्तों इनमें इन्फॉर्मेशन और स्ट्रेटेजिक प्लानिंग अवेलेबल करवाया जाता है बिजनेस एंटिटी के हर एक लेवल को। स्ट्रेटेजिक मैनेजमेंट का बेनिफिट क्या है कि आपको क्लियर सेंस ऑफ स्ट्रेटेजिक विजन प्रोवाइड करता है। मैनेजमेंट को अलाउ करता है कि वो स्ट्रेटेजिकली इंपॉर्टेंट इशू पे फोकस करे। दोस्तों हम यूनिट 2 चलिए, यूनिट 1 को कंप्लीट किया हमने, यूनिट 2 पे आते हैं। प्लानिंग में स्टेप क्या है दोस्तों? अपॉर्चुनिटी एनालिसिस, ऑब्जेक्टिव एस्टैब्लिशमेंट, डेवलपिंग प्लानिंग प्रीमाइसेस, alternative identification, evaluating alternatives, selecting the best alternative, formulating derivative plan. So these are the steps involved in the planning. So all the thing that you are getting here is a simplified version of your Macmillan book. आपके Macmillan book का ये simplified version है that I am explaining you in the simplest manner possible. दोस्तों बात करें फंडामेंटल्स ऑफ प्लानिंग की, तो एक प्रोसेस है आप इंगेज करते हैं थॉटफुल डिस्कशन इससे पहले कि टास्क को अंडरटेक कर सकें। दोस्तों बात करें ऑब्जेक्टिव्स की, तो ऑब्जेक्टिव एनालिसिस ऑफ फ्यूचर रिक्वायरमेंट ताकि फैसिलिटेट कर सके मॉडिफिकेशन ऑफ ऑनगोइंग एक्टिविटीज़ को। दोस्तों बात करें हम एडवांटेज क्या है प्लानिंग का, तो दोस्तों ये हेल्प करता है एफर्ट को कोऑर्डिनेट करने में अलग अलग फंक्शनरीज़ के और डिपार्टमेंट के, ताकि हम गोल को अचीव कर सकें। ये मैनेजर को इनेबल करता है कि वो डिटरमाइन कर सके कि कौन से एक्टिविटीज़ का मैक्सिमम डिमांड है रिसोर्सेज के लिए। ये वेल डिफाइंड गोल प्रोवाइड करता है इंडिविजुअल्स को और कॉन्सेप्ट प्रोवाइड करता है कि क्या कॉमनली उनसे एक्सपेक्ट किया जा रहा है। इसे डिस्टिंग्विश किया जाता है माइल पोजीशन से, जो कि यूज़ किया जाता है प्रोग्रेस को मार्क करने के लिए। दोस्तों एडेप्टेबिलिटी की बात करें तो ये जो प्लानिंग है ये एडजस्ट कर सकता है गाइडिंग प्रिंसिपल को नए इन्वायरमेंट से। दोस्तों बात करें बेसिक एडवांटेज ऑफ प्लानिंग की, तो सबसे पहला है कि प्लानिंग प्रेडिक्शन को आसान बना देता है। प्लानिंग के माध्यम से आप प्रेडिक्शन कर पाते हैं एग्जिस्टिंग इन्फॉर्मेशन से, आप रिस्क को अवॉइड करते हैं, अल्टरनेटिव पाथ को क्रिएट करते हैं ताकि आप एंटिसिपेटेड गोल को अटेन कर सकें। दूसरा एडवांटेज है प्लानिंग जो है बेसिस होता है दूसरे मैनेजमेंट फंक्शन का, इसे आप क्लियर ऑब्जेक्टिव क्रिएट कर सकते हैं। प्लानिंग और कंट्रोलिंग इंटरडिपेंडेंट है क्योंकि प्लानिंग प्रोसेस दोस्तों कंट्रोलिंग प्रोसेस का एक्सटेंशन होता है। प्लानिंग के एडवांटेज की बात करें तो अनसर्टेनिटी कम करना, ऑब्जेक्टिव पे फोकस्ड होना, कंट्रोल फैसिलिटेट करना, ये क्रिएटिविटी इनोवेशन इनकरेज करना, प्रॉब्लम को एंटिसिपेट करना, बोर्ड के साथ काम करना डेस्टिनेशन के लिए। दोस्तों यदि हम डिसएडवांटेज की बात करें तो एक्टिविटी को फोरस्टॉल करता है ये प्लानिंग। उसके बाद लैक ऑफ कंसर्न, फिर दोस्तों हिंडर्स इनोवेटिवनेस, रिजल्ट इन रिजिडिटी, एक्सपेंसिव प्रोसेस, दिस आर द डिसएडवांटेज। एमबीओ की बात करें दोस्तों, नेक्स्ट मैंने बात करते हैं एमबीओ की। इट इज़ गोल ओरिएंटेड ऑब्जेक्टिव, इट इज़ गोल ओरिएंटेड अप्रोच, परफॉर्मेंस रिव्यू थ्रू गोल अचीवमेंट, टाइम कंज्यूमिंग गोल सेटिंग प्रोसेस, डिपेंडेंस ऑन रिवार्ड एंड सैंक्शन, मल्टीटास्किंग इनएफिशिएंसीज। एडवांटेज की बात करें दोस्तों एमबीओ की, तो ये मीन्स प्रोवाइड करता है ताकि गोल को डिटरमाइन कर सकें और प्लान कर सकें उसे अचीव करने के लिए। ये प्रोएक्टिव बिहेवियर को इनेबल करता है और डिसिप्लिन अप्रोच को इनेबल करता है। ये आपको इलेबोरेटिव रिटर्न गोल प्रोवाइड करता है, इसमें रिक्वायर्ड करते हैं सभी एम्प्लॉय को एक साथ काम करें। लिमिटेशन क्या है दोस्तों? ये डिसरिगार्ड करता है ऑर्गेनाइजेशन कल्चर को और वर्किंग कंडीशन को। ज़्यादा इंफेसिस होता है गोल सेटिंग पे देन ऑन ऑपरेशनल इशू। एम्प्लॉय जो है प्रेशराइज फील कर सकते हैं, ये डिसएडवांटेज है। आउटडेटेड गोल जो है हिंडर कर सकता है इनिशिएटिव और क्रिएटिविटी को। लैक ऑफ एम्प्लॉय एंड एप्रिसिएशन इन अंडरटेकिंग, दिस आर द लिमिटेशन। इन्वायरमेंटल एनालिसिस में दोस्तों क्या होता है कि आप इवैल्यूएट करते हैं किसी ऑर्गेनाइजेशन के प्रेजेंट स्टेट को। ये फैसिलिटेट करता है कि आप फ्यूचर के बारे में प्रोजेक्शन कर सकें। दोस्तों इसे यूज किया जाता है ऑर्गेनाइजेशन के गोल को एस्टैब्लिश करने के लिए। एनालिसिस की बात करें तो पहला आता है इन्वायरमेंटल एनालिसिस, इसके अंदर आइडेंटिफाइंग, स्कैनिंग, एनालाइजिंग, फोरकास्टिंग आता है। फैक्टर क्या कंसिडर किया जाएगा तो पेस्टल एनालिसिस, पॉलिटिकल, इकोनॉमिक, सोशल, टेक्नोलॉजिकल, लीगल, एनवायरमेंटल। एडवांटेज क्या है दोस्तों? गोल के अकम्प्लिशमेंट कंट्रीब्यूट करता है, आइडेंटिफाई करता है, एनालाइज करता है पोटेंशियल डेंजर को, हेल्प करता है कि आप डेवलपमेंट को समझ सकें इन कॉमर्शियल इन्वायरमेंट। ये अवेयरनेस क्रिएट करता है कि इम्पेंडिंग डेंजर, ये प्रेडिक्शन बनाता है फीचर्स के बारे में। दोस्तों पेस्टल एनालिसिस क्या करता है कि ये आइडेंटिफाई करता है कि प्रत्येक पेस्टल फैक्टर का क्या रिलेवेंस है किसी फर्म के लिए। ये आइडेंटिफाई करता है, कैटेगराइज करता है इन्फॉर्मेशन प्रत्येक फैक्टर के लिए, एनालाइज करना डेटा और कंक्लूजन ड्रॉ करना। आपको मैंने फुल फॉर्म बता ही दिया, पॉलिटिकल, इकोनॉमिकल, सोशल, टेक्नोलॉजिकल, लीगल, एनवायरमेंटल। चलिए दोस्तों इंटरनल एनवायरमेंट एनालिसिस में फिजिकल रिसोर्स, फाइनेंशियल रिसोर्स, डिस्ट्रीब्यूशन नेटवर्क, पोजीशन ऑफ स्ट्रेटजिक एसेट, नेटवर्क कॉन्ट्रैक्ट विद आउटसाइड ऑर्गेनाइजेशन, ये सभी इंक्लूडेड है। इंटरनल एनवायरमेंट एनालिसिस अलाउ करता है कॉम्प्रिहेंसिव रिव्यू, यानी जो दोस्तों कंपनी के ऑपरेशन के जितने भी एस्पेक्ट हैं सभी को आप कॉम्प्रिहेंसिव रिव्यू कर सकते हैं। दोस्तों इसके ये मैनेजमेंट को इक्विप करता है कि नॉलेज जो कि ज़रूरी है ताकि आप अपॉर्चुनिटी का मैक्सिमम यूज़ कर सकें, स्ट्रेंथ का मैक्सिमम यूज़ कर सकें। इंटरनल एनालिसिस के टूल कौन कौन से होते हैं? तो गैप एनालिसिस होते हैं। गैप एनालिसिस एक टूल होता है कि आप असेसमेंट कंडक्ट कर सकें, क्योंकि ऑर्गेनाइजेशन को एक क्षमता प्रोवाइड करती है कि वैसे एरिया को आइडेंटिफाई करें यहाँ पे परफॉर्मेंस को इम्प्रूव कर सकते हैं। दोस्तों स्ट्रेटजिक प्लानिंग की बात करें तो सिचुएशन एनालिसिस आता है। यहाँ पे आप इंटरनल और एक्सटर्नल एनवायरनमेंट को एग्जामिन करते हैं ऑर्गेनाइजेशन का, ताकि स्ट्रेंथ, वीकनेस, अपॉर्चुनिटी, थ्रेट यानी SWT एनालिसिस कर सकें। स्ट्रेटजिक इवैल्यूएशन के अंदर आउटकम एनालाइज करते हैं किसी स्ट्रेटजिक प्लान का। दोस्तों फिक्सेशन ऑफ ऑब्जेक्टिव में क्या होता है कि आप गोल और ऑब्जेक्टिव को एस्टैब्लिश करते हैं ऑर्गेनाइजेशन के लिए, यानी दोस्तों प्लानिंग प्रीमाइसेस एंड कंस्ट्रेंट में क्या होता है दैट जो प्रोजेक्टिंग वेरिएबल्स है, जैसे कि करंट ट्रेंड इन पॉपुलेशन, पॉलिटिकल एंड इकोनॉमिक क्लाइमेट, कॉस्ट ऑफ प्रोडक्शन, सो दीज आर द प्रोजेक्टिंग वेरिएबल्स। ओके, तो दीज आर फिर है दोस्तों कि हमारा कॉस्ट, प्रॉफिटेबिलिटी, मार्केट एंड सेल्स पोटेंशियल, कॉम्पिटिटिव रिएक्शन, एबिलिटी टू मीट कॉर्पोरेट ऑब्जेक्टिव। सो दीज आर द क्राइटेरियाज फॉर इवैल्यूएटिंग अल्टरनेटिव्स। अल्टरनेटिव को इवैल्यूएट करने के लिए कुछ क्राइटेरिया होती हैं, जिसको मैंने आपको बता रहा हूँ। कॉस्ट हो गया, प्रॉफिटेबिलिटी हो गया। कंटिजेंसी प्लानिंग क्या होता है कि आप एक अल्टरनेटिव प्लानिंग बनाते हैं ताकि अनफॉर्चुन इवेंट को मैनेज कर सकें। फोरकास्टिंग और डिसीजन मेकिंग दोस्तों क्या होता है कि आप प्रेडिक्ट करते हैं, एस्टिमेट करते हैं फ्यूचर को पास्ट और प्रेजेंट एविडेंस के बेसिस पे। फोरकास्टिंग की टाइप की बात करें दोस्तों, ये जो PDF है जिसमें आप सभी चीज़ों को क्विकली रिवाइज कर पाएंगे। सो इफ यू वांट सच टाइप ऑफ PDF काइंडली व्हाट्सएप मी नंबर शोन ऑन द स्क्रीन। नाउ लेट्स डिस्कस टाइप ऑफ फोरकास्टिंग। तो लॉन्ग टर्म फोरकास्टिंग का एडवांटेज है कि स्ट्रेटजिक डिसीजन के लिए क्रूशियल होता है। डिसएडवांटेज है कि ज़्यादा टाइम लगता है, ज़्यादा रिसोर्स लगता है। मीडियम टर्म फोरकास्टिंग इंपॉर्टेंट होता है माइनर स्ट्रेटजिक डिसीजन के लिए। शॉर्ट टर्म फोरकास्टिंग में कम टाइम चाहिए, कम एनर्जी चाहिए, और दोस्तों ये हेल्प करता है कि आप करंट फाइनेंशियल स्टेट को एसेस कर सकें और प्रिवेंटिव एक्शन ले सकें। डिसएडवांटेज क्या है कि टेक्नोलॉजिकल कॉम्प्लेक्सिटी है, और दोस्तों डिफ़िकल्टी होता है कि आप समझ पाएँ पेबल एंड रिसीवर अकाउंट को। डिसीजन मेकिंग की बात करें तो डिसीजन मेकिंग का एडवांटेज है कि रैशनल प्रोसेस है बेस्ड ऑन सिस्टमेटिक एनालिसिस। डिसएडवांटेज क्या है दोस्तों? इंट्यूशन पे बेस्ड नहीं होता है। चलिए यूनिट 3 की बात करें दोस्तों, तो यूनिट 3 में क्या है? ऑर्गेनाइजिंग है। ऑर्गेनाइजिंग का क्या होता है कि आप प्रोसेस होता है आप इस्टेब्लिश करें इफेक्टिव अथॉरिटी रिलेशन बिटवीन टास्क, इंडिविजुअल एंड वर्क प्लेस, ताकि दोस्तों वर्क एफिशिएंटली हो सके। तो इसमें क्या है? ग्रुपिंग एक्टिविटीज़ एंड रिसोर्सेज। फिर ऑर्गेनाइजेशन दोस्तों फाइनल प्रोडक्ट होता है ऑर्गेनाइजिंग प्रोसेस का। इंपॉर्टेंस क्या है और ऑर्गेनाइजिंग का? तो एडमिनिस्ट्रेशन में एडमिनिस्ट्रेटिव एफिशिएंसी, रिसोर्सेज ऑप्टिमाइजेशन, गेनिंग एक्सपर्टाइज, प्रमोटिंग इफेक्टिव कम्युनिकेशन। स्टेजेस की बात करें, सबसे पहले डिफाइन कीजिए, रिव्यू कीजिए प्लान को और कंपनी के ऑब्जेक्टिव को। फिर वर्क एक्टिविटी को डिटरमाइन कीजिए जो कि जरूरी है ऑब्जेक्टिव को एकम्प्लिश करने के लिए। कैटेगराइज कीजिए और ग्रुपिंग कीजिए जो कि जरूरी है वर्क एसेंशियल वर्क एक्टिविटीज़ को मैनेजेबल यूनिट में, यानी आपके पास जो एसेंशियल वर्क एक्टिविटीज़ है उसको कैटेगराइज कीजिए और ग्रुप कीजिए मैनेजेबल यूनिट में। एक्टिविटी असाइन कीजिए और अथॉरिटी डेलीगेट कीजिए। ऑर्गेनाइजिंग प्रोसेस की बात करें तो सबसे पहले टास्क डिटरमाइन कीजिए ऑब्जेक्टिव अचीव करने के लिए। एंड रिजल्ट जो है एक वर्किंग एटमॉस्फेयर होगा जहाँ पे प्रत्येक मेंबर अपने टास्क को समझेंगे। दोस्तों यदि आप ऑर्गेनाइज नहीं कर पाएंगे तो इसी कारण कन्फ्यूजन होगा, फ्रस्ट्रेशन होगा, एफिशिएंसी रिडक्शन होगा। दोस्तों ऑर्गेनाइजेशन की टाइप की बात करें तो एक होता है सेंट्रलाइज और डिसेंट्रलाइज ऑर्गेनाइजेशन। यहाँ पे क्या है कि सेंट्रलाइज ऑर्गेनाइजेशन का डिसीजन मेकिंग पावर होता है टॉप लेवल ऑफ मैनेजमेंट, जबकि डिसेंट्रलाइज ऑर्गेनाइजेशन जो है प्रत्येक डिसीजन मेकिंग पावर को डेलीगेट करती है लोअर लेवल एम्प्लॉय को। लाइन और स्टाफ ऑर्गेनाइजेशन में लाइन ऑर्गेनाइजेशन की रिस्पॉन्सिबिलिटी होती है कि वो ऑर्गेनाइजेशन के ऑब्जेक्टिव को अचीव करे, जबकि स्टाफ ऑर्गेनाइजेशन एडवाइजरी और सपोर्टिव सर्विस प्रोवाइड करता है लाइन ऑर्गेनाइजेशन को। फंक्शनल ऑर्गेनाइजेशन जो है एम्प्लॉय को ग्रुप करता है बाय देयर फंक्शन और एरिया ऑफ एक्सपर्टाइज, यानी वो किस एरिया में एक्सपर्टाइज है उस हिसाब से उसे ग्रुपिंग करता है। कमिटी ऑर्गेनाइजेशन दोस्तों इसके अंदर ग्रुप ऑफ पीपल होते हैं जो कि रिस्पॉन्सिबल होते हैं डिसीजन लेने के लिए। दोस्तों ऑर्गेनाइजेशन स्ट्रक्चर की बात करें तो एक सेंट्रलाइज है, यहाँ पे क्लैरिटी होता है डिसीजन मेकिंग में। डिसएडवांटेज क्या है कि लोकल डिमांड से कम रिस्पॉन्सिव होता है। सेंट्रलाइज में दोस्तों एफिशिएंट इंप्लीमेंटेशन होता है पॉलिसीज़ का और प्रोजेक्ट का। डिसएडवांटेज क्या है कि लिमिटेड स्टाफ इनपुट। डिसेंट्रलाइज ऑर्गेनाइजेशन की बात करें तो इसका एडवांटेज है फास्ट डिसीजन मेकिंग एंड रिस्पॉन्स टाइम। दोस्तों दूसरा डिसेंट्रलाइज का एडवांटेज है दैट इम्प्रूव कैपेसिटी टू एक्सपेंड द कंपनी, स्किल्ड और स्पेशलाइज मैनेजमेंट। दोस्तों डिसएडवांटेज की बात करें कि एक्टिविटी को कोऑर्डिनेट करने में डिफिकल्ट होता है डिसेंट्रलाइज में, एडमिनिस्ट्रेटिव कॉस्ट बढ़ता है, इनकंसिस्टेंटी इन ऑपरेशन। दोस्तों लाइन और स्टाफ में एडवांटेज क्या है? इट प्रोवाइड रिलीफ टू लाइन ऑफ एग्जीक्यूटिव। दूसरा एडवांटेज है कि प्रोफेशनल काउंसिल, बेनिफिट ऑफ स्पेशलाइजेशन, इंप्रूवमेंट इन कोऑर्डिनेशन। यदि हम लाइन और स्टाफ ऑर्गेनाइजेशन के डिसएडवांटेज की बात करें तो फंडामेंटल मिसअंडरस्टैंडिंग होती है, लैक ऑफ रिलायबल गाइडेंस, कॉन्फ्लिक्ट विद लाइन एंड स्टाफ। दोस्तों फंक्शनल ऑर्गेनाइजेशन की एडवांटेज की बात करें तो स्पेशलाइजेशन, एफिशिएंट कंट्रोल, एफिशिएंसी, कॉस्ट इफेक्टिवनेस, एक्सपेंशन। डिसएडवांटेज की बात करें तो कन्फ्यूजन, लैक ऑफ कोऑर्डिनेशन एक्सेट्रा। दोस्तों अब जरा फॉर्मल ऑर्गेनाइजेशन के एडवांटेज की बात करते हैं। ऑर्गेनाइज टास्क होता है दोस्तों, उसके बाद सक्सेसफुल कंप्लीशन होता है, एवॉइडेंस ऑफ डुप्लीकेशन है इसका, फिर दोस्तों हार्मोनी मिलता है इस फॉर्मल ऑर्गेनाइजेशन से, इस्टेब्लिश वन प्लेस। यदि हम बात करें इनफॉर्मल ऑर्गेनाइजेशन की एडवांटेज की तो ये सब नहीं होता है, ठीक है दोस्तों। सक्सेसफुल कंप्लीशन पोटेंशियली अनफेवरेबल इफेक्ट होता है दोस्तों यदि इनफॉर्मल ऑर्गेनाइजेशन होगा, वर्क में एम्फेसिस होना, इफेक्टिव एंड रैपिड कम्युनिकेशन, ये सभी एडवांटेज हैं हमारे फॉर्मल ऑर्गेनाइजेशन के। एक होता है मास्टर चार्ट, एक होता है सप्लीमेंट्री चार्ट। क्या अंतर है? तो मास्टर चार्ट आपको इंटायर फॉर्मल स्ट्रक्चर डिस्प्ले करता है, सप्लीमेंट्री चार्ट आपको इन डेप्थ प्रोवाइड करता है दोस्तों, लिंकेज, अथॉरिटीज़ और रिस्पॉन्सिबिलिटी ऑफ स्पेसिफिक डिपार्टमेंट प्रोवाइड करके। मास्टर चार्ट का क्लासिफिकेशन प्रिपरेशन के लेवल पर होता है, जबकि सप्लीमेंट्री चार्ट दोस्तों बेस्ड होता है कि क्या इन्फॉर्मेशन आप प्रेजेंट कर रहे हैं। दोस्तों वर्टिकल चार्ट की बात करें तो वर्टिकल चार्ट हायरार्की को डिस्प्ले करता है एज पिरामिड, और जबकि सप्लीमेंट्री चार्ट दोस्तों वर्टिकल डिटेल प्रोवाइड करता है स्पेसिफिक डिपार्टमेंट का। इसे टॉप डाउन चार्ट भी कहते हैं वर्टिकल चार्ट को। दोस्तों सोर्स ऑफ अथॉरिटी की बात करें तो लेजिटिमेट अथॉरिटी, यहाँ पे लीगल राइट होता है कि आप कमांड इशू करें जो भी सुपरविजन है उसके अंदर। कोर्सिवनेस में क्या होता है कि फोर्स या थ्रेट को यूज़ करते हैं कॉम्प्लायंस को अचीव करने के लिए। रिवार्डिंग अथॉरिटी में क्या होता है कि आपके पास क्षमता होती है कि रिवार्ड कर सकें, इंसेंटिव प्रोवाइड कर सकें कॉम्प्लायंस को अचीव करने के लिए। एक्सपर्टाइज में दोस्तों स्पेशलाइज नॉलेज और स्किल की रिक्वायरमेंट होती है। अथॉरिटी की बात करें तो फाउंडेशन है चीज़ों को करवाने के लिए, लेजिटिमेसी, डिसीजन मेकिंग, सब्जेक्टिविटी, इम्प्लीमेंटेशन। रिस्पॉन्सिबिलिटी की फॉर्म्स की बात करें तो ऑपरेटिंग रिस्पॉन्सिबिलिटीज, अल्टीमेट रिस्पॉन्सिबिलिटी, दिस आर फॉर्म रिस्पॉन्सिबिलिटीज। कीज इशूज़ कौन कौन से ऑर्गेनाइजेशन स्ट्रक्चर में? टर्नओवर, प्रोडक्टिविटी, प्रोसेस मैनेजमेंट, रोल स्पेसिफिकेशन। ऑर्गेनाइजेशन चेंज की बात करें तो एक्शन जो कंपनी लेती है एक सर्टेन एस्पेक्ट ऑफ ऑर्गेनाइजेशन को मॉडिफाई करने के लिए। दोस्तों 3 प्राइमरी स्टेप होता है, प्लानिंग, इम्प्लीमेंटेशन, फॉलोअप। तो ये जो 3 कैटेगरी होता है ऑर्गेनाइजेशन चेंज का वो है डेवलपमेंटल चेंजेस ड्यूरिंग ट्रांजिशन, ट्रांसफॉर्मेशनल। मैनेजमेंट ऑफ चेंज की बात करें तो एक मेथोडिकल और सिस्टमेटिक स्ट्रेटजी है ताकि ऑर्गेनाइजेशन के ऑब्जेक्टिव को, प्रोसीड्यूर को और टेक्नोलॉजी को एड्रेस कर सकें। रेजिस्टेंट टू चेंज का मतलब क्या होता है कि एक एक्ट है कि रिजेक्ट करना और बैटल करना अगेंस्ट मॉडिफिकेशन। अप्रोच मॉडल की बात करें तो लुईस चेन मैनेजमेंट मॉडल है, इसमें 3 स्टेज है चेंज की, अनफ्रीज, चेंज, रिफ्रीज। मैकेंजी 7 मॉडल है, इसका फोकस होता है 7 इंटरनल स्टेट एलिमेंट ऑफ ऑर्गेनाइजेशन जिसको अलाइन किया जाएगा सक्सेस अचीव करने के लिए। क्वार्टर चेंज मैनेजमेंट प्रिंसिपल है, यहाँ पे 8 फेज हैं जो कि एड्रेस करते हैं पीपल रिएक्शन टू चेंज। नेक्स्ट है दोस्तों नर्स थ्योरी। नर्स थ्योरी कॉन्सेप्ट अप्लाई होता है बिहेवियरल साइंस, इकोनॉमिक्स और पॉलिटिकल थ्योरी में। एडकार मॉडल है, यहाँ पे 5 स्टेप हैं ताकि फैसिलिटेट कर सके सक्सेसफुल चेंज में। अवेयरनेस, डिज़ायर, नॉलेज, एबिलिटी, रीइंफोर्समेंट। ब्रिज ट्रांजिशन मॉडल, यहाँ पे 3 स्टेप है ट्रांजिशन के, एंड, न्यूट्रल जोन, न्यू बिगनिंग। कुबलर रॉस 5 स्टेज मॉडल, यहाँ 5 स्टेज है ग्रीफ का, इसको अप्लाई किया जाता है चेंज मैनेजमेंट में। कॉन्फ्लिक्ट डायनेमिक्स एक कंसेप्ट है जो कि अलग अलग स्टेज ऑफ कॉन्फ्लिक्ट फंडामेंटली अल्टर कर देते हैं इन्वायरमेंट को जिसमें इंटरेक्शन होता है। कॉन्फ्लिक्ट मैनेजमेंट एक प्रोसेस, कॉन्फ्लिक्ट डायनेमिक्स था। कॉन्फ्लिक्ट मैनेजमेंट एक प्रोसेस होता है ताकि कॉन्फ्लिक्ट को रिजॉल्व कर सकें। कॉन्फ्लिक्ट रिजॉल्यूशन के स्ट्रेटजीज होते हैं, यानी सबसे पहले तो आप कॉन्फ्लिक्ट को इग्नोर कीजिए, नेचर ऑफ इशू को एक्सप्लेन कीजिए, एक मीटिंग ऑर्गेनाइज कीजिए अलग अलग पार्टीज़ के बीच में, सॉल्यूशन को आइडेंटिफाई कीजिए, विजिलेंस मेंटेन कीजिए, फॉलोअप कीजिए सिचुएशन का। दोस्तों यूनिट 4 को ये रिवाइज करते हैं। तो स्टाफिंग के अंदर अब एक्टिविटीज़ होता है जैसे कि पर्सनल प्लानिंग, प्रोक्योरमेंट, ट्रेनिंग, डेवलपमेंट एक्सेट्रा। इसका मेन ऑब्जेक्टिव ये है कि अप्रोप्रिएट एम्प्लॉय को असर्टेन कीजिए फॉर द अप्रोप्रिएट पोजीशन, डिज़ाइन कीजिए पॉलिसीज फॉर पर्सनल मैटर। नेचर ऑफ स्टाफिंग की बात करें तो कॉन्सेंट्रेटेड होता है इंडिविजुअल्स पे, ओरिएंटेड होता है डेवलपमेंट के प्रति और ऑल प्रिवेलेंट फंक्शन होता है। दोस्तों एस्पेक्ट ऑफ स्टाफिंग की बात करें तो ऑब्जेक्टिव क्या है स्टाफिंग का, मैंने पहले बताया, नेचर बताया आपको। साइलेंट फीचर स्टाफिंग का ये है कि ये ह्यूमन बीइंग से इन्वॉल्व होता है, डिस्टिंक्ट मैनेजरियल फंक्शन होता है, जरूरी होता है सभी मैनेजरियल लेवल पे, सोशल रिस्पॉन्सिबिलिटी से एसोसिएटेड होता है। फैसेट ऑफ स्टाफिंग की बात करें तो रिक्रूटमेंट, सिलेक्शन, ट्रेनिंग, सिग्निफिकेंस ऑलरेडी डिस्कस्ड। सिस्टम अप्रोच टू स्टाफिंग क्या होता है दोस्तों, इसमें क्या होता है कि कंसिडर्स द इंटरडिपेंडेंसी ऑफ स्टाफिंग कंपोनेंट एंड देयर रिलेशनशिप विद ओवरऑल ऑर्गेनाइजेशन। रिक्रूटमेंट प्रोसेस के स्टेजेस कौन कौन से होते हैं, नीड डिफाइन करना, कंसीव करना स्ट्रेटजीज को, ड्राफ्ट जॉब डिस्क्रिप्शन, पब्लिसाइज पोजीशन, रिक्रूट कैंडिडेट, एग्जामिन एप्लीकेशन, कंडक्ट फोन और इनिशियल स्क्रीनिंग। टाइप्स ऑफ रिक्रूटमेंट में इनिशियल इंटरनल रिक्रूटमेंट होता है, यानी दोस्तों आप ओपन पोजीशन फिल करते हैं करेंट स्टाफ मेंबर से। रिटेन रिक्रूटिंग में दोस्तों एजेंसी कलेक्ट करती है पार्सल फी फ्रॉम द क्लाइंट बिफोर द रिक्रूटमेंट प्रोसेस बिगिन। कंटीजेंसी रिक्रूटमेंट दोस्तों रिक्रूटिंग एजेंसी या कॉन्ट्रैक्टर को पे किया जाएगा यदि कैंडिडेट को हायर किया जाएगा। रिक्रूटिंग फॉर स्टाफ एजेंसी पार्शियल जॉब सीकर विद ओपन पोजीशन। और प्लेसमेंट रिक्रूटमेंट ये हेल्प करता है लोगों को जिन्होंने अपने जॉब खो दिया है और नए एम्प्लॉयमेंट फाइंड करना, उसमें हेल्प करता है। सक्सेसफुल रिक्रूटमेंट दोस्तों ऑर्गेनाइजेशन में पहले चेक करते हैं, सिलेक्शन के अंदर प्रिलिमिनरी इंटरव्यू, एप्लीकेशन लेना, एग्जामिन करना एप्लीकेशन को, एम्प्लॉयमेंट टेस्ट, फॉर्मल इंटरव्यू, फिर वेरिफिकेशन ऑफ रेफरेंस, मेडिकल टेस्ट एक्सेट्रा। ट्रेनिंग दोस्तों एक प्रोसेस होता है कि आप स्किल और नॉलेज को इंक्रीज़ कर ले वर्कर का बेटर जॉब परफॉर्मेंस के लिए। उसके बाद दोस्तों बात करते हैं टाइप्स ऑफ ट्रेनिंग की, तो ऑन जॉब ट्रेनिंग होता है, यानी वर्कर को इंस्ट्रक्ट कीजिए जब वो परफॉर्म अपने रेगुलर ड्यूटी को परफॉर्म कर रहे हैं। ऑफ द जॉब ट्रेनिंग में क्या होता है कि एम्प्लॉय जो है ट्रेनिंग दूर ले जाते हैं अपने प्लेस ऑफ वर्क से। रिटेंशन और डेवलपमेंट में इफेक्टिव प्रैक्टिस होता है हायरिंग, सोशलाइजिंग, ट्रेनिंग एंड डेवलपमेंट, कॉम्पेंसेशन एंड रिवार्ड, फेयर सुपरविजन। एम्प्लॉय इन्वॉल्वमेंट स्ट्रेटजीज़ क्या है, कॉम्प्रिहेंसिव स्ट्रेटजीज़ है। नॉलेज एंड लर्निंग मैनेजमेंट में क्या होता है, एक प्रोसेस है कि आप जनरेट करें, एक्सचेंज करें, यूटिलाइज करें और इन्फॉर्मेशन को मैनेज करें किसी ऑर्गेनाइजेशन के अंदर। दोस्तों नॉलेज मैनेजमेंट का बेनिफिट है कि ये सपोर्ट करता है इनोवेटिव प्रोडक्ट को, सर्विसेज को, डेवलपमेंट को, शॉर्टर डेवलपमेंट साइकिल को शॉर्ट करता है, मैनेज करता है और दोस्तों क्रिएट करता है एंडेवियर फॉर एजुकेशनल ग्रोथ। परफॉर्मेंस अप्रेजल क्या करता है दोस्तों, परफॉर्मेंस को इंप्रूव करता है, एम्प्लॉय के डेवलपमेंट को सपोर्ट करता है, डेफिशिएंसी को करेक्ट करता है। मेथड क्या क्या है परफॉर्मेंस अप्रेजल का, तो पास्ट ओरिएंटेड मेथड में रेटिंग स्केल, स्टेट एनालिसिस, फोर्स चॉइस, फोर्स डिस्ट्रीब्यूशन, क्रिटिकल इंसिडेंट्स, कॉन्फिडेंशियल रिकॉर्ड, तो ये सब ये फीचर ओरिएंटेड में MBO, असेसमेंट सेंटर अप्रोच, ये सभी अप्रोच है दोस्तों। फिर बताया जा रहा है कि BARS क्या होता है, बिहेवियरली एंकर रेटिंग स्केल। यहाँ पे KRA बेसिकली एरिया होता है आउटकम का या आउटपुट का, जिसके लिए डिपार्टमेंट रिस्पॉन्सिबल होता है। जो इंडिविजुअल परफॉर्मेंस और डेवलपमेंट प्लान है, इसके दो पार्ट होते हैं, परफॉर्मेंस प्लान और इंडिविजुअल डेवलपमेंट प्लान। ह्यूमन रिसोर्स डेवलपमेंट में दोस्तों ट्रेनिंग दिया जाता है, अपॉर्चुनिटी प्रोवाइड किया जाता है दोस्तों एम्प्लॉय के ग्रोथ के लिए। इसका टाइप है ऑन जॉब ट्रेनिंग, जॉब शेडोइंग, इंटेलेक्चुअल प्रोफेशनल डेवलपमेंट। दोस्तों अलग अलग जनरेशन को मैनेज करना, कैसे मैनेज होगा, तो एजम्पशन ना कीजिए, लेवल को यूज़ कीजिए, रिव्यू कीजिए अपने बाइसेस को रेगुलरली, इंडिविजुअली पे फोकस कीजिए और डिफरेंस क्रिएट कीजिए। फिर दोस्तों डाइवर्सिटी को मैनेज करना, यानी दोस्तों आप प्रॉब्लम सॉल्विंग, अंडरस्टैंडिंग डाइवर्स ऑडियंस, ऑर्गेजन फॉर एजुकेशनल ग्रोथ, हेल्दी इंडस्ट्रियल रिलेशनशिप, यानी रिलेशन और इंटरेक्शन जो है लेबर और मैनेजमेंट के बीच में अच्छी होनी चाहिए। एरियाज़ क्या है दोस्तों, एम्प्लॉय सुपरविजन रिलेशनशिप, यूनियन मैनेजमेंट रिलेशनशिप, मैनेजमेंट ऑफ चेंज। दोस्तों आप क्या करते हैं कि जो आपके लीडर्स हैं उनके बीच में कन्वर्सेशन को मैनेज करना, फिर चेंज को इम्प्लीमेंट करना। स्टेप्स क्या है, चेंज प्रोसेस को समझना, ड्राइवर ऑफ चेंज को अवेयर रहना, फॉर्मुलेट स्ट्रेटजी फॉर्मुलेट करना। दोस्तों हम लोग यूनिट 5 को रिवाइज करते हैं। लेट्स रिवाइज यूनिट नंबर 5 विच इज़ बेस्ड ऑन डायरेक्टिंग। तो डायरेक्टिंग क्या होता है दोस्तों कि गाइड करना, मोटिवेट करना, काउंसिल करना, सुपरवाइज करना। इसका कैरेक्टरिस्टिक्स है कि आप एक्शन इनिशिएट कीजिए, एफर्ट इंटीग्रेट कीजिए, मोटिवेशन प्रोवाइड कीजिए, चेंजेस को एकोमोडेट कीजिए। एलिमेंट्स इसमें लीडरशिप, मोटिवेशन, कम्युनिकेशन, सुपरविजन आते हैं। लीडरशिप एक प्रोसेस होता है कि आप लोगों को इंस्पायर करते हैं कि वही कॉमन गोल और कॉमन गोल पे काम करें और अपने रिसोर्सेज को ऑर्गेनाइज करें। दोस्तों ट्रेट क्या होता है, ट्रेट एट्रीब्यूट्स एट्रीब्यूटेबल टू इफेक्टिव लीडर्स। सो फ्रेंड्स आप यहाँ देख सकते हैं इंपॉर्टेंट पॉइंट्स कि ये सब ट्रेड्स एट्रीब्यूटेबल होते हैं इफेक्टिव लीडर्स के। कौन क्या इंपॉर्टेंट है लीडरशिप का रोल क्या है, रिस्पॉन्सिबिलिटी का, लीडरशिप के क्वालिटीज़ क्या क्या हैं। अब देखिए इसमें लीडरशिप का मॉडल होता है, 4 तरह के लीडरशिप मॉडल होते हैं। एक होते हैं ऑथोरिटेरियन लीडरशिप, इसका एडवांटेज डिसएडवांटेज आप यहाँ देख लीजिए। उसके बाद नेक्स्ट होते हैं पार्टिसिपेटिव लीडरशिप, प्लीज सी द एडवांटेज एंड डिसएडवांटेज। द नेक्स्ट इज डेलीगेटिव लीडरशिप, यू कैन सी द एडवांटेज एंड डिसएडवांटेज। एंड द नेक्स्ट इज ट्रांजेक्शन लीडरशिप, ये एक हाईली स्ट्रक्चर्ड फॉर्म ऑफ लीडरशिप होता है जिसके अंदर क्लियरली डिफाइंड एक्सपेक्टेशन होता है, रिवार्ड होता है, कॉन्सिक्वेंस होता है किसी कंपनी के अंदर। फिर दोस्तों ट्रांसफॉर्मेशनल लीडरशिप होते हैं। फिर मोटिवेशन, दोस्तों टाइप ऑफ मोटिवेशन की बात करें, इंट्रिंसिक और एक्सट्रिंसिक होते हैं। इंट्रिंसिक एटीट्यूड मोटिवेशन, कॉम्पिटेंस मोटिवेशन, अचीवमेंट मोटिवेशन। एक्सट्रिंसिक के अंदर फियर मोटिवेशन, इंसेंटिव मोटिवेशन, सोशल मोटिवेशन। फिर दोस्तों यू कैन सी द यूजेस ऑफ मोटिवेशन, कंपोनेंट ऑफ मोटिवेशन, तीन की एलिमेंट होते हैं, इंटेंसिटी, डायरेक्शन, परसिस्टेंस। अब देखिए एल्डरफर्ग अर्थ थ्योरी ऑफ मोटिवेशन है, तो जी से ग्रोथ, आर से रिलेटेडनेस, ई से एग्जिस्टेंस होता है। दोस्तों हर्जबर्ग थ्योरी ऑफ मोटिवेशन है, इसके अंदर मोटिवेटर्स हैं और हाइजीन है। मोटिवेटर में अचीवमेंट, रिकॉग्निशन, रिस्पॉन्सिबिलिटी, अपॉर्चुनिटी फॉर एडवांसमेंट और प्रमोशन। हाइजीन के अंदर सैलरी, टेक्निकल सुपरविजन, वर्किंग कंडीशन आते हैं। दोस्तों मैकलेलैंड नीड थ्योरी ऑफ मोटिवेशन है, तो डेविड मैकलेलैंड का जो थ्योरी ऑफ नीड है इसमें नीड फॉर अचीवमेंट, नीड फॉर एफिलिएशन, नीड फॉर पावर, ठीक है। तो यहाँ पे ट्रायंगल के 3 कोनों में दिया है। फिर पॉटन्स एंड लॉरेंस मोटिवेशन ये स्टेट करता है कि रिसीविंग रिवार्ड कैन लीड टू सेंस ऑफ फुलफिलमेंट एंड दैट समटाइम परफॉर्मिंग वेल कैन रिजल्ट इन रिसीविंग रिवार्ड। फिर दोस्तों इक्विटी थ्योरी ऑफ मोटिवेशन क्या करता है, एक तरफ इनपुट है एक तरफ आउटपुट है, ठीक है। तो जब हम क्या इनपुट मतलब आप क्या जॉब के अंदर दे रहे हैं, आउटपुट का मतलब आप क्या जॉब से ले रहे हैं। वीरूम एक्सपेक्टेंसी मॉडल में एक्सपेक्टेंसी, इंस्ट्रूमेंटैलिटी, बैलेंस है, यानी मोटिवेशन एक्सपेक्टेंसी, इंस्ट्रूमेंटैलिटी और बैलेंस का प्रोडक्ट होता है। अब एक्सपेक्टेंसी, इंस्ट्रूमेंटैलिटी और बैलेंस क्या है ये आप देख सकते हैं। दोस्तों फिर सेल्फ डिटर्मिनेशन थ्योरी है, यू कैन सी द डिटेल रिगार्डिंग दिस हियर। ओके द कम्युनिकेशन के अंदर दोस्तों लीनियर मॉडल आता है, डायनेमिक मॉडल आता है। उसके बाद दोस्तों लेवल ऑफ कम्युनिकेशन की बात करें तो देयर आर 5 लेवल ऑफ कम्युनिकेशन। कम्युनिकेशन क्यों इंपॉर्टेंट है, दिस हैज बीन एक्सप्लेन्ड हियर। सो इफ यू वांट सच टाइप ऑफ PDF प्लीज व्हाट्सएप योर नंबर ऑन द स्क्रीन। आई हैव एक्सप्लेन ईच एंड एवरी concept in the simplest manner possible, taking help of diagrams which is not given in your books. दोस्तों सुपरविजन का मतलब क्या होता है? सुपर मतलब फ्रॉम द अबव, विजन मतलब टू सी। तो देखिए क्या क्या क्वालिटीज़ है इफेक्टिव सुपरवाइजर का। टेक्निकल नॉलेज, ऑनेस्टी, एबिलिटी टू लर्न, एबिलिटी टू टॉक वेल, नॉलेज ऑफ द ऑर्गेनाइजेशन, टेक्निकल ऑर्गेनाइजेशन। इंपॉर्टेंस क्या है सुपरविजन का, यू कैन सी हेयर। सो दिस वाज ऑल अबाउट आवर यूनिट नंबर 5 दैट इज डायरेक्टिंग। सो फ्रेंड्स नाउ लेट्स रिवाइज यूनिट नंबर 6 कंट्रोलिंग क्विकली। आइए कंट्रोलिंग को क्विकली रिवाइज करते हैं दोस्तों। सो फ्रेंड्स नाउ लेट्स रिवाइज कंट्रोलिंग क्विकली। दोस्तों बताया जा रहा है कि बेसिक्स ऑफ कंट्रोलिंग में पहला स्टेप है इस्टेब्लिशमेंट ऑफ स्टैंडर्ड, दूसरा है मेजरमेंट ऑफ एक्चुअल परफॉर्मेंस, तीसरा है कंपैरिजन ऑफ एक्चुअल परफॉर्मेंस विद स्टैंडर्ड, पांचवा है चौथा है दोस्तों करेक्शन नेसेसरी। कैरेक्टरिस्टिक कंट्रोलिंग की बात करें, मैनेजमेंट फंक्शन, परवेसिव फंक्शन, कंटिन्यूस फंक्शन, डायनेमिक प्रोसेस, फॉरवर्ड लुकिंग, मेजरमेंट एंड कंपैरिजन, करेक्टिव एक्शन। एडवांटेज यू कैन सी। नाउ दोस्तों लिमिटेशन की बात करें तो इंटरप्राइज का बहुत कम कंट्रोल होता है एक्सटर्नल इन्फ्लुएंस पे। एम्प्लॉय दोस्तों उनको अच्छा नहीं लगता है कि उनको सुपरवाइज किया जाए, रेजिस्टेंट ऑफर करते हैं। सेटिंग कंट्रोल पॉइंट आसान नहीं है दोस्तों, एक्सपेंसिव है, टाइम लगता है, एफर्ट लगता है। टाइप ऑफ कंट्रोल मैनेजमेंट की बात करें तो इनपुट यानी फीड फॉरवर्ड कंट्रोल, प्रोसेस यानी कंकरेंट कंट्रोल, आउटपुट यानी कि फीडबैक कंट्रोल। दोस्तों कंट्रोल प्रोसेस क्या है, 5 स्टेप है। पहले परफॉर्मेंस स्टैंडर्ड को सेट कीजिए, एक्चुअल परफॉर्मेंस को मेजर कीजिए, कंपेयर कीजिए एक्चुअल परफॉर्मेंस को स्टैंडर्ड के साथ, रिवीजन को एनालाइज कीजिए, करेक्टिव एक्शन लीजिए। रिलेशनशिप क्या है प्लानिंग और कंट्रोलिंग में, प्लानिंग स्टेज ऑर्गेनाइजेशन होता है कंट्रोल का, कंट्रोल प्लानिंग को हेल्प करता है लॉन्ग टर्म को सस्टेन करने के लिए। और दोस्तों बताया जा रहा है कंट्रोल की टेक्निक क्या है, ट्रेडिशनल कंट्रोल टेक्निक है, मॉडर्न कंट्रोल टेक्निक है। मॉडर्न के अंदर PERT यानी प्रोग्राम इवैल्यूएशन एंड रिव्यू टेक्निक, MIS यानी मैनेजमेंट इन्फॉर्मेशन सिस्टम, मैनेजमेंट ऑडिट, ये सभी मॉडर्न कंट्रोल टेक्निक है। ट्रेडिशनल के अंदर बजटिंग एंड बजटरी कंट्रोल, कॉस्ट कंट्रोल, इन्वेंट्री कंट्रोल, ब्रेक इवन एनालिसिस, प्रॉफिट एंड लॉस कंट्रोल, दीज आर द ट्रेडिशनल कंट्रोल टेक्निक। दोस्तों ट्रेडिशनल कंट्रोल टेक्निक है पर्सनल ऑब्जर्वेशन, बजटिंग एंड बजटरी कंट्रोल, एवरीथिंग हैव बीन डिस्कस्ड, व्हाट आर द एलिमेंट्स ऑफ बजटरी कंट्रोल। नाउ ब्रेक इवन एनालिसिस दोस्तों इलस्ट्रेट करता है कॉस्ट और वॉल्यूम के बीच के रिलेशनशिप को। ब्रेक इवन पॉइंट वो पॉइंट होता है जहाँ पे गेन जो है लॉस के बराबर होता है। स्टैटिस्टिकल रिपोर्ट के अंदर दोस्तों एवरेज, परसेंटेज, कोएफिशिएंट ऑफ डिटरमिनेशन, रेशियोज, इन सभी के टर्म्स में एक्सप्रेस किया जाता है। मॉडर्न कंट्रोल के अंदर दोस्तों ROI होता है, रिटर्न ऑन इन्वेस्टमेंट। फॉर्मूला आप देख सकते हैं, ROI इक्वल टू नेट इनकम अपॉन कॉस्ट ऑफ इन्वेस्टमेंट एंड इन्वेस्टमेंट गेन अपॉन इन्वेस्टमेंट बेस। ओके दोस्तों ये सभी मॉडल भी में भी आ गए हैं। फाइनेंशियल स्टेटमेंट और रेशियो एनालिसिस भी एक तरीका होता है। इसमें कंपैरेटिव स्टेटमेंट, कॉमन साइज स्टेटमेंट, रेशियो एनालिसिस, कैश फ्लो स्टेटमेंट, बहुत सारे प्रोसेस को यूज किया जाता है। रिस्पॉन्सिबिलिटी अकाउंटिंग के अंदर दोस्तों बहुत सारे अमाउंट ऑफ रिस्पॉन्सिबिलिटी को प्लेस किया जाता है इंडिविजुअल एम्प्लॉय पे, जैसे इनपुट एंड आउटपुट, टारगेट ऑडियंस क्या है, रिस्पॉन्सिबिलिटी सेंटर का एस्टैब्लिशमेंट, ऑर्गेनाइजेशन स्ट्रक्चर और सेंटर की जो रिलेशनशिप क्या है। PERT और CPM की जो डिफरेंस बताया जा रहा है, PERT का फॉर्म होता है प्रोजेक्ट इवैल्यूएशन एंड रिव्यू टेक्निक, CPM होता है क्रिटिकल पाथ मेथड। PERT जो है इवेंट ओरिएंटेड है, CPM एक्टिविटी ओरिएंटेड है। PERT अनप्रेडिक्टेबल एक्टिविटीज़ को मैनेज करता है, CPM प्रेडिक्टेबल एक्टिविटीज़ को मैनेज करता है। MIS दोस्तों जरूरी रिस्पॉन्सिबल है ताकि इन्फॉर्मेशन प्रोवाइड कर सकें, जो कि साउंड डिसीजन लेने में हेल्प करता है। मैनेजमेंट ऑडिट एक प्रोसेस है, आप एग्जामिन कर सकते हैं कैसे कंपनी अपने रिसोर्सेज को यूज़ कर रही है। Now what are the selection of the technique of controlling? This has been explained. Controlling technique and information technology कैसे related है? Organization control technique, management control technique, financing control technique, data processing, environmental control technique, physical access control technique, legal access control technique, SLDA control technique। SLDA का मतलब होता है सिस्टम डेवलपमेंट लाइफ साइकिल। BCP का फुल फॉर्म होता है बिजनेस कंटिन्यूटी प्रोसेस, application control technique. So this was our complete revision of the module number of ABFM. How you like the lecture, please write down in the comment section. If you like the lecture, kindly hit the like button. And friends, if you want such type of lecture, then we have दोस्तों हमारे पास हर एक यूनिट का, हर एक सब्जेक्ट का क्विक रिवीजन सेशन अवेलेबल है, इसका लिंक आपको डिस्क्रिप्शन में मिल जाएगा। यदि आपको इस तरह की PDF की रिक्वायरमेंट है तो प्लीज़ व्हाट्सएप मी ऑन द नंबर शोन ऑन द स्क्रीन। थैंक यू।